everybody. Good to see you. Thanks for coming. My name is Jeff Gibby. I'm going to kick us off today. I hope you're doing well. Thanks for joining us for day 5 of the Traders Conference. Just a quick note, if you're joining us and you're watching on YouTube, we are going to be giving away prizes all day long. To be eligible to win those prizes, what you'll want to do is when you're going to want to go to metastock.com, click on the banner at the top, register for today's event, and that's how you can get registered today. So I do want to say thank you for coming. Thanks for being a part of the event. Let me go ahead and kind of start a little bit. Let me go ahead and read our legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. MetaStock and its employees do not endorse a purchase of any security, nor are they paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. If you have questions today as we go, if you're watching this on GoToWebinar, click the questions box. If you're watching this on YouTube, just go ahead and type them in the chat and we'll be happy to answer them. Before we get started, I want to say thank you to some very awesome sponsors that we have. I want to say thank you to Stocks and Commodities Magazine. Stocks and Commodities Magazine has sponsored almost every single event we've done for the last 15 years. They're a great partner, a great sponsor. It's also a great magazine. If you have a subscription to Stocks and Commodities, you can get access to all of the 17,000 articles and a searchable archive that's available. And you can find more about that at traders.com. A big thank you to Stocks and Commodities Magazine for sponsoring the event. I also want to thank the Traders Forum. You can join the Traders Forum for free. TheTradersForum.com is where you do that. There you can chat with other traders, learn about the markets. It's designed to be a community of traders helping other traders. Today we just got up to, well, actually earlier this week, we hit our 1,200th member. So it's a great place to hang out. We talk all kinds of technical analysis up there. We do indicator lessons. We do interviews with really good traders. It's a great place, a great resource, thetradersforum.com. Of course, we're MetaStock. We're going to be talking about MetaStock all day. MetaStock's been rated #1 in this price category for 32 years in a row. All of the promotions that we've got all week long, you can get at metastock.com/conf-promo. So our first guest today is Vince Vora. Vince has been a great friend of MetaStock over the years. And for many years, actually, we've had several versions of his very, very popular add-ons. Back in 2020, he created a very, very popular method that was designed to take advantage of more volatile market movements. And it's been very, very popular. We've reiterated on it a couple of times. And without further ado, let's go ahead and get him started. Vince has been one of those people that have been kind of a bit of a mentor to me. I've learned quite a few lessons about trading with him, and pay attention. Vince, let's go ahead and get you started. How you doing?
I'm great, Jeff. How are you?
I'm good.
Good, good. Let me share my screen. First of all, thanks for having me on again. Really appreciate it.
Yeah. You're always invited. All right, I can see your screen.
You can? See my slide?
Yeah.
Excellent.
Yeah.
Excellent.
All right, I'm going to get out of the way. Your turn.
Okay. Thank you. Welcome, everybody. Good morning. Glad to be with you. As Jeff said, we created Victory 2.0 late 2019, early 2020. We've been trading with it since, and it's been amazing. I'm going to take this hour to show you everything about it this morning. Before I do that, just a quick second about myself. I'm the head trader here at Trading Winds. We've been doing this since 2013, I believe, at Trading Winds, and I have been trading over 3 decades. I've done quite a bit over that time, creating strategies, trading systems, but the most fun I've had has been with coaching students. We do have a group at Trading Winds that we trade with all the time, and I'm going to tell you more about that as we go through the presentation, but it's a lot of fun. We have people from all sorts of different backgrounds and experience levels, and it's just fantastic. We meet with them 3 times a week, and it's just a ton of fun. And before we get started, please remember that trading can be risky. Here at Trading Wins, we do everything possible to eliminate risk. Hopefully during this hour that we have together, I'm going to show you a few techniques to help you keep risk to an absolute minimum, but please don't start trading with real money until you are completely comfortable with the system you are using. Now, let's get started with Victory 2.0. Here's my MetaStock platform, and what you're seeing on my chart is the Victory add-on here. Now, there are a lot of little things to look at here. We will go through them one by one. I will say, before I describe what these arrows and flags mean, is that this is a system that is designed solely with technical analysis. I mean, there's no fundamental analysis involved in the algorithm here. Having said that, you could marry the two. Myself, most recently, I have been doing more and more of that, selecting some great, solid fundamental companies and then using the Victory add-on in order to time my entries and my exits, etc. The premise behind this is to take advantage of trend and momentum. Whenever you're trading with trend and momentum on your side, more than half the battle is won. And what we try to do is use simple math here in order to guarantee our success. And the way we do that is by keeping our losses extremely small. I'm sure if you've been around this game for a while and read different trading books and so on, you've heard traders tell you to cut losses quickly. That is the single best piece of advice I could ever give you in this game, and allow your winners to run. Now, sure, it's easier said than done, but we think we've pretty much got a handle on it with Victory here. This does most of the work for you. So I like to take a top-down approach when I look at the market, meaning I will start with the highest time frame, the monthly time frame on my chart, which is what you see here. This is a chart of SPY, the S&P 500 ETF, and I will look at the Dow, the S&P, the Nasdaq, and the Russell 2000 on the monthly time frame to sort of gauge whether we are in an uptrend, a downtrend, or in a market that has no trend. In other words, a consolidating market, a sideways market. Once I determine that, I will use Victory 2.0 to look at the 12 different sectors and get a quick glimpse of which sectors are hot right now, which are not, and then break those down. And that's how we find our stocks to trade. So I'm going to show you all that in this hour. I would also like to show you many different charts. This does work on equities, ETFs, Forex, futures, crypto. It doesn't matter. Anything that you can create a chart on, any time frame. We are going to go through 1-minute charts, 5-minute charts, daily, weekly, monthly. You can trade them on different exchanges. Before we went live with this, we tested it on exchanges in the US, Canada, Australia, UK, India, all over the place. It works the same no matter what, for the simple reason that it is an algorithm based on technical analysis. So the price action determines everything here. So please, if you have questions along the way, type them into the chat. Jeff, if you can hear me, I do not have the YouTube live chat open, so if there are questions there, just interrupt and I will answer them, but I'll keep an eye on the chat here. Thank you. And please type in whatever symbols you want me to bring up. If there's a trade that you're thinking of putting in, or a stock that you just like to trade generally and you want to see how Victory would have handled it, by all means type it in and we'll bring that up for you. So let's talk about what you're seeing on your screen here. There are going to be arrows, both green and red. And you're also going to notice that there's some smaller arrows and some bigger, darker arrows. Okay. There are also going to be some dots, some red dots, some green dots, and some exit flags. There might also be some yellow bars every once in a while. And then there's this blue line. So let's go through it. So obviously the arrows are indicating where the system believes is a good either long entry or short entry, etc. Now, before we go through any rules, and I'm going to give you the exact rules that I use to get in a trade and out of a trade, I will tell you that the intention here is not to take every single symbol or setup, okay? We want to take the best of the best. So although you will see many arrows along the way, it's the rules that we wrap around it that are going to determine which ones you take and which ones you do not, okay? And the reason we do that is to improve our accuracy. If you follow the exact 8-step checklist that I'm going to give you, what you will notice is that what you should have, if you're doing this correctly, is more winners than losers, but more importantly, your winners are much bigger than your losses. And with that math, you can't really go wrong. So arrows, and if you hover over any of these with your mouse, you'll notice that a little box comes up and it'll tell you what it is anyway. Now, the difference between the small, lighter arrows and the darker, bigger arrows, this one says long, obviously, and this one is HPB. It's a high probability buy, okay? Means that it satisfied a couple of other factors in the algorithm that makes this a stronger setup. Now, you can also customize this. You can remove some of these. You can, keep them all on. This is a customizable add-on, okay? Very simple to do. But generally, when you get a green arrow, it is a good time to go in, as long as it meets all 8 pieces of criteria that I'm going to show you in just a minute. Now, you'll notice that once we're in a long trade, every single bar or candle, whatever you want to use, it is colored green, okay? That is intentional. That is to keep you disciplined and not get scared out of a trade early. That is the one main thing that a lot of traders struggle with. They get in, if the stock starts moving their way, it's all good. They're happy, comfortable, calm. But as soon as you get a couple of red candles pulling back on you, they start to question whether or not they're about to give back their profits or whether they made the wrong decision. They get scared out only to see the stock continue to go up, right? And so hopefully this will help you. Now, what you can do here, or actually let me just explain what the dots are and the blue line is and these ribbons at the bottom, and then I'll go through the rules. So the dots here, like this green dot here, you'll notice it says long RE. That stands for long re-entry, meaning the same criteria that came together for the long has come together again. But since we're already in a trade, we're just labeling it a little differently. And so if you got in here, now you can add to your position here, add to your position here, if you choose, or just use it as confirmation that you're in the right trade here and you should remain in this trade until you get either an exit flag or a change in color. Sometimes the system will take you from green, exit and not give you another entry right away. It might be a bar or two before you get another entry. Sometimes it'll ask you to go straight from long to short. So what I look for is any change in color, I exit the full position. Now, along with the add-on, you're going to receive a couple of different training classes where we talk about, scaling out along the way, taking some profits off the table along the way. But whenever there's a change in color, I need you to exit the full position, no questions asked, okay? What you will notice here is that when the system realizes that the trade is starting to go against us. Okay, for example, if you got short here, which we wouldn't have according to the rules, I'll show you in a sec. But if let's say we got short here and it starts to go against us, it'll get you out immediately. Okay, reason being is we want small losses, no big losses. I've taken big losses. That's how I came to develop this system very early on. I took some very large losses, and looking back, it was ridiculous. There was no reason for it. And so after experiencing those losses, I developed both a trading plan, a system, along with a money management plan that will simply never allow me to take another big loss again. And I will share those rules with you so that you'll never have to take a big loss again. So we have entries, obviously, to the long side, to the short side. We have re-entries to the short side, to the long side, exit flags, and this blue line right here is a 20-period simple moving average. Okay, not exponential, not weighted, simple. This we use for momentum, to judge momentum. To judge a trend, obviously, you're looking at pivot highs, pivot lows, but basically on a chart like this, you can tell when you're going from bottom left to top right, we're trending higher. If it was top left to bottom right, we'd be trending lower, sideways, pretty obvious. The trend, the momentum, excuse me, is where the 20 comes in. We want the 20 to be sloping in the direction of our trade. Okay, now we could have a minor slope. Like this, we can have a stronger degree of slope. And then we can have a very strong degree of slope, right? The higher that slope is in the direction of the trade, the better. So for a downtrend or a short sell, you want the 20 to be sloping lower. When you're sloping or not sloping, excuse me, when the 20 is flat, those are areas that you do not want to trade in. That's where traders lose most of their money. During a consolidation, traders get in, they get stopped out. They get in, they get stopped out, etc. And that's where they give back all their profits. So we want to avoid that, and I'm going to show you exactly how. All right. So now, before I get to those rules, I want to tell you another feature of this add-on is this here. All right. With one click, and actually I should show you how to get there. If you right-click on your chart and you say Apply Template, okay, and you go here, you're going to have to scroll to the bottom. This is, in order, and the Voras are all at the bottom here in alphabetical order. There are templates here, which is the multi-time frame view. And you'll notice that there is a 1 hour, a 1 minute, 5 minute, 30 minute, but there's the multi-time frame view, the market overview here, this one, market overview, that's where this comes in. With one click, it'll give you the ETFs for the Dow, the S&P, the NASDAQ, the Russell 2000, along with all the different sectors in there, from communications, energy, financials, all the way to utilities. Now, what this is painting for you here, green and red, this is what the color of the add-on currently is on that chart. So again, if you look at the S&P here right now, it's green here. Now, this is a monthly time frame. It'd still be green on weekly and daily right now. But you can choose the time frame that you're looking at here. Right now, I have daily on the left, weekly on the right. You can change that if you want. But basically, it's telling you whether we have green or red bars there. And so generally, during a strong trending market, like now, if you look at the weekly here, we have pretty much green all the way down, okay? Consumer staples is the only red along the way. So you can tell that we're in a very strong bull market there, compared to times where everything is mostly red, and then you're in a strong bear market. But it's also useful since even in a strong market here, you don't want to put you don't want your portfolio to have nothing but long positions. You want to be hedged in some way, right? So it's always good to have one or two positions on the short side as well. Well, this will help you identify the sector that is weak right now. So you can look through the components of the consumer staples sector and pick out a couple of very weak stocks to use on the opposite side and balance your portfolio a little. Okay, so that's fantastic. Now, these ribbons down here, these will tell you, and I'm going to switch to the daily time frame. Okay, here on the SPY, these will tell you what the color of the indicator is on 2 higher time frames. Okay, so I'm here on the daily. I don't have to switch my charts to a weekly and a monthly to see what the chart looks like. This tells me right here. Okay, and you'll notice that when all 3 time frames are aligned, daily, weekly, monthly, that's when you get your strong pushes, right? We can scroll through and go back, and you'll notice that. So it's a very helpful guide. Now, as I showed you earlier, if you go to apply template, we have templates to use if you trade on the 1 minute time frame, the 5 minute, the 30 minute, hourly, etc. So if you're on the 5 minute, this will show you the 15 minute, and the 30 minute, for example, 2 higher time frames automatically if you're using those templates. Okay. And also going back to the to this here, if you're looking for the same type of information but on a different market, we have it for the Australian market, we have it for the Indian market, the Nifty, and we can always add more if you want, if you're trading, if you're living in different parts of the world and trading on different markets. Okay, so I see Israel is already asking for NEM. Great, let's use that to start here. So let's look at a few charts. New Mount Mining in the gold sector, which has been super hot right now. Fantastic, here we are. So I'm going to use this actually to give you those rules, the 8-point checklist, which I'm going to bring up right now, right here. So I'm going to read it quickly, and then we're going to go through the chart and see if a particular setup has these. So first of all, you want a clean chart. What do I mean by that? Well, you want a clean trending chart. If there's something that is very, very messy, okay, here's a tip I'm going to give all of you. When a market is trending strongly, most of the bars are all very similar in size, okay? When you go through a volatile period, the bars start to all change, some small, some big, all over the place, and it's difficult for you to spot a trend, okay? But when it's trending strongly, you can tell by the price action how clean it is, how strong it is, and also by the degree of slope on the 20, obviously, okay? So we want a very clean chart. I'll come back to this in a second. I just want to show you an example. If we look at Zoom here, all right, give me a sec, my system is a little slow. So for example, kind of messy all over the place. You look at small bars, big bars, and it's just kind of all over the place. Is there really a trend here, right? So not really. You want to avoid these kinds of charts. This is where you're going to get stopped out quite a bit. Compared to if you want a really nice clean chart, it's predictable, right? So have a look at this, especially on a weekly time frame, okay? Very, very predictable. It either goes up, it goes down, it goes up. And these are not hard to find. They're all over the place. These charts are the ones with the most volume, the most heavily traded, and they're very, very predictable. This helps you make trading easy, and the Victory add-on will help you time these moves perfectly. Okay, so let's go back to NEM. And it's obviously been doing very well. here recently. Now we can look at the weekly time frame, but I'm going to go back to the daily. Please, if you're entering a symbol, let me know what time frame you want to look at, so I make sure I'm giving you what you're asking for. And now let's go back to the checklist here. So we want a reason to enter. Now you may have a strategy already that you like to use, a method of getting in a stock, but for us it'd be the victory method. So any of those arrows or dots. We look at slope on the 20. It needs to be sloping in the direction of the trade, and the higher the degree, the better. Now, we want that setup bar, the bar that has that arrow or that dot, to be as close to the 20 as possible, okay? Reason being is if we were entering up here, we'd be at risk of a snapback. Whenever price moves away from a moving average, it's going to come back. It's going to revert to the mean eventually. So we want it to be near the 20. It doesn't have to be touching it, but it's near. So this setup here, for example, okay, if we had determined that this was a clean chart, all right, and then we need a reason to enter, and we have the victory entry, okay, and the bar is close to the 20 here, okay, the 20 is sloping. So far, we have what we need, okay, so let's carry on. Now, where does the bar close? That bar that has the arrow or the dot, where does it close? For longs, we want it to close in the top half, preferably in the top quarter of the bar. Why? Bars that tend to close, near the high tend to follow through over the next couple of days. So it puts the odds more in our favor, okay? And then we want to look at support and resistance, higher time frames, and earnings. So where did this bar close? Well, it closed pretty much right at the high, which gives us a much better chance of following through. Then we want to look at support and resistance. So we want to look to our left here, and is there blank space here? That's what we want to know. If there was a lot of activity overhead, we'd be running right into a wall of activity. That's resistance. In other words, we want to run into blank space. So new highs, especially if you're trading a 52-week high. So have a look at this setup right now on NEM, okay? So you have a beautiful slope, very high degree. You are close to the 20. Now, by close to the 20, the way I look at it is I look at the high of the bar, because the only way I'm going to get in here is once this bar closes, I'm going to look for a trade 1 tick or 1 penny above that high, okay? And my stop is going to be below the 20 here. So I got to measure the amount of risk I'm taking. If it's too much for me here, it's about 5-6 points. If it's too much for me, then I skip it and go to another trade. But if it's within my risk profile, then I'm happy to take that trade. So we've got slope, we've got a reason to enter, we've got a clean trending chart here. We're near the 20 right now. At least we're at the high of the day. And when we look to our left, there's nothing but blank space, which means there's an open road ahead. Now, we also want to look at the higher time frames. Are they green? If we're trading long, we want both of these to be green. They are, okay? And then we would look at the earnings date. The earnings date is one you want to avoid. When earnings are released, it can gap up, down. There's really no way to predict it. So you want to make sure you have at least 10 days or more before earnings to let the trade play out. I like to have more than that. Now, there may be a change coming. Trump has decided that he doesn't like quarterly earnings, so the SEC sounds like they're gonna go along with his suggestion. They're gonna vote today, I believe, on it. But considering the panel's 3 Republicans to 1 Democrat, I think we're gonna see quarterly earnings go away and go to at least 6 months, if not annual. So we may not have to worry about that any longer, but right now we do. So a trade like this would mean that it gives us a very high probability of success. So and now I'm going to start flipping through charts a lot quicker, okay? And the ones I want you to focus on are the ones with slope and where these entries are near that. Okay, we're going to go through it. But for example, take this one here, this red. Okay, would we go short here? No, we wouldn't. Why? Simple fact, the 20 is sloping higher, not lower. So that right away, that one thing doesn't allow us to tick off all 8 boxes. So we would not take a trade. So these rules keep us out of the bad trades. So this sideways action, you see how many arrows there are here? And this is typical with most trading systems, right? The problem is most people don't wrap rules around it to avoid those. Now, we couldn't program these out of the, like, not program these in without removing some of the good ones. So we left those in and we wrapped the rules around it. You see, if you got short here, you get stopped out. You go long here, you get stopped out. You go short, you get stopped out. That's where you get eaten up. You want nice trends here. Now, Greg is asking for MXL. Let's see. MXL. Let's see what we're looking at here. Beautiful. Okay. So, perfect example. Thanks, Greg, for this example. Look what we have here. A flat 20, right? We have a consolidation period. Can we say we have higher highs, higher lows, etc.? No, we cannot. What we can do is look at this pivot high, this pivot high, this pivot high, and say we have lower highs. But we can look at this pivot low, this pivot low, this pivot low, and say we have higher lows. So what we're doing is we're consolidating, but it's tightening here. So if we draw trend lines across here, okay, we've got a bit of a wedge going here. Okay? And this is great. It's tightening up. It's going to break out one way or the other. And when it does, that's when we can consider a position. In here, every single one of these would have been a loss. Okay? But they would have all been avoided if you follow the rules, the 8-point checklist. This would have met the rules, right? This would have met the rules, and so on. This would not have, the ribbons were not fully in line, okay? That's what you got to look for. Look back in here. There's another area of consolidation. Once we broke, we went higher, right? Now, we may not have, the system may not have allowed us to take any of these, but there's going to be so many that your job, what you're going to do every day when you're scanning for trades, is compare one to another, okay? Because you're going to find many. It's rare that you don't find any setups, and then you're going to select the strongest of the strong. So we can look at this on different time frames. It doesn't really matter. Again, whether you're trading on a 3-minute chart, a 5-minute chart, daily, weekly, monthly. This stock has been consolidating here. I mean, it's been dropping, but now it's been consolidating. It's trying to build a base, okay, but it's just not quite there yet. So we look at it on the monthly, and there we are. It's trying to do something, but right now, you know, this downtrend doesn't appear to be over just yet. So not a stock I would trade. But let me explain 2 other rules here. I know a lot of you have probably spent many hours, months, years trying to figure out how to buy at the bottom or sell at the absolute top. Aside from telling you that it's a waste of your time, try to capture the middle 60% of a move. That's the easy part. But if you insist on doing that, I'm going to give you a couple of rules that might help you at least get close to the bottom or the top, okay? So when we don't have slope in our favor, for example, we take this long. When we look at this, this would not allow us to check off every box because the 20 is not sloping in our direction. But whenever we don't have that 20 in our favor, there are 2 situations that would allow us to take that trade. Okay, we're taking a bit more risk, but we can still manage. One is if this bar that went along with this arrow, and it's very small here, I hope you can all see it. If this bar had closed above a prior pivot high, so for example, if it was up here above this high, okay, again, you'd have to look at the amount of risk you're taking and be comfortable with it. But if it closed above a prior high, then you could ignore the negative slope and go ahead with that trade as long as it met the other 7 pieces of criteria. Or when it retests the 20. Now, if you look at this, we moved above and then we came back to the 20 here, touched it actually a couple times, and then we moved ahead. So on this bar here, where it moves above these highs that tried to retest it here, at that point, you could consider jumping in, okay? Or during consolidations, basically, you want to mark the high of the consolidation, you want to mark the low, okay? And then you can take the breakout. Now, if there's slope on the 20, if the higher time frames are aligned, all that other good stuff is also in line with that break, even better, okay? Those are the kind of trades we look for. Kenneth was saying, yeah, is there any reason to retain these signals when you're not planning to take it? It's a programming thing. We just, at the time, we couldn't eliminate those without eliminating some of the good ones. So we left them in there. So we're trying to clean that up in the next version here. Let's look at some more stocks. Please put in symbols if you want. I'm going to go through some of the more popular ones. How many of you have been trading Robinhood? I'm sure many of you have, along with Palantir and a number of others. And we can look at different time frames as well. I'm going to look at futures, Forex, and a few other things for you. Again, you see a nice, strong, trending, clean looking stock. Look at the price bars. Very similar in size, are they not? That's a nice, consistent trend. And you can clearly spot the consolidations compared to the trending ones, just using the slope on the 20, right? Now, if we go back here, here's a perfect example of one of these where we had a flat 20, okay? We did not close above a prior high, nor had we retested the 20 yet, so this would not be valid. But stock carries on, it pulls back. Here's your retest of the 20. But it just so happens that we now have a high probability buy signal. We do have slope, right? We are close to the 20, okay? The bar does close near the high of the day. When we look to our left, we don't have a lot of activity. There is a lot of blank space here. Why? This was the prior all-time high, okay? When we look down here, both are green. So we have everything we need. All we need is a trade, 1 tick or 1 penny above that high, and we're in. Now, there was a small gap here, which is okay. I would take this trade. If it was a big gap and we opened up here, far from the 20, you wouldn't want to chase that, okay? This goes on nice and easy, right? All the bars painted green, so it doesn't make you nervous at all. All you're looking for and waiting for is a change in color. Now, you can add to your position here, add to it here, add to it here, add to it here, but remember, you want to follow money management rules, okay? In the training, we're going to give you the 5-step money management plan that will not only help you avoid big losses, it'll guarantee you never take big losses again, okay? If your money management plan allows you to add more, you can. If you're maxed out, you just hold it until you're out here, okay? And yes, sometimes if you're in a trade like this, can you get one day that's a big gap down and you end up back down here? Of course, it can happen, but they're rare. In most cases, you just get an entry out here near the top, okay? So this one looks great. Let's have a look how this one would do on a 5-minute chart, for example, right? It doesn't really matter the time frame. There are going to be quiet periods. There are going to be busy periods, okay? So here's an area, a day where you would want to be out of this market. The eight-step checklist there would not allow you to take any of these trades. So that's the thing. And when you're trading intraday, you're gonna have to wait for a day, where everything lines up. Now, you might be wondering why these are blank down here. It's because I have the template for the daily, which is only the weekly, monthly, so it's not going to show you that. If you add the 5-minute template, it's going to give you the 15-minute and 30-minute one here. Okay. This, I can tell you, was a beautiful trade here, and this is what you're looking for. And it's nice and easy. They are worth waiting for, and you don't have to wait long. You just have to compare one to the other and pick out the strong ones. But the ones, look at this, you have significant slope. You have a victory entry here. The bar is close to the 20. We closed pretty much at the low. These were red, I can tell you that at the time, okay? And you look down here, and there's a lot of blank space. And it's just an easy road down. That's all we're doing, is we're using trend and momentum in our favor, all right? And with a few other indicators in the background, when they line up, it gives us a very high probability of a move in that direction. And that's what we're using. So let's look at, for example, gold, all right? Here. And see. Now, gold has been incredible lately. I still like this longer term, no question. And again, you can look at it, and this is a 5-minute. Let's go back to the daily. Here. Beautiful, easy moves. Again, when something like this does not have slope, right? You're either looking for a break of a prior high or a retest of that 20. And then as long as everything else lines up, okay, there you are. Now, one other thing I will show you quickly is when you're consolidating, these can be very frustrating to sit through. I don't want you to be frustrated. I want you to look at them as opportunities. The longer this goes on, the bigger the move you're going to have in whichever direction it breaks, when it does break. So if this were to last for several years, it would frustrate the hell out of you, but it'd be well worth it. When it does finally break out, okay, so on this bar, you measure the length of that, okay, and then you just invert it up, and that is the size of the move that you are expecting. And it works incredibly well, I can tell you, incredibly well. So the longer this goes on, the better it actually is for us. We wait patiently for a breakout, and then we play that upside, okay? It's fantastic. Let's look at Palantir. Let me know if there's anything else any of you want to see. I'm going to show you a couple other parts to this indicator in a second. Apologize, we haven't gotten through more charts, but I just love teaching here. What did I do wrong here? Got the wrong Palantir? Yeah, there we go. So really what we're doing with this is just putting the odds in our favor. It's that simple. So when a trade like this, so clean, that comes up, we're all over it. And we don't have to ask questions. Look at this. Generally, it looks like a trade you wouldn't want to take. Is Palantir, is this uptrend over? Is Palantir falling apart now? What's happening? Is this going to be a head fake? Is it going to be a double top? What's happening? The 20s flat, but it breaks above, and what does it do? Comes back, retest, holds that retest. Right here we get in, and boom, off you go. Okay. Now, not if it's close to earnings. If this was an earnings gap, we wouldn't want to get in the day before earnings. Okay. Always be aware of that. But otherwise, that's what you want. When you cross, a lot of people, when they start trading, look at crosses with moving average, either one moving average crossing another, or price crossing the moving average. if you're trading like that, I'm going to give you a couple of tips. Number one is when you cross, you really don't want to look at this until you clear a prior high. And number two is to either or to retest the 20. So you're either got to clear a prior high or you got to retest and hold whatever moving average you're using. Okay, a simple cross does not do it. So for example, here you cross below and then it just turns around and goes and continues to go, right? Here it crosses, right? And it continues and it changes direction again. You need something to confirm that it is going to remain on that side of that moving average. And that's either a break of a prior high or a retest. And in many cases, it happens along the same area. So if you look at this high and this high, same, and off it goes. Okay. Can you look at Rio Tinto? Sure. Let's see, Rio Tinto. Absolutely. Let's have a look. So what do you see first glance, Kenneth? I see a mess. I would run from this chart right away immediately. First of all, a lot of gaps, a lot of little gaps. And this is the daily time frame. This tells me there's not a lot of volume on this right now. Okay. If I have the right one, do I have the right one? Let me make sure. I think I have the right one. Yeah. So this would make me run away. Now let's see if it's a little smoother on a higher time frame. No, it's still messy. See how the bars are all over the place? What you're asking for here is to get stopped out. So that's the problem here. So our first rule on our checklist here for a clean chart will keep you out of this mess and save you from future losses. And that's what we're trying to do. So again, have a look at this. When it was trending, right? You would meet all the rules. So you have a reason to enter. You have slope. The bar is close to the 20. The close is near the high. Higher time frames are aligned. You look to your left, nothing but blank space. The only other thing is earnings. If there was no earnings date here, you enter. And then if you missed it, you have another chance here. You missed it, you have another chance here or here. If you can add to it, you add to it. You scale out at certain parts along the way. You know, what we're going to teach you along the way is you know, once you move away, you know, maybe you take some profit. When it comes back, you add it back. You take some more, you add it back. You take some more, you add it back, and off you go. And when it goes red, you're out of there completely. Now, here's one of those examples where, you know, you were up here and oh wow, you're out down here. Yeah, if you don't scale out along the way, there's always that risk. It could happen. If you're going to try to play penny stocks, for example, that get pumped and dumped, you know, they have those big runs, you better take some near the top or all of it if you can, because it's going to turn. When it moves that far away from the moving average, it's going to snap back, right? So you want to be smart about that. You want to look at the distance of the 20. So when it pushes away, you definitely want to take some off. Pushes away here, take some off. Look, then it snapped back, right? Pushes away, and then it snaps back, pushes away. So take those profits and move on. Now, there is more to this add-on than what I've shown you so far. If you go to the top left here and click on View, there's expert commentary. Now, some of you who have been using MetaStock for a while already are aware of this feature, but for those of you that are not, this will tell you, and by the way, you can move this box around anywhere you want on your screen, but this will tell you a bit more about myself and Trading Wins and Victory, but it will help you. It'll help you hold your hand throughout the life of a trade here. Now, you'll see this little triangle that is over the most recent bar. It always defaults to the most recent bar, regardless of what time frame you're on. Now, you can move this by using the arrows up here on the expert commentary box, or just by clicking over a certain bar, okay? So let me try to go back to a trade there. So here. So this is indicating the end of that long trade, right? Because we get the exit flag here. And then now it's signaling a short sale opportunity. So basically, if there's no trade signal, the area between these two paragraphs will be blank. If there is a trade opportunity, it's going to walk you through it. But if it's a long, it's going to be green text. If it's a short, it's going to be red text. So we're saying consistent with the theme. And then it'll also give you some advice on if you're trading this with options, how far out in the expiry you want to go, what kind of delta you want to target, that sort of thing. And then more importantly, as the trade moves forward, okay, it's going to put in here a stop level. This is for those of you who cannot be in front of your screen all the time. You have full-time jobs, so on, you want to go to work, but you don't want to leave your position open with no stop. It'll give you a stop level. Otherwise, if you can watch it, you're just waiting for that change in color, okay? So this is extremely helpful. And the other thing is, if you go up here to the top left, the letter P, the power console, and you click on that, go to the third tab down on the left, Explore. This is the scanner. This is what will help you quickly find trades. So there's all the explorations here that you can choose. Again, it's alphabetized. Mine are at the bottom, but you can right click on one of these and add to favorites. So the ones you're going to use constantly, just add to favorites. I have a tab here. And here are the victory ones. Now, you'll notice that this says Vora victory filtered. What Jeff and his team have done is filtered it by slope. So we only want to identify the ones that have slope. We don't want the ones that are flat. If you're looking for channels, there's one that is just called Vora victory that incorporates all of these signals. So you can use that, okay? And then there's the one for high probability only, etc. So if we click on that and then we come down here and we choose what we're scanning, right? So Dow Jones 30, the NASDAQ 100, you can do S&P 500. There's one for all optionable stocks. That's the one I usually do. And, and then you come down here, you choose your time frame and you let it run. You start your exploration. And that is going to help you quickly identify some trade candidates, okay? I know I'm short on time. I'm gonna ask Jeff to come back in. He can tell you how to get yourself a copy, but I'm gonna stick around for more questions, especially from the YouTube crowd.
That was a quick hour. That was a quick hour.
It's never enough time, Jeff, never enough time.
I could do this all day. Oh, wait.
You are. That's right.
Let me go ahead and make myself the presenter. I don't see any questions on YouTube, but if you do have them, let us know. I'm going to just jump over here real quick and let's show my screen. And let's talk a little bit about Vora Victory 2. So with Vora Victory 2, like I said, we released the first version of this back in 2020. And it was before coronavirus, but Vince wanted to kind of come up with a way to kind of take more advantage of the increased volatility in the market. And I don't think he had any idea what was coming, but with everything that happened later on. But as a result, it ended up being our best-selling MetaStock add-on for that year, and it's been extremely popular. So Vince talked about the detailed commentary breakdown, the expert alerts, the market scanning. We do have the ability to scan for the high probability scans, as well as the buys, as well as the sells. All those are kind of built in there. I love scanning. I'm about ready to run a scan just so I can see if there's anything I want to trade today. And it does have the ability to test trading ideas as well. So it takes advantage of all of the parts of MetaStock. When we added some stuff to it, we had to really kind of put some thought into what we were going to add, just because I was like, hey, what else were we going to add? It's a very, very good system. It's given great signals. People really like it. But what could we kind of do to improve it? And it took us a while to kind of think of some ideas of things that might be helpful. And the multiple time frame views was a great idea. I don't remember whose idea it was, but that kind of ribbon on the chart that just allows you to kind of see what the higher time frames doing at a glance. There's a market dashboard in here, and I think that's my next slide is the market dashboard. Market dashboard will allow you to, the default view for this is you get monthly, weekly, and daily. But you can look at any view of the market that you want, and it just tells you kind of how the market's looking. Like right here, this is the Dow Industrial. This isn't current, by the way, this is a slideshow, but the Qs, the IWM, you can see what sectors are moving, all that kind of stuff, just built right into the platform that you can see at a glance. It's actually pretty cool. So in addition to that, we added the take profit suggestions where you can kind of go in and take some profit off the table when you're in a good trade. And here you can kind of see what things are doing on a higher time frame. So if you're looking at, in this case, it's a daily, you can see what it's looking like on the weekly and the monthly without even looking at the chart. You can see if we're, I don't know if bullish is the right word, if we're positive for victory on the longer, higher time frames. So those were all added as part of the suggestion or the things. And here are the scans. And I've kind of talked about these already, but you can look at the Vora victory. One of the things, and actually this is one of the things I had actually kind of incorporated for my own trading. I was like, well, you know, we're say to look at stocks that have a slope of greater than, let's say, 5 or less than 5. Why don't we create a filtered exploration that just kind of eliminates the ones that are kind of going sideways so that we can just focus on the best ones. And so the filtered allows you to kind of run in and see the ones that not only have the buy recommendation, but also where the slope is at least minimum of what we'd want to see. You also have the re-entries, the high probabilities, those are all scannable as well. Vince did a good job of talking about the expert advisor. What I will say is Vince did a really good job of kind of defining this out and talking about where to get out of the trade, when to enter the position. When you get a new trade, it's going to tell you exactly what its suggestions are for options and how to get into those, and you know what deltas you might be looking for. It's almost like having Vince over your shoulder, just kind of telling you what to do. So it tests very well. There's a system test that's in there, so you can test it and see how it works if you're trading it just with stocks. And we actually also include Vince's other very, very popular systems as well. He released a winning momentum strategy that we retailed. That was one of the first strategies that he created for MetaStock. It was about $500. It's included as part of the package, as well as Veracity. That's normally about $19.97. It was a predecessor to Victory, and is included as well. Both of those have full commentary, they have full systems. So what you get when you get this particular add-on is kind of a complete collection of Vince's work. It's pretty cool. So, but in addition to that, we've been kind of talking a little bit about the Trading Win service off and on over the course of the week. We've given away a couple of subscriptions to it, but a couple times a week, they'll do a live session. Vince and I guess Rahul's involved as well. You can correct me if that's not correct, Vince. But they do 3 live weekly training sessions. They send out daily trading ideas. There's on-demand technical analysis training videos, ideas for option trades. All of those are included. That's a subscription that's very, very well worth it. At like $97 a month. I mean, just the ability to kind of sit down and kind of talk to people and get ideas and that kind of stuff by itself is extremely valuable. A lot of people just subscribe just to the service. It's a $1,200 value. We're going to include it as part of the purchase. So we did record a bootcamp class that's available as soon as you order it. In that bootcamp session, Vince sat down and talked about how to use Victory 2. And after he was done, I did a little bit of here's some best tips and practices for using MetaStock. So that's available as soon as you order it as well. There's a ton of stuff in here. So I'm gonna try and go through it real quick. You got Vora Victory 2. Normally that'd be $19.97 as a retail cost. You have Veracity, we sold that for $19.97, and it's included in Victory now. You get the winning momentum strategies, that's $500. You get the year of the ongoing training sessions, that's included at $11.64 value. The total price, you get the boot camp. That's not even on here. We didn't charge for that. That's not, we want you when you buy something from us, we want to make sure it works for you, and that's why we back it with a money back guarantee and let you try it. But we also want to make sure you understand how to use it. And I love everything that's included with this. All the boot camp, the weekly sessions, the trade alerts, the trade tips, all of that stuff's just included. Because a lot of times when you get a system, it's really, really helpful if somebody's around to kind of help you understand it and help you kind of explain it to you. So the value on everything that we're going to kind of put into this package today is $5,657. We're going to sell it to you for just $997. A big thanks to Vince to kind of making this deal possible and offering the year of the trading service as well. We are still going to back that with a money back guarantee. This page got a little bit funny when I pasted it in. We'll still back that with a money back guarantee. What if you don't have MetaStock? We've been talking about how MetaStock can be helpful for your trading all week long. $997, 30-day money back guarantee, free trial of MetaStock if you need it. 1 year access to all of the Trading Wins Pro membership. The other add-ons, the Vinces that have also been super popular, all of that is just $997. So to take advantage of that, you can give us a call at 800-882-3040. You can go to metastock.com/saleschat, and you can also visit metastock.com/conf-promo. Let's see, Nylish had a new question. Can we get a daily, weekly, monthly stocks and ETFs list as it aligns and happens and gets updated on a daily basis? So you can run a scan. That's a good question, Nylish. You can run a scan on a daily basis to see whatever's matching up. And then that dashboard is a really good way to kind of look at the market and say, okay, well, the markets are up or the markets are sideways or the markets are down, depending on kind of what they're showing, but also see exactly what sectors are going up. So in order to get a daily list, yeah, absolutely. That's one of the core advantages of the product is you can say, hey, I'm out of the optionable US stocks, which ones are giving me a buy signal, and it'll return that to you. So absolutely, you can do that, Nylish. So that's the only last question I have. Again, if you want to take advantage of that, Callis would be more than happy to send you any questions or answer any questions you've got, send you any information you want. I encourage you to try this. Metastock.com/conf-promo, 800-882-3040, or metastock.com/saleschat. Vince, a big thank you for coming in and spending an hour with us. That was a fast hour.
Thank you, Jeff. It's a lot of fun. Thank you again.
All right, cool. Let me go ahead and do this. And as we move on to our next speaker, there's two things we need to do. The first one is I need to say thank you to Stocks and Commodities Magazine for being a long-term sponsor of the MetaStock events. Really appreciate all the help that they've been over the years and all the work that they've done. If you don't have a subscription to Stocks and Commodities Magazine, you can grab it at www.traders.com. And as we've been saying all along, any of the offers we talk about, you can get at metastock.com/conf-promo. If you have any questions at all, you can call us 800-882-3040 or visit us online at metastock.com/saleschat. Now, Liz, you're welcome. Thank you for the question. Greg, what's the second thing we need to do right now?
Well, I think we need to give some stuff away.
All right, let's do prize. Okay.
Sounds like
as is a custom, now it's become customary, we're going to give away a Steve Bigelow book as our very first prize. So
that sounds great.
We're going to do the candlestick patterns, high profit candlestick patterns. This is one of 3 books Steve Bigelow wrote. I believe he wrote a couple Christmas books, but I believe there was a total of 3 around investments, and I'm sure I'm going to get corrected if I'm wrong. But Steve was probably the mentor that had the most impact on the way that I trade. He has, I'm hearing a little bit of me coming back.
Let me turn down my speaker over here.
You're fine. He was, let's see, a partner of MetaStock for a number of years. His patterns we've programmed into MetaStock. Great person, absolutely loved him. This is a great book. I've read it. So you're going to win well, you might win a copy. It depends on if Greg likes you and if
Right.
you're lucky.
That's a lot to ask.
All right. Greg, what I really need from you is just a number between 2 and 5,329.
Say that last number again.
5329.
Okay, according to the Google random number generator, today's first lucky winner is number 2,974, 2974. And while you're pulling that up, I would like to say that I wrote down all of Vince's 8 rules and can't wait to employ them to use his method, which I used to use and I haven't used recently, and I'm going to start doing it again because I really have enjoyed it in the past.
Cool. Let's see. Yeah, Vince does a really, really good job. Okay, high profit. All right. Great. Thank you very much for the assist. Oh, yes. Before I let you go,
yes,
can you tell everybody that is watching on YouTube how they can register to win if they haven't?
Absolutely. If you're on YouTube, all you need to do is go to metastock.com and there's a banner at the top. You click that, you fill that out. It takes just a second, or you can click the chat that I have pinned at the top of the link I have pinned at the top of the chat right now. Don't need to enter more than once. Doing so will not help your chances of winning. And if you're on GoToWebinar right now, you've already entered, so you don't need to do that. One thing I should mention too, Jeff, as we're waiting for Buff to come on, I did.
Buff's waiting for
his
us.
camera came on earlier, and I selected and turned his camera off remotely. And I don't know if there's something you or he need to do for his camera to come back. I apologize. I assumed he had not intentionally done that. So.
Oh yeah, I can turn his camera back on.
There he is. Okay.
You can turn it back on.
All right. Sorry,
yeah,
Buff. That was if that was jarring. I just wasn't sure if you knew you're live, so I clicked you off real quick.
Yeah. Juan wants to say.
Both of you break a leg.
Yeah. Thanks. Thank you, Greg. Appreciate it. Juan asked a quick question I'm going to answer. What markets can be scanned in MetaStock? Are there international markets like Canada, Europe, etc.? There's about 200-ish exchanges you can use in MetaStock. So that would include Canada. It would include London. India is a very popular. Singapore, Hong Kong, just about anything on Earth, because we get the data from London Stock Exchange Group, and they own the whole what used to be the Reuters infrastructure for that. So thank you for the question, Juan. You can use just about anything you want. Buff, I'm going to actually go start introducing you. How are you doing today? Let's see. Let me go ahead and send you a unmute request.
Okay, I'm doing great, Jeff. You hear me now? I was muted.
Yeah, I do that too. I don't have a good excuse though. I'm gonna go ahead and make you the presenter. Buff, let's see. I'm trying to remember the award you won for VCPI. Was it the Dow Award? Charles Dow Award. Okay. Buff's extremely smart. He uses volume and volume-based analytics. He won the Dow Award, as we just discovered, in his methodologies. And Buff, I'm going to turn the time over to you now. Are you ready?
Yeah, more than ready, Jeff. Glad to be with you.
Okay, I'll be here if you need me. It's all yours.
Okay. All right. Hey, well, Jeff was mentioning Stocks and Commodities magazine. So as another plug, in the upcoming October issue, which you can actually, if you're a subscriber, you can get, you can download right now. I have the featured article. So I think I think the article is on my favorite subject, volume, and how volume is a force. Well, thanks, Jeff, for having me on today, and thank you all for joining my session. Again, I'm Buff Dormeier, but to you, I'm your volume evangelist. Now, we're going to talk about the markets today, and the markets are extremely efficient vehicles. And we have to remember that when we invest, we're going head-to-head against the most capitalized institutions that are employing the wisest minds. And so going up against them could be a difficult game. So what I'm here today to do is I'm here to provide you with some volume-based tools that's going to provide you with an edge by identifying where the money is moving, okay? And that will allow you to follow the path that the smart money is ablazing. So this will be a technical discussion today. I'm going to speak about my custom indicators that are available to you through MetaStock, and not only what they are, but why they work. And so, do you currently use moving averages? Are you using RSI, MAC? All great tools, but they're antiquated. They've been around for decades. Today, you have an opportunity to get out of your Model T and step into the cockpit of a Model S. We're going to start the first few minutes or so by reviewing the fundamentals of technical and volume analysis. This is how I start off most of my presentations. We're going to start from the very basic groundwork, build a framework so that you can understand the rationale and why this works. Okay. Now it's going to seem real basic at first, but pay attention because it's going to build upon itself, and you're going to need this understanding as we move along the presentation. And when you finish up, you'll not only have the tools, but access to the very systems that will put you generations ahead of the institutions we're competing with. Now, a little bit about myself. I'm Buff Dormeier. I'm the Chief Technical Analyst at Kingsview Asset Management, and I'm also the Index Specialist at Monarch Funds ETFs. So I do this professionally. I advise advisors. I manage money exchange traded funds. The Monarch ETFs employ my volume factor intellectual property, some of which I will disclose to you today in this session. Said we're going to start with the basics. And does it get any more basic than price? Well, let's take a step back. What is price? Okay. If I am purchasing a stock today, what's my opinion of it? Well, I'm bullish. I believe it's going to go up. There's no other reason to buy it, right? But in order for me to take that ownership, the order must be matched. Okay. We call it the stock exchange. And what's the opinion of the other person on the other side who's selling it to me? There could be multiple reasons to sell, but most likely they're bearish. They believe it's going to decline. So what is price? Price is just the agreement to disagree. Two people coming together with opposite views, and they agree, and that agreement is called price. Now, price is truth. Doesn't matter what the analytics say. Doesn't matter what the talking heads on TV say. Doesn't matter what the fundamentalist and intrinsic value is. The stock is worth what it trades for, and price represents all the collective knowledge of the markets. So price is the collective knowledge of markets, and that is the price of what it sells for. Is all that knowledge is embedded. Now, volume is synonymous with force. Okay. Now, if we were to look up in the dictionary, what would we find for the definition of force? If volume and force are the same thing, force is a power made operative against support or resistance. And so what's support? Support is an area where the buyers reside. And what's resistance? Resistance is the area where the sellers reside. And what's an uptrend? We follow trends. What's an uptrend? It's nothing more than a rising support line. And what's a downtrend? It's nothing more than a falling resistance line. And volume is the force required to sustain those trends. So here's another definition. This comes from the physics dictionary. Volume is a vector quantity that tends to produce an acceleration, okay? This confirms a major tenet of technical analysis going all the way back to the days of Charles Dow, way over a century ago, that volume leads price, meaning that we see the changes in volume patterns, they precede the changes in price movements. So think about it this way. What did Yoda say before going on an important mission? May the volumes, my friends, is the force of the exchange market. If you take one thing away out of my presentation today, remember that volume is the force, and you as an investor want to make sure you're on the right side of it. Volume is the performance driver in all the strategies I professionally manage. Volume is the unknown investment factor. My book last year, The Volume Factor, goes out and proves using sophisticated scientific methods like the Fama-French model that volume is not just a leading indicator. It's not just a piece of data, but it's actually a market factor, okay? So this is not just my professional opinion. There's research on this that's been tested, and we're going to go through some of that, a little bit of that science, that research in some of the studies that we go through today, okay? But before we do that, I opened up and I said, I'm an evangelist. So if I'm an evangelist, I have to have a sermon, and it has to have 4 points, and it has to all start with the same letter. So this is the 4-point sermon on volume, okay? And these are the four reasons why I use volume data in all my portfolios, my selection process, my exit, my risk management. Volume is a piece to all of those. Okay, so let's just go through it. The first R is responsiveness. Okay, volume provides quicker information. Volume leads price. Okay, so as I mentioned before, changes in volume occur before significant price movements. The second R is reliability. Not only does volume lead price, but volume also confirms price. If price, it is the market's testimony. Remember we talked about it? It's like the DNA. It contains all the collective knowledge of the market. That is price. Okay, it's the market's testimony. Volume is its polygraph. Volume validates and substantiates price. The more people participating at a given price, the more that price point is validated. Okay, so with volume, we not only can get in quicker, but it also increases our reliability, meaning it gives you a better probability of making being on the right side of the market. Okay, if we can do those two things, if we can get in quicker and we have better reliability, it will help us differentiate between a trend that's legitimate and by identifying weakness early on. And this will help us reduce risk in the portfolio, and it will also help us increase returns. Okay, so what we're doing here is with volume is we're using the information to put the odds in our favor so that we can make better returns with less risk. Okay, I said we're going to study some studies. This one goes way back. Okay, I made some claims that volume is leads price. Okay, this is a study we done using the scientific method testing a basket of securities. Okay, and I said we're going to introduce some new tools too. How many of you use moving averages? Simple moving average? Do you use exponential? Do you use weighted moving averages? What kind of moving averages are you using? You're probably not using volume weighted moving averages. Here we compared volume weighted moving averages compared to simple moving averages. And in 93% of the time, volume averages had faster signals than simple moving averages. Not only did we get quicker signals, of the signals, 60% of them were more reliable. So you got in quicker and had a higher probability of being correct, whereas only 28% of the time did the simple moving averages were more reliable, and 12% of the time there was no significant difference. Okay, using a volume weighted moving average strategy versus a simple moving average crossover system, the drawdown was lower about 70% of the time. And we had 60 securities that were tested, 44 of them had lower drawdown with volume weighted moving averages. And then if we can get in quicker and have higher probability of being on the right side of the trend, you can see that 11 out of these 12 different types of groups of stocks had better returns with using volume weighted moving averages. Okay, so we know now that we should dump our SMAs, and now we should pick up volume moving averages. Okay, now this is all true. Okay, but this isn't the biggest piece. Okay, the volume factor is all about delta, and as one of the, if not the foremost expert on the subject of volume, I can tell you, this is the piece that people don't get. It's not about volume, it's not about price, it's not about trend, it's not about momentum. It's the difference between volume and price within trends, within momentum, within individual securities. It's all about the delta. So here we can see here in the chart, we have a red line, which is a volume weighted moving average, the blue line, which is the simple moving average. Notice that down here on the volume bars, when the volume pops, the volume moving average becomes much more responsive. What we're going to look at is not the simple, not the volume, but the delta, the difference between the volume weighted moving average and the simple moving average. And when this delta is positive, it's telling you that volume is confirming the momentum and it's confirming the trend. And when it's negative, it's telling you it's contradicting what's happened. Okay, you just got a PhD in volume analysis when you can grasp this concept. Okay, I'm not going to get into all of this, but so we click through those slides pretty quickly. But this is taking that information, that delta, and putting it into an indicator called the VPCI. Jeff mentioned this was the winner of the Charles Dow Award. This shows a symmetry between price and volume. Okay, so notice here that we have the VPCI is red and a smooth average of it is blue. This allows us to follow the trend of VPCI, and the red line is, of course, VPCI. Okay, so this is how it all works. Okay, so think of it like this. Okay, so this is how price and volume work together. Okay, so let's start. We have a trend that's up and the volume is rising. Okay, this is a trend that's up. Markets are up because of greed. Okay, volume is a form of force or energy. So when we have uptrend that with volume, This is greed with energy. This issue is under strong demand. Stocks going up, it's being fueled by volume, and this is the issue under strong demand. The uptrend is being confirmed by the volume. The outlook is bullish. Next, we have a trend that's up, but the volume's falling, okay? Falling volume doesn't operate under the laws of energy, but rather of entropy. So this is greed with entropy. This is the complacent market under weak demand. The uptrend's being contradicted by fewer and fewer people willing to buy at ever increasing prices. The outlook for this is bearish. Next, we have the stock moving down, the volume's rising. This is fear with energy, or a state of fear. This is an issue under strong supply. The downtrend is being confirmed by more people willing to sell at ever decreasing prices. The outlook is bearish. And finally, we have a trend that's moving down. The volume is also falling, moving down. This is fear with entropy, or a market that's in the state of apathy or weak supply. The downtrend is being contradicted by fewer and fewer people willing to sell their stocks at these ever depressed prices. The outlook for this condition is bullish. Well, let me just quickly go through this real quick. So we're going to look at the VPCI. First, we want to know what direction is the VPCI moving. Two, we want to see if there's any crossovers between the VPCI and the smooth average of itself. This shows momentum. Next, we want to know, is the VPCI high or is it low? Is it above zero or below the zero line? And the last one, it's not on here. There's actually one pattern. You see the VPCI form a V formation. That means that the market's having a capitulation moment. So if you see the V like a V bottom, that generally often leads to a capitulation bottom before you see a bottom, or maybe even a V bottom in price. So let's just kind of go through it. So here we have a stock. What is the direction of the trend? It's down. The VPCI is moving down. It's below trend, and this is the zero line, this dotted line. It's below zero. But notice here, the VPCI crosses above the smooth average of itself, then crosses the zero line, and what happens? Stock is now in an uptrend. VPCI is moving up and confirming the move. Now the trend continues to move up, but now the VPCI, the volume's weakening, and this is a warning signal. And eventually the stock tops. And looky here, here's what I was talking about. See that V, letter V in the VPCI, capitulation bottom. The stock starts to move up. The VPCI is moving up with it, and it crosses the zero line, and then you can see the trend going up. That's how we use the VPCI. We also are going to test these 4 R's, okay, of the VPCI, just like we did with volume weighted moving averages. And what did we find? Is that when we tested a trading system versus stocks without and with the VPCI, we turned systems that were accurate about 1/3 of the time, moved it all the way to accurate about over 37% of the time. We looked at a variety of types of stocks that were small caps, mid caps, large caps, stocks with high volume, stocks with low volume, stocks with high volatility, and stocks with low volatility. When you inserted the VPCI into the testing, all of them made more money. Okay, you can take those groups and you combine them together. Those 7 groups make 12 subgroups, and of those 12, 11 of the 12 made more money when infused with VPCI into the system. And what we're going to do is we're going to take the S&P 500. Anybody heard about the S&P 500? Okay, but as opposed to buying all 500 stocks, we're just going to buy the top 10% with the highest VPCI score. And doing that, you take, this is the blue line, the S&P, versus the red line, which is the top 10% of stocks in the S&P with the highest VPCI scores. So we outperform the S&P by almost 3% annualized by doing something as simple as that. Now, next we're going to do is we're going to take the VPCI and we're going to put it into a system, kind of like what I showed you before. Okay, this time we're going to use a trending system where we want stocks that are trending higher, and then we're going to test the VPCI against the system itself, but also against another system that's using an inferior indicator called on balance volume. I call it inferior. I hate doing that because Joe Granville was one of my mentors, and we had a fantastic relationship. And so he's since passed. But by the way, Joe Granville is the creator of On Balance Volume, if you didn't know that, and he was one of the best investors of all time. If you remember those old commercials, the E.F. Hutton commercials, I don't know if I'm dating myself here, but their motto, but their motto was E.F. Hutton talks, people listen. You know why people listen? Joe Granville at one time was their analyst, was their lead analyst. You think about there's Jim Cramer, there's Warren Buffett. Joe Granville was those two wrapped in one, but 10 times as more powerful. Matter of fact, it was said in the 80s that Joe Granville had more power than the Federal Reserve, because when his letter came out and it said to buy and sell, markets just, that they reacted. Co-location, you heard of co-location, you want to get closer to the market so you can get quicker signals. Co-location in the 80s was how far your zip code was from where Joe's mailbox was, where he mailed his or his post office rather. But anyway, so Joe Granville ruled the markets in the 80s and in the late 70s with this indicator on balance volume. And what we're going to do is we're going to compare VPCI in this trend system to on balance volume. So I said first thing we have to do, the stock is trending. How do you know that? We use an indicator called ADX. If ADX is above 30, means the stock's trending. What direction is the trend? Remember we talked about some antiquated indicators? We're going to use the MACD to determine the direction of the trend. When that trend, the MACD has a bullish crossover, we're going to say that the trend is up. Okay. Then we're going to confirm these signals with on balance volume or VPCI. That's the test. And when we did this test was done. This was actually the Charles Dow War, so this is an older thing. I'm going to bring this a little more up to date here soon. But if you were in the stock market, you made 9.4%, almost 10% from this period of time. Okay. But if you were in the MACD and ADX alone, you lost 4% as opposed to make 10%. So that trend system that looks so good, when we tested on the spider, and that's what we used, that's why we started in 93, that was the start of the spider, it actually lost 4%. When we put on balance volume to confirm that, we cut the loss by more than half. We went from losing about 4% to losing only 1.5%. But when we take this losing system of 4% that lost 4%, and we confirm it with VPCIs, we don't just cut how much we lose, we turn it actually into a profitable system. Okay, so we take this losing system that lost 4 and add VPCI to it, and makes 8. Okay, now it didn't beat buy and hold being paired with this losing system, but it was only invested 35.5% of the time. Okay, and because of that, it had significantly less risk. Okay, and so actually, if you were to do something crazy and you would have put your money into the money market, which actually in this period of time would had very favorable rates, you would actually have beaten buy and hold if you would have taken your money and invested in cash when you weren't in the market. This is the year-by-year returns. You can note here there were just 2 years where this strategy lost money. That was in 2000 and 2002. Again, during the periods of time, when you weren't invested, if you were invested in the money market, you would actually made money in both of these periods of time. So let's bring this system up to date. Now we're taking the same system and instead, and we're going to doing something that's subtly different that makes a huge, huge difference. Okay, and the big difference is, as opposed to using the S&P, we're going to use the components of the S&P. So we're going to screen all the components of the S&P and ones that meet the criteria. Why is that important? The reason our system didn't work so well with the SPDR ETF is because the SPDR is a diversified portfolio. At least it usually is not so diversified right now, where 75% of its movements are dictated by the top 10, or excuse me, the top 10% of the holdings. But nonetheless, I'm going away from my point. My point is that when you own an index, that you own value stocks, you own growth stocks, you own 11 different sectors by definition. It's a diversified portfolio. When you look at individual stocks, okay, these tend to have stronger trends. They trend more, okay? Diversified portfolios trend less. So when we use that ADX, we're going to find better trends, okay? So we're going to have better trends that's going to equal better results in our testing. So here we use the MACD, the VPCI, and the ADX together, okay? And we use the components. And notice here that during the period of time, the market does 9.6%, and our system 17.5%. Okay, and we do it with lower risk, I should say, which creates good Sharpe ratios and things like that. Okay, now, what if we were to use some of the same volume theory and infuse it not into simple moving averages, but let's take that same premise and let's infuse it into the MACD. Okay, so this is another indicator that's available to you on the MetaStock platform. This is my trend thrust indicator. It's like an enhanced version of a volume-weighted MACD, okay? But it's adaptive. It can change its settings. You know, you have these settings put in. Maybe it's 12, 13, 6. I don't know. You know, whatever you can. But what this does, it adjusts to make those signals quicker if volume is confirming it, or it can slow it down if volume's contradicting it. Okay, so so this is an adaptive indicator. Okay, so you can see here what it looks like. Here we got a stock. Here's the MACD. Here's a volume weighted MACD, and here is the trend thrust indicator. We're going to test it using 60 stocks that weren't picked at random, but by these traits that of the characters. And when we test the MACD, it works about a third of the time. That's what you should expect. Stocks trend a third of the time. The MACD is only going to work about a third of the time. But when we infuse this volume information into it, we take a system that works a third of the time, and now it works over half the time. Okay, so we're making the indicator more reliable. Okay, and here's each category. Look, almost every category, it takes it from a third to 50. All these different types: small caps, large caps, low volume, high volume, low volatility, high volatility. They all show significant improvements when with the TTI over the MACD. if we're getting better signals, we're going to make more money again on all the different items. So what if we did something crazy? What if, as opposed to using the MACD in our system, that combined the ADX, MACD, and the VPCI, what if we were to drop the MACD and replace it with the TTI? Okay, so look what happens here. We go from 17.5 return to 17.8%, but look what we did to our risk, and look what we did to our max drawdown, and look how much more money we made. Okay, so we're significantly improving our results. Okay, and now we're going to do the same thing here with we're going to add the VPCI. Well, let me go back here. Okay, we're going to add them all here together in one system, and now look what happens. Now we go from 17.5 to 17.8, and with all three of these combined together, we go to 23.2 total return. So when we add all three components, we just keep on getting better. Okay, so what I did for you is one of the things that you have in the toolbox, the volume factor toolbox, is a system that scans for what we just looked at. Okay, and what I did for you for this presentation is on last week, at the end of the week, I screened out the scan to see what stocks are hitting that, and that's what we have here. So you can see we have Alibaba hit. It's not the first time it hit. Let me just kind of go over before I get into the stocks that cleared the screen. Let me take a step back and explain what you're looking at. Okay, so this, of course, is a bar chart. Okay, these are volume weighted moving averages, different time frames. The green is a stop loss if you are short. Okay, so if we get a sell signal, which is this red arrow, if it crosses above the green, that's our stop loss, we're out. Okay, if we get a green arrow, like right here, and it crosses below the red dots, which is our stop loss, we're out. Okay, so this is green is a stop loss for shorts. Red is a stop loss for longs. Okay, the green is the arrow is the buy. When it crosses underneath the sell stop, that's when we sell. I'm not going to get into what these are, but if you're familiar with like a parabolic system, that's what this is on steroids, injected with volume analysis. Okay, this is extremely sophisticated code, and it's available to you on the MetaStock platform. It's called the anti-volume stop loss. Below that, we have the trend thrust indicator, which is the Model S as opposed to the Model T MACD, the VPCI, which has no comparison, and then another indicator called the volume momentum indicator, which is similar to like the VPCI, but with momentum as opposed to trend. This is like kind of like maybe RSI, the delta between RSI and volume weighted MFI. Another thing you have, if anyone's familiar with volume spread analysis, that analysis is already done here by the color codes of these volume charts. You know, looks like Christmas down here, but each one of these colors has a meaning, and it corresponds to a candle or to a bar. Okay, so it helps you interpret each bar one by one by looking at the color the volume bar and the price. Okay, so you get all this with your MetaStock software. So you can see here that we had a sell, we exited our sell, we had another buy, and then we had a buy here. What's not showing is because we're already had a buy, we had another one just recently. This is the same. This is Bloom Energy. I think this is symbol BE. Again, we had a signal here, and we had another one at the beginning of the week. You can see it's already had a nice move. Okay, sometimes we don't always buy ones that are going up, but also starting to show signs of fatigue going down. That's what's happening here with GoPro. You know, the stock's down below $2, but just recently, see a long downtrend, pop, we got a volume. And look, one of the things I'll tell you is, you know, you don't need to be a market genius to find standouts. What are standouts? Standouts when you see these big green bars. Okay, you see these big green bars. Usually when you see that, or you see it means the stock's going to go up. You see a big green bar, it's generally the stock's going to move up. You see a big red bar, generally it's going to go down. Easy analysis, but it's surprising how effective it can often be. Okay, so here this is OPY, I believe is the symbol. Oppenheimer. Look at this. You may follow like William O'Neill, cup and handle. That's what we got here. Plus the volumes confirming it. We got a signal here, exited here, and now we got another buy here. And then, as I mentioned, I'm just going to say this one last time. If these signals were reinforced, even though we had this signal, it screened out again with the same signal last week. Okay, here we go again. REZI. Look, it's basing, based out here. Saucer bottom. Boom, got another signal here. Okay, this is DCI Donaldson. Again, saucer bottom, a handle, and a breakout. Okay, another downtrend, but being broken. A fairly decent sized green bar, not as high as I'd like to see it. But the indicator VPCI is moving higher, VMI is looking good, and the TTI looks like it's just crossed over. Okay, Regions Financial. Again, like a saucer bottom, it tried to break out, failed, pulled back, and now it's trying again. This is Max, very similar to some ones we saw before in a downtrend. A lot of these, maybe, you know, we're going to talk more about this a little bit later, but a lot of these are smaller caps are really starting to show some strength. Okay, here we had a breakout, big green, good green arrow here. TTI still well above zero, VPCI well above zero, trending higher. And again, we got a fresh signal. MGV, again, another, looks like we got a breakout here pretty early in on that move. Okay, this is BZUN, BZUN. Again, another breakout here. This is another very low price, small cap. And then EGAN. You know, look at that right before the breakout. Boom. That one's probably a little too frothy to buy here, in my opinion. So, just to give you a little bit. We got a few minutes here at the end. One of the things I do is I produce a market letter. You can get this letter for free. Buff Dormeier, my name, buffdormeier.com. You can sign up for my weekly letter that explains what's happening with volume. Okay, you can what this is pointing out here is the market bottom here in March 9th. On March 9th was no ordinary day. This was the strongest volume day ever recorded. It's the strongest by a cap weighted basis. It is by far more money moved into the market on April the 9th, the market bottom, than any day before. Why is that important? Because when you have volume of this significance, you know it's not mom and pop. It's the big boys coming in and supporting the price, thinking that the market is this is an opportunity to buy in. And certainly it marked the bottom. Again, just look at the standouts, and that gives you a good hint of what you should be doing. Okay, another thing that happened, we talk about the VPCI and the V bottom. The V bottom happened on April the 11th, 2 days after the move. So April 11th was a VPCI V bottom, a capitulation signal. This is the first time we get this capitulation signal with all the criteria that's required for it to be official after the market moves. Almost every time. Matter of fact, I've been doing this 25 years. I've I've been looking at the VPCI V bottoms. This is the first one ever that's happened after the market bottom, but it was still a great signal. Oh, I was just pointing out Lou. This is Lululemon. Sometimes stocks get a V bottom, and it just had a VPCI V bottom. Okay, this is bringing us up to date. The market had this resistance line here, and we broke through this 5,500, and notice that these things are starting to pop up. The VCPCI is starting to pop up, and these indicators are starting to move up, which is positive. Okay, in the letter we talk about two different animals. Okay, one is the generals, which is the Qs, and then we talk about the troops. And this is IWM, the troops, the small caps. Okay, and this was taken at the beginning of the week. And notice how it was on the verge of breaking out. And as of yesterday, this did break out. It broke out into new all-time highs. We've been talking about this condition for, we've talked about it forever, but at the end of July, we changed the name of our theme of our letter to A Gathering Storm and New Hope. The New Hope is what's happening with VPCI. One of the tells of the troops is watching the advanced decline line. Notice here that it is consolidated, and I would expect that this too is at the end of the week we'll see a breakout into all-time new highs. This is the flow of money. Oh, sorry. And this is my proprietary capital weighted dollar volume. And notice here we got a sell exit that happened on March 25th. We had our VPCI V bottom, and then this crossed over trend, and it's been strongly bullish ever since. But more recently, we had a little fish hook. Okay, this is still way above price trend, but it fish hooked down. And it'll be interesting to see if we close the week above or below new time highs. It's not good that this last week the stock market was at new highs and this was not. But that said, this is still way more above trend than price is above its accumulative trend. This is the same thing on as opposed to money. This is volume. What we looked at before was how much capital. This is just the volume or liquidity. Okay, so if when Jeff is going to come back on, tell you how to move into the cockpit of the Model S with with all these new tools and the systems to generate the signal. If you want to learn more, as I mentioned earlier, my new book is The Volume Factor. That came out last July. It explains how to use volume to create successful financial outcomes. If you want to sign up for that letter, buffdormeier.com is my website. You can sign up there to receive my my weekly commentary on the markets.
All right. Let's see. Do you have time for just well, one question actually? Can you hear me, Buff?
Yeah, I can hear you just fine. Yeah, sure.
Okay.
Sorry.
One, some insight into how profit factor could be calculated.
Well, we don't have profit factor in. Are you talking like the CBOEs, like profit factor, or is that what the, or are you talking about the profit factor of
performance of the system?
Oh, as a performance measure?
Yeah.
Yeah. So well, I have to think about that. I haven't calculated profit factor in a while. But that is one of the statistics that I look at when looking at systems. And profit factor, I think it looks at everything like it's a buck and tells you whether you made or lost money with that buck. So I believe that's how profit factor is calculated. So it's kind of looking at it more simplistically to see if you had $1, how much money that dollar would make. So if you have $1 and if you profit factor of 1.1 means you made 10% on that on the strategy.
I googled it, and it says it's very simply my Google just lit up. It said very simply it's a total wins versus total losses.
Yeah, it takes win versus losses and
cool. All right, and that's the only question. We did have another comment that I wanted to share with you. Richard said, "Wow, thanks for the breakdown." Smiley face.
All right, very good, very good.
All right.
It's a pleasure to be on, and wishing everybody a fantastic weekend. And Jeff, I'll let you take over and explain how you get the toolkit.
All right. Thank you very much for coming, Buff. I appreciate it.
All right. Thank you.
All right. Go ahead and do this. Okay. All right. Yeah, I keep pushing the wrong buttons. All right. So as Buff talked about, winner of the Dow Award, pretty prestigious award given away by the CMT Association. This particular add-on includes everything that he kind of showed in regard to the methodologies and the indicators that he's using. It uses 2 expert systems, scanning, of course. Of course, we're going to include scanning, system testing, the templates, and about 24 custom indicators to run them. I've got a list of all of those as well. The templates kind of lay everything out for you. The expert advisor explains everything, kind of goes through the indicators and what they're doing. And of course, you can scan for it. So with this particular methodology, it's available at a monthly subscription. The cost is just $99 per month. Like all the subscriptions that we've been doing, if you buy a month, we're going to give you the second and third month for free. So it's a great way to try it. If you don't like it, there's no commitment to keep that. But if you like it, of course, you're going to want to keep it, right? So to take advantage of this, you can call us 800-882-3040. You can go to metastock.com/saleschat. You can also visit online with us at metastock.com/conf-promo. Huge thanks to Jeff for doing that, or not Jeff, Buff. Jeff's our next speaker. Huge thanks to Buff for kind of coming in and talking to us a little bit about it. I found what he had to say about the market in general very interesting. So I hope you did too. As we move on to our next speaker, I want to say thank you to the sponsor, the tradersforum.com. Tradersforum.com's been a new kind of thing we've been working on for a little bit. You can come, you can learn about different technical analysis indicators. You can watch interviews that we do with different market experts. We release all kinds of good educational content on a regular basis. We talk, like last week, just to kind of give you a flavor, last week we talked about Kansen. The week before that, we talked about the Ichimoku method. So we try and kind of cover a lot of things. The whole idea behind this, though, is really, it's the design of it is it's a group of traders designed to help other traders. I get a lot of really good ideas from there. I've learned things there, and I'd encourage you to come participate. Tradersforum.com. You can join for free. There's you can come to like all the sessions that we do. You can chat. You can kind of talk to everybody. It's been a great community and it's been growing. So come join us. Tradersforum.com. Greg, Mr. Lewis, it's prize time. I have another Steve Bigelow book, actually.
My very favorite time.
Steve Bigelow. We're going to give away another one of his books. This time it's Eliminating Emotions, and it's by Steve Bigelow. Again, we love Steve. Steve did such a great gift to technical analysis and candlesticks. And, this book was also part of what he created. So I'm gonna send this off to somebody.
I think it's ironic that the name of the book is Eliminating Emotions, and you immediately said that you love Steve. Maybe he didn't want you to eliminate all your emotions.
Yeah.
Just don't fall in love with the security, I guess, is what the point is.
Yeah. I don't think I could. Anyway, let's go ahead and give away a book. I was gonna say I don't think I could eliminate. I'm such a gushy guy anyway. Like I don't think.
Well, you have a soft, cushy marshmallow center, Jeff. I know that about you. Despite your rough exterior.
Go on.
That very buff and hard and muscular exterior.
So if you are watching on YouTube, hello. Make sure to like and subscribe. It helps a great deal. If you have questions, let us know. I don't think we've missed any questions today, but I'm sure we've missed some over the week. But make sure to ask questions if you've got them, if you have comments, anything like that, just help. If you're watching us on YouTube, what I was going to start to say is I want you to register so that you qualify to win a prize. We're going to be giving away quite a number of prizes for the rest of the day. I've got a lot of prizes still to go. And if you register, what you can do is you can click on the pinned comment in the YouTube chat and it'll take you there. If you just go to MetaStock.com and click on the home page, it'll allow you to register as well. But do register. We are going to give away, we might even do like a lightning prize round, Greg.
Oh,
maybe. Yeah. So, but for right now, what we're going to do, I guess I'm going to have to do it now. I said it out loud. Right now, what we're going to do is we're going to do a candlestick.
Can't take it back.
Eliminating.
No takesies backsies on the internet, Jeff.
Yeah, no. I didn't say anything. Number between 1 and 5,329.
Okay, that number, according to the Google random number generator, is, this doesn't seem very random, but it's 1100, 1100.
I hit the wrong mouse. That is a Stephen S. With a Hotmail address. So there you go. I'm going to make a copy. I'm going to make a note of that real quick. Greg, thank you for the assist.
You are welcome. I'm here if you need me.
All right. Cool. Our next presenter has a very cool first name. It's Jeff. Jeff Tompkins has been a part of MetaStock for a number of years now. During the time I've known, the way he started actually was teaching people how to trade on a website called udemy.com. So he's by his very nature a coach, a trainer, whatever you want to call that. Since I've known him, which has been like I think 8 or 9 years since we started doing business with him, he's actually just blown up. He's started a hedge fund. He is very, very popular, and he does a really, really good job. And it's been really cool to see all the stuff he's accomplished just in the little time that I've known him. So without further ado, Jeff, let's go ahead and get you started.
Hey, happy Friday, Jeff.
Happy Friday to you too. I almost forgot it was Friday.
Yeah, it's week has flown by.
Yeah, for sure.
I usually don't
All
know
right,
what day it is, so.
there we go. I can see your
All right,
screen.
got my screen. Good, good.
Yeah, I can hear you.
That's it. We're off to a good start.
All right, I'll get out of the way. How about that?
Okay, all right, sounds good. Well, thanks for the intro, and as always, thanks for having me. It's great to be here. Welcome to everybody who's joining. It looks like we have people over on the YouTube side too, so welcome to all of you. I can't see you, but I know that you're there. So yeah, let's dive in. I'm gonna do things a little differently than I normally do. So we're gonna talk about how to accurately and consistently forecast market direction. We're gonna use a couple very simple, straightforward indicators. But I'm gonna kind of try to cut back on the slides, and I want to do more out of the MetaStock platform today. So we are going to go over a strategy that I call my slingshot, and we'll go over the basics. But I'm going to also kind of give some various nuances and extensions of that strategy that I don't typically cover on these presentations. So I just wanted to kind of give you a heads up, kind of lay the groundwork for what we're going to cover over the next hour or so. So got a lot in store for you. So go ahead and get your pen and paper handy, get ready to take some notes, and let's go ahead and dive in. I will cover a brief disclaimer with you before we get started. Trading securities and options involves risk. Prior to buying or selling an option, investor must receive a copy of characteristics and risks of standardized options, and of course, need a broker to trade securities and options and must meet suitability requirements. Any results that we do cover on our session today are not necessarily indicative of future performance. They might be based on actual trades, they might be hypothetical, but due to the time-critical nature of trading, brokerage fees, activity of other traders, we don't guarantee that anyone will mirror the performance of what is shared on the session. All right, so I'll just give you a brief background on myself, and then we'll dive in. So again, I'm Jeff Tompkins. Great to have everybody here today. I have over 2 decades of experience trading the stock, options, and futures markets. I received my professional training as an intern at the trade desk back in the early 2000s at Morgan Stanley. And we're coming up on our 10-year anniversary, hard to believe, but about a decade ago, founded Altos Trading, where I'm the chief investment strategist. We've rapidly grown over 60,000 members in over 100 countries across the globe. As Jeff mentioned, I'm also a hedge fund manager, so I do manage money for my clients at Altos Capital. And some of the strategies, tactics, tools, the slingshot itself are things that I use inside my hedge fund. So this is kind of a unique opportunity to get some insight into the operations of a hedge fund manager. I'm also the founder and creator of the Trade Trend Signal software, which we'll be looking at on our session today as well. So we're going to really be focusing on number one, forecasting markets. So we want to obviously have some tools and strategies at our disposal that allow us to not just accurately forecast market direction and buy low and sell high, but to do it consistently, and also to remove the guesswork from our trading decisions. And so we're gonna use a few different tools there. One thing we're gonna look at is volatility. We'll kind of talk a little bit about implied volatility, but it's really one of the only forward-looking indicators that we have. And we're also going to dive into the slingshot, okay, using a very simple, basic indicator that's available to everybody. You can find it right on the MetaStock platform. And amazingly, when you apply this setup to the major indexes, so the S&P, the NASDAQ, the Russell, and you go all the way back to the dawn of the stock market, not only does it tell you where markets are likely to sell off, it can also help us navigate market rebounds, but it's incredibly, it plays out this way 100% of the time. It's never failed, okay, going all the way back to the dawn of the stock market. So it'll warn us of potential market sell-offs, which is obviously worth its weight in gold, right? That's something that we all fear, right? Especially when, like now, when markets are all-time highs. And we're going to accomplish this with volatility bands. So once these bands of the market can't be stretched any further, they have to bounce back. Okay, it's what drives market, not just volatility, but directional trends. Okay, so without this, behavior, we wouldn't have, fluctuations in prices. I call it a rubber band effect. So it helps make it possible to accurately identify tops and bottoms in the market. Now we're not going to, pick an exact top or bottom, but we can get remarkably close. And so this is what it looks like. I just have a past chart of the S&P 500 pulled up, the SPX. It's a daily chart. And this is from back in early 2020 when we had the COVID crash. So I just want you to kind of visualize a couple things here, and then we'll dive a little bit deeper and apply the indicators. So it's very common for the retail trading crowd to buy into markets near all-time highs, right? There's FOMO mentality, fear of missing out on, additional upside moves in the market, but there's also a fear and uncertainty of, is this the new high, and we're gonna, correct or crash or whatever. And so this is often where, again, the retail trading crowd buys into the market, but it's also where markets tend to be very vulnerable, where there's more downside risk than upside potential. And again, as we apply the indicators here momentarily, you'll see how you could actually navigate this very well. You can implement hedges, protect, your retirement accounts, your 401k, your IRA, your long positions. You can initiate speculative bearish positions. So obviously we know what happened back in early 2020. S&Ps were down to the magnitude of somewhere like 35% in just a few short weeks. And that created a lot of opportunity, though, for those who knew how to navigate this. So there was a lot of panic selling, right? But it created opportunity where buyers came in. And so when the bulk of the retail trading crowd is panic selling, right, we're going to know how to come in and buy in these opportunities. Okay, and interestingly, markets return right back up to that initial level where they sold off in a rather short period of time. Okay, so you're going to discover why volatility is one of the only leading indicators of market direction. We'll look at how to identify when markets may be vulnerable to a sell-off. Okay, and this alone can completely turn your trading around, because again, it helps mitigate that fear component in our trading decisions. We'll look at how to identify when the market is likely to go up, how far the market is likely to go up. Okay, this helps kind of solve that trader's dilemma. If you get into a successful directional position, there's always that question mark: how long, how much further is the market going to run? Should I take profits here, or should I, scale out of a portion of the position and leave the other portion open for a runner? All these questions come into play. We're going to answer a lot of those on our session. So I'll also show you how to get your hands on a tool that can change your trading forever, and that's a bold claim. But this is something that I've developed and used that has allowed me to be very successful in the markets and has really changed my trading forever. And I get a lot of enjoyment out of sharing this with others and watching it transform their trading. So we'll get into the slingshot a little bit, but again, I'm not going to go through the whole. Normally I have a very long slide deck where I go through a lot of the more nuanced components of this, but I'd rather do more out of the charts. So we're going to get over to charts in a second, but I want you to understand why I refer to it as a slingshot. Because as you pull a slingshot back, right, the muscle energy is transferred to elastic energy in the bands of the slingshot. And then after you release that slingshot, the elastic energy is transferred to the stone as energy of motion. So it's referred to in physics as kinetic energy, right? And kinetic energy kind of plays out in the financial markets in the form of supply and demand. So when you have excess demand, right, you get buying pressure. The market catches a bid and then it goes up. So once these bands become overstretched, it's going to give us a buy signal, and we can enter the market with high confidence that prices will go up to the initial resting point of the band. Okay, and we're going to accomplish this using a common indicator called the Bollinger Bands. Okay, so I'll kind of walk through what these are, and then we'll hop over to the charts. So they consist of 3 lines, and the outer bands, which are standard deviation settings, and I'll explain what that means, give us a good indication of volatility. Okay, and volatility, as I mentioned, is, in particular, implied volatility, is a forward-looking indicator. Okay, but what these volatility bands will tell us is when prices move too far from the mean or the average and is likely to reverse direction. Okay, so again, this indicator is available right out of the MetaStock platform. Okay, and then we're going to add another indicator into this to really make it powerful. Okay, but this is what the slingshot looks like. So for now, I just want you to visualize this, right? You get a breach of the lower band, a simultaneous divergence of the outer bands. At that point in time, there's a very high likelihood of some degree of a sell-off, which, as we talked about, right? Markets are supply and demand. This is where the kinetic energy shifts. And there's a buy signal, and price returns right back up to that initial volatility expansion level, where price breached that lower band and the outer bands diverge. Okay, so I'll just give you a quick high-level overview of the Bollinger Bands in case any of you are not familiar with them. And obviously, you don't need to calculate any of this. This is for purposes of understanding. But again, they consist of 3 lines. So we simply take a simple moving average, or SMA, of the securities price. That's going to be the center line that you see on the chart there. And then we take a standard deviation of the securities price. Now, that's just a mathematical measurement of average variance, but this is where volatility comes in, okay? Because it measures how spread out numbers are from an average value. And again, we won't go into the calculations because we don't need to calculate it. But what you want to understand is that because standard deviation is a measure of volatility, when the market becomes more volatile, the bands widen. And when the market's less volatile, the bands contract. Okay, so that's important. Now, in terms of settings, like most indicators, right, there are user inputs, so you can manipulate the settings. In the MetaStock platform, and in most, they will default to a 20-period SMA or simple moving average and a 2 standard deviation setting for those outer bands. Okay, so that simply means that the price level where those outer bands, and sometimes I'll refer to them as upper or lower band, reside is 2 standard deviations away from the 20-period mean. Okay, that's all that means. And we're gonna keep these settings. We're not going to manipulate them for asset or time frame. Okay, we're going to use them universally across time frames, across assets. All right, so we're going to use the Bollinger Bands to help us make more informed, accurate, consistent trading decisions and buy low and sell high. Now, this indicator has been around for many, many decades. It was developed, it's funny to think the 19th, like when I tell people, like, when were you born? I was born in the 19th century. Makes me sound old, but like the mid 19th century, I think, is when John Bollinger, introduced these. And, every indicator developer kind of has their own purpose for developing the indicator and how it should be used. But like any indicator, there's a multitude of ways, to use these. The slingshot's a unique way. And it's essentially where price exceeds one of the bands, the upper or lower band, or hugs that band, right? In other words, trails the band for prolonged periods during a strong trend. So what we're going to do is wait for that lower band to break, and I'll explain what that means, and then wait for a buy signal. And then we exit when price returns to the breaking point. Okay, and we'll visualize this all on a chart. But as we kind of unravel all this and you start to discover how this works, apply this to one of your charts and go back and look, and you'll see it occurs with astounding accuracy and predictability. So, throw it on a chart of the SPY or the SPX or the NASDAQ, okay? And you'll see that the major market indices have returned to their initial volatility breakout with 100% accuracy. So if you go all the way back to the donut stock market, so that includes the bear market of 2022, flash crash of 2015, flash crash of 2010, the crash following the 2008 mortgage crisis, the 2000 .com bubble, the Corona crash, every black swan event, market correction, major crash, bear market, you name it, this plays out. So this is what it looks like, okay? And I want to point a few things out here, and then we'll get over to the chart. So on the MetaStock platform. So on the left edge of this chart, this is the same chart we just looked at of the S&Ps, the SPX. It's a daily chart. we have the Bollinger Bands plotted. And if you look at the left edge, okay, so this is back in early mid-February, you notice that the outer bands, okay, are relatively narrow, so they're relatively close together. They're parallel, they're horizontal. And then if we reference the price to the Bollinger Bands, what do we see? Well, they had recently rotated off that lower band and then came up and touched the upper band. Now, I'll get into this again when we get over into the charts on MetaStock, but typically when you have narrow parallel bands, you'll see price bounce off, right, the upper and lower band. Okay, and so that's kind of more of a rangy market environment where you get consolidation and not much directional movement. Now, here's where it gets interesting. So notice how price, so the S&Ps start to sell off. And then that first candle you see there that touches the lower band, right? It kind of intraday, that particular day, stalls out and then rotates a little bit up off the session lows. So it kind of served as dynamic support. And I used these bands as dynamic support and resistance. And then you'll notice on the next day, okay, we get range expansion, so a wider high-low range on the daily session. And then we get a breach of that lower band. And the other critical thing, so that's kind of the first thing you should take note of, okay? Price is breaching that lower band, but there's one other thing that has to occur simultaneously, and that is a divergence of the outer bands. So notice how when price breaches that lower band, so the candlestick, breaches the lower Bollinger Band, the outer bands diverge, and they were previously parallel. Okay, this is where the slingshot starts to get pulled back. And this is the indication that there's a high probability of a sell-off in the asset. Okay, we obviously know that occurred here. Okay, S&Ps were down over 30% in just a few weeks. And you always want to put things in context, right? So this was back in early 2020 during the COVID crash. Okay, the pandemic was still in its infancy. There was, at this point in time, global economy shutting down, quarantining. We didn't have any viable treatment options, vaccines, etc. However, the markets recovered, right, in the second half of March, April, May, June, and by June they were back up right to that initial level where the sell-off ensued. Okay, so the market doesn't follow exactly what's going on in terms of the catalyst. All right, but I do want to point something out here. If you look at so here's where price returns back up to that level, and interestingly, you notice that over the next week or so, there's a little bit of a pullback, a mean reversion of the 20-day average. So that's no accident. This is very common to see with the slingshot setup. Okay, this is probably profit taking because of course we know that the S&Ps went on to rally back to the upside, right? Okay, so we're going to dive deeper into that here in just a second, but just kind of visualize this. But this is where we could look at taking profits. Okay. So we'll look at a few other charts and then we'll get over into the MetaStock platform. And we're going to throw in another indicator here. So we're just going to use two simple indicators. This is an example on an individual stock on Apple. So this is a past chart of Apple. And you'll notice that on the left half of the chart, Apple's in a strong uptrend. Okay, it's trailing the upper band. Okay, and then it rotates lower. And for any of you who are candlestick analysis traders, right? These are two consecutive bullish reversal candlesticks right off that lower band. But they didn't on that first one, right? And notice the incredible dynamic support that prices perfectly kissed that lower band and then reversed up intraday, closed higher. Okay, but then on the following day, we get a breach and we get a simultaneous divergence of the outer bands. So previously they were essentially parallel. Okay. And this is, again, where the slingshot starts to get pulled back. All right. We get the sell-off. Apple rotates down into a key level of support, attracts buyers who come in and drive price right back up to that initial level. And once again, notice how price kind of stalls out here and consolidates for about a week before it then resumes its upside move. And so this is an extension of the slingshot that I typically don't cover on the session just due to time constraints, but we are going to talk more about this when we get over to into the MetaStock charts. Okay, so we'll come back to that. Just another couple quick examples. This is a past chart of the Qs. Once again, notice on the left edge of the chart, okay, price is range bound. Okay, the Qs are range bound. The Bollinger Bands are parallel, horizontal, relatively narrow. Price breaches that lower band, and then simultaneously the outer bands diverge. Okay, there's the sell-off, which attracts buyers. There's demand, there's the kinetic energy, drives price back up right to that initial volatility expansion level. This also can be applied on intraday time frames. So if you're day trading, okay, the same principles, same rules apply. This is an intraday chart of AMD Advanced Micro Devices. It's a 5-minute chart. Okay, notice how it was range bound there for a period of time, a couple hours. Okay, the bands are relatively narrow and horizontal. We get a breach. We get, in fact, there were a couple embedded slingshots in here, but we get the sell-off. Attracts buyers. We get the rebound. Price returns right back up to that level. So again, this is where you can look at taking profits. Okay, so it's relatively simple to identify when the market's vulnerable to a sell-off, right? You get a breach of that lower band. You get the divergence of the outer bands. That's your first indicator that the market, you know, whatever asset you're charting is vulnerable to a sell-off. The trickier part is identifying the buy zone. Okay, so when do we get in on the long side? When is the band overextended and ready to snap back? And I spent well over a decade, thousands of hours trying to determine when momentum shifting in a new trend is starting. And I ultimately developed an algorithm, which number one, I had to configure to work on across multiple time frames because I do a lot of my trading off higher time frame charts like daily, weekly, even monthly charts. But I also do some intraday trading as well, right? So it had to be adaptable. I wanted it to be forward-looking. I wanted it to give me some degree of advanced notice of the forecasted directional move. Okay, and I wanted to be able to apply it to other, I don't use many indicators. There's really only a handful that I have found are effective and that I use. And one of those are the Bollinger Bands. So I wanted to give me good signals in relation to the Bollinger Bands, up to 3 candles in advance of a forecasted move. So that means, you know, if you're trading off a daily chart, you can have up to 3 days of advance notice of a forecasted trend direction. Okay. And it's really incredible when you formulate the right combination of momentum studies, volatility studies, and price action, you can actually accurately identify buy and sell signals near the outer bands. And this is what we've developed into the trade trend indicator. And so we launched this with MetaStock. I think it was back, Jeff would give you a know better, but I think it was like back in you know, 2019 maybe. And so we developed this in partnership, and it's just been wildly successful and popular. It really stands out from a lot of the other indicators that you'll find out there. Because number one, again, it gives you accurate buy and sell signals up to 3 candles in advance of a forecasted trend. It does all of this in real time. And so the algorithm's constantly reading the market. It has a trailing stop component to the algorithm that also reads the market in real time and gauges, trend strength, momentum, and volatility to help lock in profits on successful trades and help us predict short and long-term trends with astounding accuracy. And again, it can be applied to any asset class: equities, ETFs, futures, Forex. It also includes a scanner, so you can scan for forecasted buy and sell signals, the click of a mouse. You can apply it to any time frame. I love using this indicator alongside my option strategies, especially directional option strategies, which are very time critical. So I love using trade trend to supercharge my option strategies. This indicator does not repaint. So what that means is once you get a signal, it's set in stone, it's confirmed, and it won't change on you after the fact. Okay, it has built-in protection to avoid whipsaws. It helps capture a lot of the trend before it reverses. It's designed to limit losses and let profits run. It can be used with any other indicator system for added confirmation. And again, today in our session, we're going to be using it alongside the Bollinger Bands and help us remove the guesswork from our trading. Okay. There's also one other thing I want to point out before we get, and then we'll get over into the MetaStock platform that's incorporated into the indicator. And that is a specific order type that helps us confirm momentum and trend direction. And it can actually help drastically reduce your losing trades. And that is a buy stop or sell stop order. Okay, so the bulk of retail orders are going to be limit or market orders, and those might be appropriate for certain circumstances. But if you're taking a directional trade, wouldn't it make more sense to use a buy stop or sell stop? I'll explain what that means, and we'll look at it on the chart. But if you're looking to go long the security, okay, if you think that, ABC stock is going up, you could just fire off a market or a limit order, right? And you're basically getting in at the current market price or maybe slightly lower. But then what happens if you're wrong and there's no follow through? Okay, then you're in a losing trade off the bat. Whereas if you use a buy stop order, so you place that order just slightly above the current market price or above a, for instance, daily session high, okay, you have to have follow through to get filled on the order and get into a long trade. And the majority of the time, you're going to be in a winning trade off the bat rather than a losing trade if you're wrong and you get in with a market or limit order. Okay, and then for a short position, it's just the opposite, right? You just use a sell stop order. Okay, and that can really help improve our consistency and increase profitability. So let's get over into the MetaStock platform and kind of take a look at this. So I mentioned that the trade trend indicator comes with a scanner. Okay, so if you pull up the Power Console and then go to the Explore tab, it's going to allow you to scan, and you're going to find 4 different scan functions. Okay, so you'll see trade trend long setups, trade trend long signals, trade trend short setups, trade trend short signals. Okay, so the setup is the warning. Okay, and that's going to correspond to either a red or green diamond. Okay, and then we'll look at a chart. You can kind of actually see one down here. A green or long setup is going to be a green diamond. Short setup is going to be a red diamond, and then the signal is the trigger. So just remember, the diamond is the forecast, the warning. That's our advanced notice, and then the arrow is going to be the confirmed entry. So this one had a confirmed entry. Okay, and there's the red down arrow. Okay, so not every forecast will result in a confirmed entry, but these signals are good for up to 3 candles. So we're going to look at both daily and intraday charts. But if you're on a daily chart, you have up to 3 days of advanced notice. Okay, so this is the Power Console, and then you can run your scans. Okay, you can essentially scan in any market you want. I create some custom watch lists. You can scan the entire market, but really cool. You can just run a scan and you're going to get all of your forecasted buy and sell signals. Okay, then you've got your charting, right? So this is where we can start looking at some charts. You got your trade trend indicator there, and I've got some charts pulled up. So we'll kind of look at this. and I have the Bollinger Bands plotted as well. And again, just a standard default setting on these. So we have our time period, which is our center band at 20. Okay, so it's a 20 period average. And again, on a daily chart, we're looking at a 20-day average. And then the setting for the outer bands is 2 standard deviations. Okay, so that's it. And so you won't need to change these. These are already defaulted to the correct settings in the MetaStock platform. Okay, so let's kind of talk about this. What I want you to kind of, as we're walking through this, kind of notice is the slingshot. Okay, so this was from back in February of this year. Okay, we're looking at a chart of the SPY, by the way, daily chart of the SPY. All right, so back here, okay, on February 19th, markets put in a new all-time high. And notice how they tested the upper band. You can see in this particular session, right, perfectly touched that upper band. Okay, so whether this is a self-fulfilling prophecy or, the market participants are actually paying attention to this, it's no accident. Okay, and in either case, and this happens very frequently, but this is dynamic resistance. So we look at the upper band as dynamic resistance, and the lower band is dynamic support. And so once there's a significant breach of dynamic support or resistance, and you get the simultaneous divergence of the outer bands, that's where you tend to get sustained directional trends and strong directional momentum. Okay, so again, price is kind of testing dynamic resistance over the course of a couple sessions. Then on February 19th, we have new all-time highs and closing highs, okay? And then we put in a lower high on the next session and a lower low. Okay, and then trade trend gives us a sell signal. Now we haven't tested or breached the lower band yet. Okay, but notice how previously we had band convergence. Okay, that's critical for the slingshot. You want the prior occurrence to be either convergence of the outer bands or parallel bands. Okay, and narrow. So see how they converge, they get kind of narrow, they're parallel. Trade trend actually gave us a few days of advanced warning before we got a breach of the lower band. Okay, but there's the breach, and then notice how the outer bands simultaneously diverge. So this is the beginning of the slingshot, and now we have a high probability of a sell-off. Okay, so there's the sell-off. Now, as I mentioned, not every warning will follow through, and this is why we use buy stop and sell stop order. So here was actually a buy signal, and you can see the markets in this session kind of started to catch a bid. Okay, but there was no follow through, and the sell-off resumed until eventually they caught a little bit more of a bid. We got another buy signal here. This one actually triggered 2 days later. Okay, and we got a mean reversion back to the 20-day average, and then we get a resumption of the sell-off. And there was another slingshot. Okay, notice the band convergence, divergence, right? And then another sell-off. Okay, and again, trade trend actually gave us about 4 days of advanced warning before the breach with the band divergence. So this is also something I want to point out. Here was a breach. So you can see the market actually opened right at a 2 standard deviation level, right at that lower band, but it, in terms of the session low, breached that lower band. Now, why wasn't this a slingshot? Because the outer bands weren't diverging, they were converging. That's more likely to result in a bounce off the band, in a reversion to the mean, in this case, the 20-day average. Okay, you can see it almost perfectly tested it there. It closed right near the 20-day average, and then we gapped down the next day. Okay, so this is kind of how the symbology works, but not every signal will result in a triggered trade. So if you don't see the arrow following it, then that means it didn't reach the suggested entry price. And in this case, that would have been up above the session high by that point in time. And so what's really cool, I'll pull this up here real quick for you, is MetaStock comes with expert commentary. Okay, this spells it all out for you. It's gonna, so like if I go to this buy signal from March 17th, okay, I'm gonna click on that. The commentary is gonna show all the instructions. So on March 17th, okay, it tells us that trade trend projects a move up and the criteria for a buy setup has occurred. Okay, this is just our warning. It doesn't mean to go ahead and jump in on the long side. You can see in the next session, we actually look like we were gonna sell off. We put in a lower high and a lower low the next day. No follow through. Now, Trade Trend told us the suggested entry price using a buy stop limit order. So 569.81, that's gonna be just above the high of the day the forecast was made. And you can see 2 days later, it triggered. Okay, we got the mean reversion. Okay, and then we get a sell-off. So like if I click on this day, okay, March 28th. Okay, Trade Trend no longer suggests any long positions. It's now projected to move down, and the criteria for a sell setup has occurred. Okay. And once again, there's the slingshot. So this is all built into the expert commentary. Once you get a filled trade, it's also going to give you trailing stop levels. And again, depending on how you're trading the signals, you may want to use those or maybe not. That's totally up at your discretion. I do a lot of options trading, so I will just if I were to do, let's say, a bear put debit spread here, right? I won't be using the trailing stop component of the algorithm. All right, so that's all in the expert commentary. Okay, let's look at some other charts. I have one pulled up on Intel, which just recently, yesterday, just gapped way higher on some news there for Intel. This is a reverse slingshot. Okay, but let's look at kind of some past signals. So here was a sell signal. Okay, this one triggered. This one didn't go too far. You probably could have made a nice, just a small little profit on that one. It ultimately did. Again, if you're using the trailing stop component, you could probably pick up a little small profit there. If you hold on longer until you get a buy signal, you would have had a really nice profit. But there's a slingshot, right? Breach of the lower band, divergence of the outer bands, prior convergence. Okay, there's a nice slingshot. And here's the rebound. Okay, so there's our buy signal. Okay, this one gave us 3 days of advance notice. So the suggested entry price would have been up here. We can actually pull up the expert commentary again. Just get over here and we'll click on this day. Okay, so that was August 6th. Oops. Back. There we go. Okay. All right, so it let us know that the criteria for a buy setup occurred. Okay, it gave us our suggested entry price at 20.50. Use a buy stop limit order. And this was a beautiful slingshot setup. Now, I mentioned the extension of the slingshot, and this one actually played out as an extension. So what you'll look for when you get a slingshot is initially for price to return back up. Now this was kind of a unique situation because we got a gap down below the lower Bollinger Band. Generally, if there's no gap, right, the breach would have occurred here. There was the band divergence. But you want to look for price. So normally we would target a rebound right up into roughly that level. But here with the gap down, right, we don't have any price action in this price zone there. So we may want to, you know, look at this level if we were to go long down at lower prices. But here's the slingshot extension. When price then exceeds that initial sell-off level, it often goes on to make significant upside moves. And we see that here. So at the very minimum, it will, a high percentage of the time, go up and retest the upper band. Okay, so there's our dynamic resistance. Here we got a sell signal, no follow through. So you can see there's no red arrow. Okay, but the algorithm is picking up some weakness in momentum and trend direction. Entry would have been down below the low of that candle, no follow through within the next 3 days. Okay, so this is a null signal that no trade would have been placed here. So see the power of using that buy and sell stop order? It actually kept us out had we used like a market or limit order and just jumped in, right, of what would have been a losing trade. So no trade. Okay, then price just kind of goes sideways for a while. We don't have a buy or a sell signal. Okay, and again, if you reference the expert commentary, it's going to tell you that each day. So you know there's nothing to do, right? Trade trend doesn't suggest any long or short positions. Okay, until September 10th. Okay, it gave us, and the trend didn't even take off yet. It actually, for the next 4 or 5 days, it kind of started taking off on, you know, maybe the 16th. Maybe it's kind of on the, there's kind of a false resistance breakout here on the 15th, but then kind of started to take off. But it gave us some really nice advanced notice. But this one actually triggered the next day on September 11th. You can see there's the confirmed entry. So if I click on that, the commentary will confirm that. Okay, the suggested long entry trigger price was reached, initiating a long position. Okay, and there's a beautiful, beautiful up move. What chart is this? This is the triple leveraged Qs. Okay, I'll point out, so this is a reverse slingshot. I wanted to also cover the, well, actually, first, here's another example. So here was a really brief mini slingshot, but it qualifies, right? You had prior band convergence. Okay, you had a breach of the lower band, simultaneous outer band divergence. This one didn't persist for very long. We already actually had an open sell signal back here that triggered. So that was a nice, would have been a nice short trade. And then there's the buy signal. This is a buy signal right off a slingshot extension, okay? Because on the forecast day, we closed above the vol expansion level, okay, where the initial slingshot occurred. Okay, that would have been, you know, if we had gone long down here, this would have been our profit target level. Okay, and then, so this was a beautiful signal. Okay, there's the buy warning, there's the confirmed entry, and this one takes off to the upside, ultimately tests the band, got a sell signal with no follow through, so that's a null signal, got a mean reversion to the 20-day average, then we got another buy signal. So this one I want to take a look at because this is a reverse slingshot. So instead of breaching and trailing the lower band, we breach and trail the upper band, but it still qualifies because we had prior band convergence followed by band divergence simultaneous with the breach. And then we get a nice trade trend buy signal. So these can be traded as well. It's just the opposite of trading the sell signal. Okay, here we trail the upper band. Okay, we get another sell signal that doesn't follow through. So remember the diamonds are good for the next 3 candles. So entry would have been right here. But price wanted to push higher a little bit for the next 4 sessions or so. So at this point in time, the signal is now null and void, right? No follow through into the suggested entry price over the next 3 days. And then we get another sell signal. This one did trigger. And looks pretty nice. Let's see, let's look at Tesla. Here's another, so this is a daily chart of Tesla, and then we'll look at one other, and then we'll look at a couple intraday charts. And then I'm gonna let you know in just a minute how you can get this indicator. Here is another reverse slingshot. Okay, so we got a couple buy signals. That one did not follow through in the next 2 days. Then we get a subsequent buy signal. This one did follow through. This was a reverse slingshot, breach of the upper band. There's our triggered entry. Beautiful up move there. Oops, let's close that. Okay, this one is on gold. So gold was kind of range bound. We got a nice little sell signal there. And then this is another method I like to use with the trade trend indicator. We talked about taking signals off of the upper and lower bands. I try to avoid signals like in between the middle and upper bands. I like to take them off the upper band or off the lower band or off the 20 period mean. So here was a great one. So this is forecasted buy from back on August 22nd, right off the 20-day average. Okay, this one did not trigger on the 25th. Okay, so this came in on a Friday, Monday, no trigger. This one, you can see we got a confirmed entry on Tuesday of that week. So bands were previously horizontal, breach of the upper band, simultaneous divergence. This is a reverse slingshot. Okay. We get a sell signal. This one triggered. This would have been good for a nice, really nice intraday trade. Okay, then we get a bit of a resumption of the uptrend. This is kind of a no man's land sell signal, but we did get a trigger here. Okay, intraday charts. Right, so this is the a triple leverage S&P ETF, so SPXL is the ticker. This is just a 1 minute chart. Okay, so this is looking at today's price action. You can see there's some slingshots here today on the 1 minute chart. There's one, there's a sell signal, there's a slingshot. There is our buy signal. There is the trigger. Okay, there's another sell signal. Buy didn't follow through. That was a null and void. That was a null and void. That was a null and void. There's another sell. Okay, so you can apply this to intraday timeframes as well. This is Newmont on a, what is this, a 1 hour chart. Okay, some nice signals here. Sell signal, okay, following a, this is following a bounce off the upper band dynamic resistance. So these are good signals. Okay, this one caught it far before the slingshot, but there's the slingshot, breach of the lower band, divergence of the outers. There's our buy signal. There's our trigger 2 hours later. Beautiful move. Some really nice buy signals along the way here. Looks like on Newmont, had a nice one here off the lower band. So here's what I was referring to. We had breaches of the lower band, but notice no divergence of the outer band. The lower band started to diverge, the upper did not. This is not a bearish slingshot. We should not expect the market to continue lower. Okay, we should expect a bounce off the lower band. So this was a fantastic buy signal. Triggered 2 hours later, so we got 2 hours of advance notice. And then we get a reverse slingshot. This qualifies because we have breach of the upper band, divergence of the outer bands. Beautiful trade, but we got him way before. Okay, you could have traded this up here and made a lot of money too, but we got him way before there. So that's the trade trend indicator, and that's how you can use it alongside other indicators like the Bollinger Bands to make more accurate and informed trading decisions. Guys, I use this myself. I do trade for a living. As I mentioned, I run a hedge fund. This is my personal, it was TD Ameritrade at the time, of course, has been since acquired by Schwab, brokerage statement from back in a horrible market period, February, March of 2020. Okay, what did I do here? I just used the trade trend indicator in the Bollinger Bands and I spotted the slingshot. I was being relatively conservative. Okay, I put on some small short positions. I was mostly in cash, but this is just from the last week of February. I traded that slingshot on the way down. In that last week of February, did over 13,000 in profit. Then I created the rebound in March. Again, just using what I've taught you today, the slingshot and the trade trend buy signal. I was still conservative with my position sizing. You can see I was putting on 1, 2, 3 contracts. Okay, but I started to put on more positions. End of March, over $27,000 of profit, just using these two things. Okay. Okay, and one of the worst, we've now, I think, probably seen an even worse one with the sell-off this year, the tariff tantrum. Okay, but in recent history, like one of the worst market sell-offs, right? This is what's possible. So you can apply this to any market, any time frame. You can do this with any size account, right? You determine your position sizing, your risk tolerance, but you're going to get buy and sell signals designed to give you a forecast or warning before the move occurs, up to 3 candles in advance. Okay, and once you get this indicator, I'll let you know how you can get it here in just a couple minutes. You'll find, to apply it to your chart, it's forecasted every market crash and rebound in the history of the market. So go back to every black swan event, every market crash, every bear market. You're going to see the trade trend sell signal there. When the market rebounds, you're going to see the trade trend buy signal. Here's some examples. This is the flash crash of 2015. There they are. This is the 08 mortgage crisis. There's the sell warning before markets lost over half their value. 2000 .com bubble. There's your sell warning. Notice how it also gives us the buys right before the market rebounds. 2022 bear market. Okay, literally one day after markets put on a new all-time high. Everyone's celebrating the market, new all-time highs. Not me. I was getting ready for a sell-off. 2025 tariff crash. Okay, once again, everyone's celebrating new market highs. I was getting ready for the sell-off. Okay, and if we put the Bollinger Bands on here, we have the slingshot. Okay, we actually got 3 nice sell signals on the way down. You guys can see the slingshot there now, right? Okay, we got that buy signal. I traded this a number of ways. One, I traded the micro S&P futures. Okay, over 40,500 in profit just on that one ticker, just with trade trend in the Bollinger Bands. So I can't guarantee you're going to replicate this, but I can guarantee that this is exactly how I accomplished that, and I'm going to give you the tool to do that. Okay, so virtually every system will produce winning trades if you can stick with it long enough, but the problem is they don't keep you out of the market when conditions are not favorable, right? And you end up giving back your profits on the losing trades. So we're here to change that for you today. Okay, and again, this is just more real world, real money proof. Okay, this is, I do a lot of futures trading. Okay, this is right out of my Thinkorswim account. Okay, just using the trade trend indicator. So yeah, I have losing trades. You can see them on there, right? They're relatively contained compared to my winning trades. Okay, the trade trend indicator helped me do that. It helped me contain my losses and let my profits run. This is again, real world, real money example, right out of my Thinkorswim account using trade trend with the slingshot. Okay, so I just did this in 3 futures markets, over 26 grand in a day with over 115 grand in open P&L. So guys, I'm gonna make a promise to you now. I wanna help you have days like these, and I'm gonna give you access to the exact indicator I've used to achieve results like I've shared with you guys today, okay? So there's a one-time opportunity to join me to discover how I make consistent income in the markets day after day, week after week, okay? I reveal everything, okay? You're gonna get the exact indicator that I'm using, okay? I don't hold anything back. I don't give you a redacted version. Okay, you're gonna get 12 months of trade trend on MetaStock. You can apply it to any asset class. You get exact entry and exit signals. You're also gonna get weekly live interactive strategy sessions with me. Okay, I host those every Tuesday at 7 Eastern. If you're not able to attend, you get access to members area, full support and coaching from me. Okay, we throw in a whole bunch of education and ultimately help you cut the learning curve. Okay, so here's the package. You get the subscription to Trade Trend on MetaStock. You get our weekly live strategy sessions. I'm there with you every week to help coach you. You get access to our invitation-only Facebook group. You get extra training on trade management, trade adjustments, and you're gonna get a couple powerful bonuses. As you're getting up and running with the indicator, you're gonna get my top 2 weekly trade trend picks, and my latest ebook, How to Create Risk-Free Trades. So the total value on the package is over $5 grand. We're knocking 80% off for the MetaStock Summit. You can literally get this entire package for an incredible steal at $997. This is limited to 25 seats, so if you want to take advantage, you can go to altostrading.com/MetaStock. And Jeff will also tell you how you can purchase this through them as well. So you have a couple options to do that. Either way, you'll get the full package, everything that you see here on your screen. So I ran right up to time. I was hoping to save a little time for Q&A. Jeff, if there are any I could answer quickly, I'd be happy to do so, but I'll want to be respectful of the next speaker, so I'll pass it back to you. But I want to thank all of you for attending today. I hope you got a lot out of it, and looking forward to working with you and hearing your success stories from the Trade Trend Indicator. So once again, altostrading.com/MetaStock. Jeff, I'll pass it back over.
Jeff, I cannot hear you. Are you talking?
Hello.
Well, there's Dave.
Yeah.
Hello, Dave.
Hey, Dave. We'll be right with you.
Are you having an issue, Jeff? Do I need to?
No. Can you hear me?
I can hear you, but I cannot see you. I can see Dave and I can hear Jeff. It's a little unsettling, if I'm honest.
Yeah.
Okay, now I can see you and hear you, but no longer see Dave.
Well, we're not quite ready for Dave, but we'll have him here in a minute. Jeff, thank you very much.
Thank you. Great to be here as always.
All right. Good to have you. Brad had a question about like when you get an exit signal, do you exit your whole position the whole time? Or he said his comment was sometimes it ran quite a bit after the presentation.
Oh, yeah. So
and the exit actually, it continued to run up. So
yeah, so that's the trailing stop component of the algorithm. And so as I mentioned, that's kind of up to the user discretion if you want to use that. You will find a lot of those, will reverse near that exit. But yeah, I will typically, it's seldom that I get out of an entire position all at once. So I'll typically scale out, take profits on half the position, move my stop up to my entry price to break even, and then I'll leave the second half of the position open for the runner, right? So if you get those extended moves, because you're exactly right. A lot of those will go on to make more significant directional moves. So yeah, definitely.
Very cool. Thank you very much, Jeff. Appreciate it.
Thanks so much. Yeah, happy Friday, everybody, and thanks for having me.
All right. Just want to also add, if you want to get that package, you can give us a call, 800-882-3040. You can also go to metastock.com/salesphat. Big thank you again, Jeff. We'll see you again very soon. Okay. Let me go ahead and as we kind of move on to the next presenter, I want to say thank you again to Stocks and Commodities Magazine. You can find out more about them at traders.com. I'm also going to say thank you to the Traders Forum. If you haven't yet joined the Traders Forum at thetradersforum.com, we look forward to seeing you there. So, Greg, let's do a prize real quick. We're running just a minute or two late, but not a big deal. It certainly isn't any reason to not give away a prize.
There's never not a reason to give away a prize.
So we're going to give away John Seville's Smart Surge system.
Mm-hmm.
He talked quite a bit about this the other day when he talked about it. But it's a $997 value. This is lifetime access to the Smart Surge system. It includes a scanner, an expert advisor, works on, of course, MetaStock and a handful of other platforms. And we're going to give away a copy to the person who's lucky, the person that's random. So, Greg, I just need to get a number from you.
All right.
2 in 5,329.
Here you go from the Google random number generator. 3,547, 3547.
And that would be Richard B. Yeah. Go ahead and make a note of that. Very cool. Thank you very much, Greg. Appreciate it.
You are very welcome.
All right. Any of the offers we have today included the extended trial for MetaStock, where you buy a month and get the second or third month for free, or any of the other MetaStock add-ons that we've talked about over the week. You can get them at metastock.com/conf promo. You can get them at you can talk to us about them at metastock.com/sales chat, and you can also call us at 800-882-3040. So, without further ado, let me go ahead and bring Dave back on. I'm going to go ahead and turn on his microphone again, or not his webcam. And Dave, how are you doing today? All right, we can see you. I'm going to go ahead and also ask you to unmute yourself.
I was saying you're rocking the beard now. It looks great. I like it.
Yeah.
I have a goatee because I look like my mother, and my wife won't come near me unless I have because I look like her without the goatee. So
that's not why I have a beard.
all right. But you look good with it. So
go ahead and get the presenter real quick. All right. I have a beard mostly because I don't want to shave.
well, that's a good enough reason right there. All right, let me get
Every once in a while it gets a little too long and I had to go kind of trim it up, but there you go.
Gotcha.
I can see your screen.
All right, we should see. All right, should be seeing the slides now.
Right.
Okay.
I can see it. Sounds good. Looks good. I'm getting out of the way. It's your turn. Go.
Okay, fantastic. Thank you, Jeffrey. Thanks to MetaStock for having me back once again, and obviously thank everybody for being here. When I was writing my first book, which I'll give you some information in a little while on how to get that for free, Larry Connors had approached me and we were talking about it, and I was thinking, it's like, oh, I've got these great ideas, and there was kind of an awkward pause, and he said, why don't you just write about what you do? And I'm like, okay, okay, that's a good idea. And then when Jeffrey approached me to do another webinar for MetaStock, it's like I kind of go through that same process, like what gee whiz things can I show you? And then while I was thinking about it, he shoots me an email. He goes, do you want to do the same presentation from last time? And then I got to thinking about it, and nearly every position, and one's really close to a setup, in my open portfolio for my core trading service is this one setup. And so I'm like, you know what? Let me just show you what that is, and then mix in a little bit of trading psychology. And also, because of the title of this presentation, about will this rally stick or whatever, well, nobody knows, but I'm going to show you a setup and some tools to help you ride the trend down should that occur, or when that occurs, I should say. And everybody's a setup junkie, so I'm going to show you some setups and live setups, but there's really a lot more to trading. There's a lot of money management and trading psychology, so I'm just going to touch upon that, and I would encourage you to go a lot further with that. Obviously, thanks again to everybody, and thanks to all you, everybody here today. Am I out of focus, or I'm a little blurry? I look like Bigfoot. Maybe I don't want to be in focus. All right, that's a little better. There's a disclaimer screen. As you know, you can lose money trading, or as I often sum it up, all predictions are about the future, and a lot of stuff can happen between now and then. I stole that from Greg Morris. Okay, so there's a lot of stuff, and I tend to jam a lot in when I do a webinar, but this is not a one and done. So if you go to davelandry.com/slides, you can get the slides from this presentation. I'll give you all 3 of my books in PDF format, so you can get to know me a little bit before investing your hard-earned cash. There's all my contact information. Obviously, shoot a screenshot of that if you like. I do answer all my own emails. The email's not on here, but it's dave@davelandry.com. Now, when it comes to markets, the market's either an uptrend or a downtrend. And one thing that people forget about is sometimes markets just go sideways. So if you ever get confused, just look at the chart and ask yourself, is it going up, is it going down, or is it going sideways? And I'm going to give you some simple tools here in just one second. But probably the most powerful thing that you could use is just a net price change. Where's the price today? Where's it a week ago, a month ago, a year ago, and so on and so forth. Now, years ago, I think it was in 1995, I wrote, way back in the 1900s, I wrote an article for Stocks and Commodities, actually 96, January 96, I believe. And I talked about a simple system for trading Japanese yen. And it involved like a gap, so to speak, above the moving average in price. And somebody read the article and contacted me, and he called it daylight, and it became Dave Light, and now it's Landry Light. So in MetaStock, I think it's called daylight, but eventually when I get around to updating the plugin with Jeffrey, we're gonna probably change the name to Landry Light on that, or we will change the name. But anyway, lows are greater than the moving average for uptrends, and the highs or less than the moving average for downtrends. What's kind of shocking is sometimes I'll see a presentation and people will have 100 different buy and sell signals on a chart, and usually there's always the ubiquitous moving average plotted on there. And what amazes me is the Landry Light would have kept you in the entire trend that they're showing without all these buys and sells along the way. So I truly believe that simpler is better, and I do make sure everything I do is very, very simple. Now, if the price bar touches the moving average, then there's no Landry Light, okay? So it's not above or below the moving average, it's at the moving average. The price bar intersects it. If the low is greater than the moving average, then you add 1 for the count. If the high is less than the moving average, then you subtract 1 from the count. And remember, it's going to reset at 0. So this is what the MetaStock code looks like for that. You could obviously convert it to your own platform. I know a lot of people have put it onto other platforms out there. So if you're using something other than MetaStock, then I'm sure it's out there somewhere. Now, if you're going to count it, again, each bar that's above it counts as +1, okay? And each bar below it is -1. So in this particular case, you have 2 bars of Landry Light on the left, upside, 2 bars of downside, and then no Landry Light when the moving average intersects it. Now, by accident, when MetaStock first put this into the platform, they plotted it as a histogram on the default. And I was like, that's pretty cool. And if you take a look at like the S&P, this is spiders here, you can see that you have green when it's above the moving average and red when it's below. And it's kind of like a Tarzan speak type of thing. And it's like funny, when I was learning Italian, I never did fully learn it, believe me. Years ago, we were doing a lot of business in Italy, and they used to have these huge trading forums over there, whatever. And I was able to speak a little bit better than my wife, although she knew the Italian much better. She was a little more afraid to use it, whereas men in general tend to speak in the infinitive and sound like Tarzan, like good and bad and eat, hungry, and they'll just gotta blurt it out. So if you're looking at the Landry Light and it's flipping back from green to red, okay, that's choppy, okay? If you have a lot of highs below the moving average, that's obviously bad, okay? And then lately we've had a really, really good run where the lows have been mostly greater than the moving average, a couple little kisses of the moving average, but that's actually a pattern we're going to use to our advantage in a minute. So upside Landry Light is good. And sometimes I know I'm being silly here, but sometimes with markets, you really just need to say, is it going up, is it going down, or is it going sideways? And if you can't say those things, then you don't know which way it's going, right? But you can, okay? The reason you can't is because in your head, you're probably trying to justify why it should be going up or should be going down, as opposed to what it is doing, which is technical analysis. Linda Rasky once said that if you're not sure which way a market is headed, ask a 6-year-old kid. And I firmly believe in that. Now, as I said a second ago, we had a couple of kisses of the moving average. Now, the Landry Light, again, when you hit the moving average, it resets back to 0. So we had a couple of kisses on the chart. And those actually create a buying opportunity. And I'm going to show you a setup based on that. And that's the setup, the Landry Light pullbacks that almost every single setup, and one's just off by a hair in the open portfolio, which I'll show you in a few minutes, and I'll walk you through those trades. Now, I'm known for drawing the big blue arrows. I actually have them printed on my arm, but my jacket's below my jacket. I don't know if you'll be able to see them, but always look at a chart again. Is it going up, down, or sideways? And again, the net price movement. So if you look here on the chart, we're around 600, okay? And you go way back in time, back here a few months, and you're around 600. So draw your big blue arrow. And that was a spill we had earlier in the year. I guess that was a tariff tantrum, as I think Jeff mentioned earlier. I don't pay a whole lot of attention to news, but I know some crazy things were happening. And obviously, we've been in a pretty good uptrend ever since, with a couple of kisses of the moving average. Now, one thing you want to do is you want to always, of course, look at the charts. And I don't see indicators as indicators. If you had an indicator that actually indicated something, then you would own the world. I see an indicator more as an illustrator. It just shows you what's already in the chart. So you can see Bitcoin was trying to get into a little bit of an uptrend, was trying to break away from the moving average and break out. And then it sort of lost steam. But notice that the Landry-like count continued to go higher, even though the stock was coming back to the moving average. Remember that count on the bottom is just a count. It's not a measurement of distance away from the moving average. Maybe that type of analysis might be worthwhile, kind of that convergence or whatever, divergence and reversion to the mean. But for me, I just like to focus on the trend as opposed to reversion mean, et cetera. But the point is that even though that Landry-like count may still be going higher, the market could be pulling back to the moving average. It just means that it's still above the moving average. And by the way, in case I hadn't mentioned it, this is a 30 EMA, and that's quickly become one of my favorite EMAs. And I know you probably want to party with me. But anyway, over here, again, you can see that the count remains or continues higher, okay, because the lows are still greater than the moving average, even though it's pulling back to the moving average. So just use indicators sparingly. They can be great to help you find setups and help you to see what's already in the chart. But I always look at blank charts first. I look at upwards of about 2,000 charts every night when I'm doing my analysis, and probably a few hundred more during the day. And if, by the way, usually when I speak to in person to a live audience, I ask if there's any musicians in the audience, and usually there's a few, and I ask them how they got good, and they always said, or proficient, whatever. They look at me, you know, like a pooed my pants, and they're like, well, I practice, you know. It's like, okay, well, if you want to get better looking at charts, then look at some charts. If you want to learn technical analysis, then look at a lot of charts. And I would encourage you to use blank charts, which is maybe a moving average or two, like we're doing today. But most of my analysis is done on a completely blank chart, and then I might throw a moving average in after the fact. Now, the reason I'm harping so much on like Landry light is it does help you to recognize setups. It's way to, I don't want to say quantify, but sort of qualify a setup. And we'll take a look at that in just one second. But anyway, mostly green is good, obviously. And when it's alternating back and forth, you have a choppy market. And of course, look at the chart, okay? And you can see in this case, we had also a bit of a double top. So a little classical technical analysis kind of sprinkled in helps. And then we started having mostly red, okay? And then the market reversed, and then we started having some green, which is a good thing, obviously. Now, this is a more current chart. You can see that Bitcoin's beginning to trend again, okay? It's beginning to pull away from the moving average. We have how many bars of Landry light? About 9 bars of Landry light. So that's a good thing. But as I'm preaching here, you want to make sure you look at the chart, and you can see a couple things. We're a little sideways on that net price movement, which is important to pay attention to. And then also we have a little bit of overhead supply to deal with. Now, there's nothing that's mumbo jumbo about my form of technical analysis. You're just looking at the chart and you're trying to read the psychology of the players, and at the same time embracing your own psychology as it comes to trading. And we're going to get to that in a few minutes. But if you think about it, if anyone buys higher than you and the market drops, or let's just rewind that. Anyone who bought at levels higher than they are now and the market's below those levels, they're going to be looking to get out of break even. It's human nature. And I'm sort of a man on the street kind of guy, and I pay attention to what the guys are saying at the gym. And there was one guy who was talking about the Russell 2000. He's like, if it ever gets back to its old highs, I'm getting out. I'm like, you know, that's just the opposite of what you should be doing. You should be staying long and possibly actually adding on to it. But anyway. All right, let's take a look at the bow tie moving averages. And years ago, I learned that the relationship between these three moving averages was very interesting, and it's especially powerful. It's really good for helping you find trends, just like the Landry light is. But it's especially powerful when you come to a market transition. So it's like getting back to this series, or what is this conference? Okay, will this rally stick? For now, yeah, it looks great. But if we get a bow tie to the downside, then you might want to pay attention. I have one client. He actually does a lot of work on the hourly charts, and he plots the bow ties, and he'll point out when there's an hourly bow tie on the S&P 500 and other indices, and that's a precursor of bad things to come. Now, you do get more whipsaw as opposed to waiting for a daily or a weekly, as we'll look at in just 1 second. But he's usually first out of the market when things do get ugly. But anyway, they come together and spread out, and they look like a bow tie when they come together fairly quickly. Now, it's just these three moving averages, and then the exponential moving averages obviously are front weighted. I don't know the formula off the top of my head, but I think it's like 92% or something of the last bar is a big part of the calculation. So it's very front rated. The reason I use a simple moving average is it has a little bit of lag to it, and the way it interacts with the other moving averages, it works out pretty well. A lot of people will send me the charts and go, I'm not getting any bow ties. I don't understand. It's like the lines are all jagged. It's like, well, usually what happens when I look carefully is their 10 is an exponential and not a simple. But you don't have to worry about the math or any of this other stuff. Just learn to recognize the patterns. And again, look at the charts. So 10 is less than the 20, and 20 is less than the 30 in this particular case. Simple, exponential, exponential. So that's downtrend proper order, okay? Now, if the 10 is greater than the 20 and the 20 is greater than 30, that's uptrend proper order. Again, easy to scan for, and the expert advisor for this in MetaStock will show you when it's a trend or no trend based on the order, uptrend, downtrend, or sideways. So you can see here, it looks like this market was sort of starting to improve a little bit, but the 10 was greater than the 30, but the 30 was greater than the 20, so that's not proper order. So we take a look at the spiders. You can see going back to 2024, we had a nice uptrend, and then we had a sideways choppy type of movement. And you can see that the bow tie proper order, again, a histogram counting the number of days, was flipping back and forth. Now, one thing I noticed as I was putting the slides together is you do have, for instance, you have a buy signal here. The bow tie setup, which I'll show you in a few minutes, is designed for more of a transitional type of move off of like all-time highs in the overall market, or major lows, okay, like a 5-year low or a 10-year low, or at least a few years for your lows. So I wouldn't get too excited about a buy signal that's happening in a choppy sideways market or near the old highs. However, when you get a sell signal, it's very important to pay attention to that. And I'll give you the rules for that in just 1 second. Really simple stuff. But you can see red and green, once again, choppy sideways type of movement. And again, draw your arrows, okay? Now you can see that slide that we had earlier this year. It formed a bow tie. Now keep in mind, it's going to be a little lag in the moving averages. That's okay, because you don't want to be in and out like the rat going for cocaine, like, oh, I better get out of the market, and then the market goes straight back up. You do want a little lag in some of these indicators, so you're able to survive some corrections along the way. But if things begin to get ugly, you definitely want to get out of the way. I think in those slides, I have a mini market timing course where I have a system in there that I'll give you, the TFM 10% system, and it's a great little system, if I say so myself. Anyway, you can see lots and lots of downside, proper order, okay? And then notice the nice uptrend we've been in ever since May, okay? And you can argue, obviously it started in April, but you're going to have some lag, has been uptrend proper order that entire time. So very simple tool to help keep you on the right side of the market, and then we could put some setups within this. Now, here's a weekly SPY, and you can see that by paying attention to the proper order, you're going to be able to stay on the right side of the market, be it bullish or bearish, and then maybe you might want to kind of get out of the market if it gets a little sideways and choppy. But you can see going all the way back to the bear market of 2000, we had a weekly bow tie, and the market lost, I forget exactly how much, but since it was kind of a gradual rollover, in that case, especially 2007, I think was even more gradual, and the market went down for a long time, it was a very good signal, and it's a very good time, obviously, to be out of the market. But you could see just by paying attention to the reds and greens, and this is nerdy stuff, but every time I look at these charts like this, these longer term charts, you're really able to see the forest for the trees and like, okay, this is a major bull market, major bear market, and you can act accordingly. But again, green for your uptrends, and then red for the downtrends with the proper order. Now, I remember that 2015, 2016, we did have one to the downside, and the market really didn't come unglued, but we just kind of chopped and chopped and chopped and chopped around, and the market kind of ended mostly lower for the most part, and it was a horrible time to trade. And I think just keeping that in the back of your mind that we have a longer term sell signal could have kept you out of a lot of trouble during that time, and it was not a fun time to trade. But anyway, we had a nice rally out again, green, and then keep in mind, especially on a weekly chart, you're going to have lag, and sometimes you might have a V-shaped recovery, which is good if you're bullish, obviously, and bad if you're trading some sort of system based on this. But whipsaws happen, okay? The other thing to remember is on a V-shaped recovery, a bow tie is going to be a lot better if a market just kind of goes down and bottoms out. And what's kind of amazing to me is sometimes the market will bottom out, and it really doesn't look like it's coming off the lows that much. It looks like it's improving a little bit, but the bow ties will flip to uptrend proper order. And even though there's lag and everything in it, because the market's bottom out over time, that lag sort of gets washed out, and you could catch some really, really, really nice bottoms, like gold, for instance, will go down and just bottom out and die out for years. And then you take that bow tie out. I call it my Phoenix strategy, when you have something that just goes down to low levels forever, years, okay? And then you get a bow tie out of it. But the V-shaped recoveries, again, it's going to be a little quick to, it's going to be a little slow to get you out and a little slow to get you back in. So always look at the chart at these particular situations. And if the aforementioned system, TFM 10% system, is just a price movement and a crossing below a moving average. So these could trigger a lot quicker than a bow tie. So I would encourage you to also use that if you're doing overall market timing. But anyway, red down, red bad, green good. And then we had another whipsaw or type of signal or a V-shaped recovery on the weekly. But on a daily chart, as I think I showed a minute ago, that daily bow tie was right before all that serious sell-off we had with the tariffs and all. And we're in uptrend proper order again. So that is obviously a good thing. Now, if you take a look at, when was this? This was 2007. Okay, this is more of the gradual rollover I talked about, and this is on a daily chart. And because the market sort of rolled over gradually, you had downtrend proper order here, and then you had a sell signal here, and it did come back up a little bit, but for the most part, the market stayed in downtrend proper order for a long, long, long time and lost over half of its value. So again, bow ties do work best in a more gradual type of market. It sort of looks like an inverted cup and handle a lot of times. And I use bigger picture technical analysis and classical technical analysis, Schaubacher, more modern day would be Pring, but Schaubacher, who's the other one? Edwards and McGee. that type of stuff, but I don't use that in and of itself. It's sort of like that's more of a backstop. Like, okay, we've got an inverted cup and handle, but then we have a bow tie or some other sort of setup, a pullback or a first thrust, which I'll mention in 1 second. All right, let's talk about actual setups. So I eyeball the charts for my setups, and I don't actually run scans for these things, but obviously if you're new to trading or if you want to save some time, I prefer to look at a lot of charts because I like to know what's going on under the hood, so to speak. But if you wanted to program these in, they're already in MetaStock in the Expert Advisor. They might be called daylight pullbacks. I should have checked before I went live here. But again, on the next version of this, we'll call them Landry light pullbacks. So the market must have 10 to 20 bars of upside. Landry light, again, also confirmed by checking the chart, okay? And then the market must pull back to touch the moving average. Now, there's one I'm going to show you here that it didn't touch the moving average, but it's also set up as a pullback. So I'm not going to double negative. I'm not going to not take a trade if it doesn't touch the moving average. It's just that it amazes me how many times this actual setup will work and how many of my actual trades, when the market is really trending, okay, that this setup will show up. So pulls back to touch the moving average, and then you look, you're not trying to catch that falling knife. What you're doing is you're looking to get long if and only if that trend begins to resume, okay? So I had a trader friend years ago say, no ticky, no tradie. If you have to wait for an entry, okay? So you're actually buying higher than where the market is. And I am shocked at how many times, I've told the story 1,000 times, I guess I'll tell 1,000 more, but I'm shocked at how many times a stock will not trigger, or whatever other market you're trading, futures, whatever, and the market will implode, but you avoid that losing trade. And the story I tell 1,000 times is every now and then I'll get an email. It's like, Dave, what should I do with that turd you recommended? I'm down 50%. I'm like, that stock has been going straight down for 6 months. I never recommended that stock. Why would I recommend that? They're like, yeah, you did 6 months ago. I'm like, oh, well, then I'll go back and look at the charts. I'm like, well, maybe I did. It was like, sure enough, I did. And you can find all these recommendations, by the way, davelandry.com/archives. And the newer ones are on YouTube, YouTube/Dave Landry. And you can get them live. I'll show you how to do that in a minute. But anyway, it's like, well, it never triggered an entry, so no capital gets put into harm's way. Thank you, Jeffrey. Yeah, youtube.com/Dave Landry is my YouTube channel on that. So this is one that I showed last time as a Landry light pullback. And you can see again, the lows are greater than the moving average. And we had about 27 bars of Landry light. And then it goes down to 0. Jeffrey, it's going to be davelandry.com/slides or davelandry.com/free-book. If you go to the slides link, there's going to be a lot more information attached to that. I just set up that campaign a few minutes ago or refreshed it. So you're going to get a lot more access if you go there. If you just need the books, you can just go to free-book, but free-book. But I would go to the slides if you want everything, almost everything, I should say. Anyway, pulls back to the moving average, and Landry light goes down to 0. Okay, so that count goes to 0, and that's your setup. It's just a pullback type of setup. You take the moving average out, it's a pullback. Okay, it's just a way to, again, qualify the pullback. So let's take a look at what happened. And again, that was shown in the last webinar earlier this year, and you can see nice uptrend intact. There's your Landry light. Pulls back to moving average again, okay? Now, if you go to davelandry.com/archives or again, my YouTube channel for the more recent ones, I have some international clients and they were looking for translation. So I started uploading my service as a private share on YouTube, but then I started making those live. So those might be live 2 days old to a week or so. It depends on how everything sets up when I make those live. But anyway, you can look at all these archives. It's like, you attend the webinar sometimes, not to pick on anybody because I didn't see anybody else today. I caught the tail end of Jeff's, which was really good, by the way. But, a lot of times they show you all these gee whiz trades. It's like, well, show me everything you recommended. And that way I could maybe make a little bit more informed decision. So you can find those again, davidlandry.com/archives. And when I put together a presentation like this, that's exactly where I get them from. I go over there and grab them. But anyway, you can see down here, we had the setup. Entry was here, stop was here, initial profit target was here. And I'm going to walk you through the money management in 1 second, but I'll tell you a little bit about it now. So what we're doing is we're taking half of the position on when it hits the initial profit off, taking half of the position off at the initial profit target, okay? And that's kind of our swing trade. You can't, it's like the predicting the weather, okay? I'm looking outside, it's a pretty sunny day, there might be a cloud or two on the horizon, but if it starts clouding up and getting dark, I know it's going to rain soon. I don't know if it's going to be raining next week or next month or next year. But with trend following, if you have your setup, you have your pattern, there's a good chance that that market's going to move shorter term on your favor, but who knows what happens longer term, and that's why we're trend followers. So you take that partial profit off, you take off half of your position, and then you move that stop up to break even. Now, this is on a hypothetical 100K account. I do take these actual trades. I was going to see if I can see where we are on that one, but I do take these actual trades too. But for legal purposes, disclaimer purposes, this is all hypothetical, okay? But on a 100K account, now I do have a model account, what I call my model account, where I take all these trades in that model account. I take other trades too, but I make sure if I'm long 1,000 shares in the service, provided there's not some big discretion or something, reason not to take the trade, but for the most part, I follow it fairly mechanically, then I'm going to be long 1,000 shares personally, and I'll be taking profit. So on a 100K account, you're taking off $1,000 or 1% of your entire account at the initial profit target. And then that stop comes to break even. As my friend Charlie Kirk, not the recent Charlie Kirk, unfortunate situation there, but Charlie Kirk's a very good trader, a good friend of mine. He calls it free roll, and he invited me down to St. Lucia for a trader's retreat years ago. And when I talked a lot about this money management, he coined the phrase free rolling. And free rolling is sort of like, I hate to use the word playing with the market's money, but the worst you could do barring overnight gaps would be to break even on a trade. And the best thing can happen is the trade runs for a while. Now, I had one from the last presentation, if you go back and watch that, where we stayed in it for years and it went up like 500%. But the idea, once you get that initial profit target out, and I'm showing you all the money management now, but we'll get to some more specifics in a second. You want to let that stop gradually loosen up over time. So what we're doing here is if you were to try to get into this trade and say, okay, I want to stay in this trade for a year, this defense company here, because defense, I like defense or whatever. Well, you're going to need this huge wide stop, and predicting far out, like Greg says, all predictions are about the future, and a lot of stuff can happen between now and then. Greg Morris, you don't know what's going to happen. So if you're a pure trend trader, and there was a group of trend traders years ago, the Turtles, that everybody knows about or should know about, and they absolutely printed money. But after the program ended, most of them kind of blew up. And I'm not being Schadenfreude, but what happened is the statistics caught up to them. They were in a really good market at the time. But anyway, this stock has ran quite nicely. And when I took this snapshot, you can see we banked that $1,000 in the first loaf, okay? And then there's 5,000 and change on the remainder. And then again, we're bringing that stop up over time. Now, this was a live trade last time, and you can see Landry light to the downside. Nice uptrend, all green for a long time. Pulls back to the moving average. The other thing too is notice that the stock accelerated higher. That's a very important thing to look for. Persistency is very important. If you, again, go to my YouTube channel and watch as many videos as you can stand, if you go to the methodology and action playlist, you're going to see me talk about a lot of these concepts in addition to Landry light and proper order, but also persistency and acceleration, very important concepts. Anyway, you can see Landry light goes down to 0. This slide was exactly as it was from last time. And we had just triggered into this. And what I like to do when I do these webinars is show live charts, live open positions. So maybe Jeffrey be kind enough to invite me back, and MetaStock will have me back again. I can show the setups we showed last time and see what happened. So the last webinar was, I think, back in May, and this position is still open. And here it is. It's a gold stock. Pull back the moving average. There's your parameters, okay? Now, it didn't do a whole lot at first, and you were actually underwater a couple of weeks into the trade, but I'm a big believer in sticking with the position until you're stopped out and not micromanaging yourself out. And that's a biggie, and it's hard because you might get stopped out 3 times in a row and think, well, I'm going to get out sooner, and then that turns out to be the big winner for the year. Anyway, so we banked 1,000 per 100K. Stop goes to break even, and then the same sort of thing again. You let that stop gradually loosen up over time, but only when the market moves in your favor. So notice the stop here, this trailing stop, flat line for a long, long time. You don't want to have like an automated trailing stop, because let's say the market spikes up 5 points and comes right back in. So your stop goes up 5 points, it comes back right back in. All of a sudden you're stopped out and you lose your position. Now, we're not throwing caution to the wind, but again, we're making an adjustment to the longer term trend. And people in the past have asked me, Dave, is your money management psychological or statistical? And my answer to that is yes. Okay, you put a little money in your pocket with a swing trade, it makes you feel good. You know, not to go all freshman psychology. You know, what's the bottom of Maslow's hierarchy of needs? You got Wi-Fi, and then you've got all basic needs, food, shelter, and so on and so forth as you go higher. But it sort of helps to feed that need for some sort of immediate type of reward, and then, you know, your self-actualization and all those things towards the top of the pyramid is with the longer term trends. But statistically, if you could hit a few of those a year, you'll make a lot of money and your year will be made. And that's the other thing too, and as I've said 1,000 times before, even recently, we got a portfolio full of winners, and we got 2 stocks that haven't taken off yet, and hopefully yet is is the key word in that sentence. But many times people, like, they'll quit the trading service, and I'm like, not that I'm always good, right? Or we do have bad periods of time, but I'm like, well, okay, why'd you quit? It's like, well, I can't make any money. It's like, okay, well, did you get this one? Did you get this one and this one? You know, they're up 300%, 200%, whatever the case may be. No, but I took all those other turns. It's like, okay, well, there's your problem. You know, kind of like the cat stuck in the PC meme. I guess that's not funny if you've never seen it. But anyway, this one was from last time. I just want to show you real quick. And it did stop out. The stop goes to break even again once you hit the initial profit target, and for $1,000 or 1% on the entire account. So again, that's better than the poke in the eye, and that's what I call that, the better than the poke in the eye trade. So here's a live trade. Again, pull back to the moving average, really simple stuff, okay? And let me just back that up a minute. You can see it's down here as a recommendation. And let's see what happened. Entry's here, stop is here, initial profit target is here. And not a whole lot's happened. It's woken up a little bit recently, but we're still slightly underwater with this one. But we haven't gotten stopped out, so we're going to stick with it and see what happens. And again, if Jeffrey and MetaStock are nice enough to have me back, we'll take a look at this trade in a few months and see what happens. And here's another open one. Now this is fairly close to the moving average. Again, I don't quantify everything, but it's fairly close to a Landry light pullback. It's also just a generic pullback is what I'd call that. Okay, there's a recommendation down here. Okay, entries here, stop is here, initial profit target is up here. And you can see that it triggered, and it hasn't done a whole lot since, but it's last I checked today, it was above the entry, which is a good thing, obviously. Now here's another gold stock. This is way back in May. I think this might have been, I might have shown this one also in the last webinar, but you can see it pulls back to the moving average after a really nice trend. And I call it a double top knockout / pullback. So the Landry light pullback might also be other patterns that I trade too. So it could be different types of setups. In this particular case, it made a minor double top, then it had a bit of a knockout type of move. And not enough time to really get into that pattern today, but that's a great little pattern because a lot of people think the market is topped and a lot of shorts rush in, and it flushes out a lot of nervous Nellies when that market begins to sell off and pull back, and the shorts think they're vindicated. Okay, that's a lot to do with the TKO pattern, which again, you can get through the book. Anyway, entry's there, stop is there, initial profit target is here. And you see it triggered, it just died out and went sideways, okay? But it never really went below the moving average, and it certainly didn't stop out. And then eventually it did hit that initial profit target. Now, I often talk about dead money if you watch some of those webinars on YouTube that I've done. And I just say stick with the position. And believe me, if I wasn't doing a trading service, it would be really hard for me to stick with some of these positions. But I feel like if I'm telling you to do it, I'm going to do it too, okay? And that's really helped my discipline out a lot. And you know, one thing I was thinking about before I went live here today is no matter how long you've been at this, you still have all of these emotions. And we're going to get to that in a minute too. And you think a switch is going to flip where everything is just perfect and you've got it all figured out. And it's not like that. You still have emotions. It's still hard to follow the plan, believe me, okay? And we all go through that. And I think as a beginner or novice, you think, oh man, I wish I wasn't so crazy about all this. That never goes away, okay? It becomes easier, but it never becomes easy, believe me. And when you feel like it's become easy, that's right before you're getting ready to have your buttocks handed to you. But anyway, this has worked out really nicely so far on that one. So it's 2 gold stocks in the portfolio. Now, we'll touch upon the bow tie here quickly. Right now is not the time yet to trade bow ties unless you're looking at something that's at really high levels. Not that you want to short NVIDIA, but NVIDIA could be like one of those stocks that just kind of gradually rolls over. And then when something like that gets ugly, it's going to get ugly fast. And also the overall market, it pays to pay attention to the bow ties. So, and I purposely drew this as an inverted cup and handle. Again, there's a classical technical analysis, okay? The bow tie is better for when the market makes a gradual rollover, okay? And you have process tops and you have event type of tops. And I have patterns for the events too, be a pattern called the first thrust, which again is in the books. And then for the long side, the market kind of gradually bottoms out and begins a rally, as opposed to more of an event type of bottom. So bow ties are better for a process top or process bottom. So after a major low, you want those moving averages to flip from downtrend proper order to uptrend proper order fairly quickly, ideally over 3 to 4 days. That doesn't make a lot of sense until you actually see it in a chart, and it will. And the stock or whatever you're trading, Forex or crypto or whatever, has to have at least a 1 bar pullback. Now, in my regular trend following or following longer term trends like the gold stocks we just looked at, the defense stock and those biotech stocks, we were looking to get in on a longer term trend. So I want to see more of a correction to knock out some of these people. Whereas if you're trading a transitional pattern, meaning that the market's just rolling over or turning back up or whatever, you want to get in a little quicker. So you need to get in on the first signs of correction. So there's only a 1 bar pullback in this situation. So again, the moving averages come together, they spread out from downtrend proper order to uptrend proper order fairly quickly, and it gives the appearance of a bow tie. And then you're looking for just a 1 little bar pullback. That's it, okay? And you look to get long above that high. Now, if it starts pulling back further, you might give it a little bit more wiggle room. But sometimes if they trigger quickly like that, you could get in really early. And this was one that we showed last time, and we did stop out of it for, I don't know if the slide here or not, but we did stop out of it for modest gain. But you can see the market went sideways for a while. It tried to rally, and then look what happened. The bow ties came together and spread out. So again, those gradual rollovers, especially in a well-known, efficient type of stock like Carnival, okay, lots of volume, very efficient, a stock that you've heard of, as opposed to something more obscure. This is just the opposite of what I do in most of my other trading. I'm looking for inefficiencies in most stocks, like those little biotechs we just had and the defense stock, whereas with the bow ties for the shorting, at least, you want a more efficient, well-known stock with a lot of I don't actually plot the institutional followership, but you want a lot of people. You want a really crowded playing field, which is just the opposite on the long side. But for the bow tie, you want a very well-known stock, and you want a lot of people to get caught off guard. But anyway, you can see the setup here. It's programmed into MetaStock, and I did take this trade, and that was the recommendation for it. A little bit of pullback, entry was there. Stop, initial profit target, and again, when that initial profit target is hit, you drop your stop to break even, and then you trail your stop lower. So 1388 or 1.4% round numbers is better than a poke in the eye. And again, I'm going to go through these quickly because right now it's not the time to be trading these, but do pay attention for when the market does, when the market does turn. Again, J-Bill, fairly thick, well-known company, bow ties to the downside, pulls back, and that's the short there. And again, you can look at those, dailylearn.com/archives. Entry was there, stop was there, initial profit target here. And this was like another one of those better than a poke in the eye trades. And if all you ever did was make a little money, 1% on your account, and then stop out on every trade, that's the worst you did, you do really well longer term. So the short-term trading here, part of the money management, does help to keep the lights on. You're not going to get rich from that. Now, I'd recommend that you do your due diligence. One time I was talking with a friend of mine, and he was trading something. I'm like, well, that's kind of neat. I don't know if that's something I would do, but it's kind of neat. And he was showing me the trade. I'm like, well, how long have you been doing that? He goes, I just read about it this morning. It's like, no, don't rush out and trade these this afternoon. Find some that worked, find some that failed miserably, okay? Go through all my archives, see which ones I picked, okay? See if you agree with me or not. And learn how to pick the best too. Again, persistency, acceleration, all those things I talked about are very important. And watch as many of those archive videos as you can stand. And if you want to watch them live, you can go to dailylearn.com/trading service. Now, let me just show you something real quick that a guru's never shown you. See, you have a nice little, this is what I call a TKO pattern, where the market's in an uptrend and just sells off really hard, knocking a bunch of people out. Initially, it took off, but then it came back in and stopped us out, okay? It, spelled with a silent SH, happens on a trade. So not everything works out as planned. It happens. Now, I've pretty much covered the money management already, so we'll go through this fairly quickly. You want to risk 2% of your account if stopped out, and your stop is based on the volatility of the stock. And if you look at some of those archives, you notice in some cases it might be 10% away. In some cases, it might be 30% away. Now, some people are like, well, Dave, I can't trade no 30% stop. And I'm like, well, you don't get no Coke, like in Caddyshack. That's because that's what the stock calls for. You compensate by trading fewer shares. And if you dig around my website, there's an article called Better the Devil You Know. It explains the volatility and how sometimes less volatile stocks are actually more risky. Anyway, you want to take partial profits when your reward equals your initial risk. And the system guys are probably rolling their eyes. Oh, Dave, that's negative expectancy. Well, settle down, Beavis. The way you make your money is on the second loaf, okay? If the trend materializes, you're still in. If it doesn't materialize, like the better in the poke in the eye trade, you get knocked out. And then again, we're going to make the transition to the longer term trend trader by slowly loosening up that stop, okay? And I realize I'm going fairly quickly here, but initially it's kind of a stair step on the swing trade. And then on the longer term trade, we're going to just slowly loosen it up over time. And we're only going to raise a stop if the market moves in our favor. So it will look like a moving average longer term, but a moving average continues to go higher even if price is coming down a little bit, okay? Whereas our stop's going to stay the same until price makes a new closing high, and then we'll bring that stop up from there. So we're going to adjust to the longer term volatility of the market. And plus, the other thing too is if you do this properly, your stock's going to go higher in price that you buy, right? And the volatility will increase as it begins to take off. And so you're going to let that stop loosen up over time. And these corrections can be painful, but if you're in a stock and you're already up 100% or 200% or whatever it is, you stop out and make 175% or whatever the case is, then you have to look at what you've accomplished. Now we come to the most difficult part of trading, and that would be you, okay? So I'm just to talk a little bit about it really quickly. I know everybody's a setup junkie, but attitude is so much important than aptitude. A friend of the family called me recently, was a friend of my father's, and he's an engineer, and he's a super smart guy, immigrant from Pakistan or India actually, and super smart. And he expressed some interest in trading, and I explained to him, I was like, Adam, you are too smart to trade, okay? Because he's going to try to figure everything out from an engineering standpoint. Engineers, doctors, automatic transmission mechanics, anyone who uses a lot of logic in their business tends to make bad traders. But pilots are good traders, by the way. That's the only profession I can really think of that makes a good trader. If you guys can think of another, let me know. But pilots used to following his instruments, following checklists, and all these other things. And if you can do all that in trading, you'll do really well. Now, one of my epiphanies, and this was about 15 years ago, I was speaking in San Francisco at the Technical Analysis Association over there. And Denise Shaw was speaking, and she explained that from a neurological standpoint, you can't make any decision without emotions, and just silly little decisions like what are you gonna have for lunch or whatever. It's like, I had breakfast earlier, but I tend to get a little sugar low, like right now I'm a little hungry, and right before I went live, I'm like, well, let me go eat something. It's like, we got some ham in the house. I'm like, oh, if I go eat that, it's gonna be salty, and then I'm gonna be drinking water the whole time the presentation. So it's like, be cognizant of all your decisions in life and how many emotions are attached to them. You cannot make a decision without emotion. So people say, separate your emotions. It can't be done. But that's a good thing. Embrace that and learn that neurology. So I'd encourage you to study a little neurology. Now, if you want to know how to fail at trading, we're influenced by the extraneous, okay? Extraneous to the markets. So say you have a fight with your significant other or your spouse or both, okay? And your mindset's could be of a certain way. You're like, well, I'll show her. And, you come back to your office and make a bunch of stupid trades. And let's say somebody, maybe you see me online, talk about a setup or something. Oh, I'm gonna go do that. Some kind of trade goad, some sort of extraneous influence without obviously due diligence, of course, that might influence you. Now, the good news is, you know what you're doing wrong. You know what you're doing wrong, provided you've been at this for a while. I remember way back in the trading markets days, way back in the 1900s, okay, we would occasionally mentor people, and I was a little nervous early on, like, okay, how am I gonna figure out what this guy's doing wrong? And I just would ask them or her, him or her, and they would tell me, and I was like, oh, okay, well, my job was pretty simple. It's like, don't do that. A story I told 1,000 times is one of my clients, very smart doctor. He said, I can't make any money with your service. I'm like, okay. And he goes, I want you to look at my trades. I'm like, that's not really what I do. It's like, he goes, no, you need to look at my trades. I'm like, okay. So I looked at all his trades, and he made a little bit of money over the period, like $300 or $400, but he followed everything to a T. He did a really good job. And we made a few $100s over the period. It wasn't a great period of time, but we were barely keeping our head above the water. But he lost $5,000 on doing 21 day trades. And when I called him up and I said, good news, I figured it out. It's like, you were actually doing really well. In fact, you did a little bit better than me as far as perfectly following the system, these setups, but you took these 21 day trades. And he goes, I know. So he knew what he was doing wrong, but he did it anyway. So the solution there is, don't do that. So just kind of wrap it up. You want to find something simple like Landry light pullback, study the heck out of it, find 100 examples, okay, before you try to trade it. Pick the best, leave the rest, obviously. Use proper money management. Make sure you identify and separate the extraneous, okay? You can't separate emotions from your trading, and there's going to be a lot of extraneous influences. And so I would recommend that you document, take really, really, really good notes. As I said 1,000 times, just one thing on a personal level, and you're going to have to figure these out on your own, but on a personal level, my office is separate from our house. I used to have a guest house I worked out of, which was really cool, but we downsized. But when we built the house, we built a separate, I wouldn't call it a wing. It's pretty small compared to what I used to be in. But I have to leave the house to come here. So I'm coming to work and going back home or whatever, so to speak. And anyway, long story endless, it's like I used to find myself coming in, and I still to this day, to some extent, come into my office and all of a sudden I fire off a trade. I'm like, why am I firing off a trade every time I come to the office? And then I figured it out. It's like, well, I was in the house, I got something to eat, okay, because I was hungry. And then I came in the office and I was no longer hangry. And all of a sudden, everything looked great, you know? And so now just simple little things. It is not enough time to get into psychology. I'm nearly out of time. But I write WITL, walk in the office, and I tried not to make a trade for a while, at least a few minutes, to make sure there's nothing from a neurological level, psychological level happening. And where I'm going with that, let me see if I can jam it in real quick, is the hangry judge effect. If you're they studied a bunch of Israeli judges, and the people who got sentenced before lunch got far more harsh sentences than the people that were sentenced after lunch, because the judge came back and he was no longer hangry or whatever. So there's a lot going on, and you're going to have to recognize all these different influences in your life. And I know I'm just scratching the surface here, but just remember there's a lot more to it than just the setups. Everybody's a setup junkie, but there's a lot more to it than that. So again, thanks to everybody. Thank you, Jeffrey. Thank you, MetaStock. Again, thank everybody for coming today, attending. And so may the trend be with you.
All right.
And there's all my contact information. Thank you, Jeffrey.
All right. One comment from Michael. He says he likes your bow tie setup, but he converted the moving averages to fib numbers, 8, 21, and 24.
Ah, I've actually heard of people doing that. I'm not a huge fan of Fibonacci, but if it works for you, if it's something you think that makes sense, then by all means. And you're using 3 time periods, so short term, longer term, or intermediate term and longer term. So as long as you're doing that, that's fine. Richard
says, I really like this guy's approach.
Oh, thank you.
The link for his book, which I just sent him the slides link, the Dave Landry.
Yeah, they'll get it from there. And if they have any questions, I do answer my own email, so I'd be happy to do that, help you guys out.
All right, and then I did look, and I forgot what it was called. The Dave Landry setup was called Landry Daylight, the one that you weren't sure what the
Okay, yeah, and we'll talk at some point and work on getting that plugin updated, because there's a few more things I want to add to it. So cool.
Thank you very much, Dave. Appreciate it.
Thanks again, Jeffrey. Appreciate it.
Talk to you very soon.
Thank you.
All right, let me go ahead and do this. All of those setups too. Just he showed a number of setups that were in MetaStock. They're in MetaStock. There's no additional charge for them. They're part of the software. And if you have MetaStock, you'll have a copy of them. So I'd recommend you get MetaStock. Of course, I've been recommending that all week. If you go to metastock.com/conf promo, you can get signed up for it. We do have a buy one, get 2 free offer, where if you buy a month, we'll give you the second and third month for free. You guys go to metastock.com/salespchat. You can also call 800-882-3040. John and Jack, I can see you. You guys look good. Can't hear you though.
All right, you should be able to hear us now. Yeah,
Michael says Dave is great. Since you're on here already, I'm going to have you help me do something. I'm going to put you to work. You ready?
Yep.
Okay. We do prizes. We do prize giveaways between every speaker. And so what I'm going to do is I'm going to reach into my virtual prize bag here. Let me find it real quick. And let's just take a look at. We're going to give away a Trading Winds premium subscription. It gives premium weekly, nightly updates, trade ideas, live trading session 3 times a week. It's the tradingwinds.com service. And what I need from you guys to select the winner is I just need a number. Now, this number has to be between 2 and 5,329.
Oof. That's a lot. Let us think about this for a minute.
You want to do some science?
How about 735?
735. Okay.
Let's process this quantitatively.
Now, because you said that, what was the reason you picked 735 out of all 5,000 numbers that you could have picked?
It's based on the data. No, it just flew into my head.
Right on. I thought you might say, hey, I asked ChatGPT to pick one or something. All right, very good. Oh, I forgot to announce who the winner was. That was Bernard S. With the Gmail account. So I'm going to go ahead and make a note of that. I will get started first, though. These guys, I want to talk a little bit about John and Jack Kosar. We've had them on to do a number of different guest interviews. I know that you were just on the Schwab Network. I just saw that come through. They do a lot of talking. The reason, I just realized that just a lot of talking might not be a very good compliment, but they do a lot of good talking. And the reason I really like them is they have kind of an approach that they use that is very macro focused, very, very different from a lot of what we talk about in the conference. So without further ado, let me get the screen share working and we'll get you rolling. Okay, make the presenter, yes. Okay, it should have asked you if you want to share your screen. All right. And I can see it, which is usually
Awesome.
my cue to leave.
Okay.
Let me know if you need anything.
Thanks, Jeff. Well, thanks, Jeff. So let's begin. And let me get rid of, let me rearrange my screen a little bit. So I have a big picture of my head right in front of where I need to be trying to look at my own presentation here. Okay, so a little bit about us, just so you know where we're coming from. This is my 43rd year in the business, and the first 17 I spent on the floor of the Chicago Mercantile Exchange back in the day when there was open outcry and there was 3,000 or 4,000 people on the floor. If you ever saw the movie Trading Places with Eddie Murphy, a lot of that was filmed at the CME. So my background started out trading every day on the floor and eventually went to starting my own company, started my own firm, just writing research for money managers. And over these past few years, we started managing money ourselves. And my journey through this went from doing a point and figure chart by hand on the floor of the CME in the early 80s to moving to computers, but still using standard technical analysis, you know, head and shoulders and flag patterns and stuff. Really, the past 10 years, we've shifted to a much more quantitative approach. Jack is, Jack's been working for me and Asbury part-time for probably the better part of a decade. He's been here full-time more than 2 years, and he'll be the legacy of this business when I turn 100 and I can't sit up in my chair anymore. But what he has added is being able to quantitatively take what I know and build models out of it. So the reason I'm going through all this is just, I want to leave you, you're not here to, you're here, I think, to learn different people's approaches so you can become a better investor, you can become a better trader. So that's kind of my basic journey, is from point and figure charts with a pencil on the floor of the exchange to actually taking what I've learned over 40 years and building models with it. Jack has been enormously helpful in back testing what I know and creating strategies with it. So let's get the slide to move. There we go. Yeah, so I've been around, like Jeff has said, spoken in a lot of places, and I guess when you do this for 40 years, you start, you accumulate a list like this. But our approach, I tried to simplify this, and we're money managers now. So basically, to me, trading could be this vast, huge abyss that you go into. There's so many different things to learn. Are you a fundamentals guy? Are you using candlesticks? Are you looking at, there's so much stuff here, you can get lost in it. So I tried to kind of distill it down. And basically it's, do I want to be in the market or not? Is question number one. And then question, or how much? I guess would be the kind of the second part of that. And the third thing is, if I'm in the market, what do I want to be buying? You know, do I want to be in small cap? Do I want to be in tech? Do I want to be in individual stocks? So that's kind of what we did when we first started to build models, was just start there. What am I trying to achieve here? And a repeatable, you want to have a process that you can repeat. And I was watching Mr. Ramsey here that was on before me, and I was kind of nodding my head at a lot of what he said. You need a repeatable process, because otherwise you're going to be drifting in the desert for a long time and wondering why you're not making any money. It's because you're not. I'm not a golfer, but you know, my dad was, and I know generally speaking, you want to swing the club the same way all the time. That's how you get better. It's the same with trading. So we built a bunch of models, and we've got some model portfolios that we use to manage money for our clients who are other individual investors. We also manage money for some RIAs, so they give us some of their clients' money to manage for them, because we've got some pretty good models. So we're going to go through a bunch of them today that you're seeing on the page here. How to find us. Oh, by the way, if you want a copy of the PDF, go to asburyresearch.com and go to the contact tab, or phone us if you like. If you like what we're doing and you want to see more of it for free, we got a free Substack, and our YouTube channel is of course free. There's a ton of videos on there. We do a twice a month, we do a podcast called Follow the Money. That's basically what we do. So that's where to find us. Glossary of terms. We look at models quantitatively. We use a lot of math, and a lot of this is, you know, comes right from Jack, who's got his master's of science and finance, and has just been kind of a math and science kid since he was 12 years old. I'm going to let him explain some of these to you, so when we refer to them, you'll know what they are.
Yeah, so starting off, our max drawdown, just that's really the peak to trough, so the top, you know, the top of a time series that you have for price of a stock from the tippy top to the very bottom. We tend to talk about that as a percentage, so what percentage of a drawdown did you have? Standard deviation, it's really kind of just the wiggle of your P&L, the wiggle of a particular stock. A relatively stable stock's going to have a low standard deviation. A kind of a more volatile stock's going to have a larger one. Beta, how a particular stock or ETF is, or a model is reacting to systematic moves in the market. So a higher beta is going to have a more of a larger move with that kind of a signal in the market. Risk-adjusted returns. So we find these really important to try to understand. You know, you could really juice up returns, but it's really on a basis of how much risk are you willing to take for those returns. I think a lot of times people are so driven on how much money are they going to make, they really don't understand the underlying risk of what they're buying. So understanding of not only what those returns are, but what they are as a function of how much risk you're taking. Sharp is a way to kind of quantify a risk-adjusted return. Sharp is the return of that portfolio or that stock minus the risk-free rate, so what you're potentially giving up as opportunity cost divided by that standard deviation. So what kind of return are you going to get versus how risky that particular model is? And then annualized total return, just the average yearly growth of an investment over time. So you can you got your total return, so how much you're making, and then when you annualize it, it's just how much you're considering the effects of compounding over a period of time. So our first model we're going to talk about today is our correction protection model. We kind of talk about this as a dynamic stock bond allocation model. So it's either risk on or risk off. And the way that we trade it with our clients is when we're risk on, we are buying the S&P 500. And when we are risk off, we are actually putting money into cash equivalent. We've been using BIL, which is the 1 to 3 month treasury rate. I believe it's yielding somewhere around 4.25 at the time. At this time, this is really a wealth preservation tool. You know, we're really trying to avoid drawdowns in the market. and it being binary kind of allows us to do this. You know, I won't go into the details of what is under the hood of CPM. That's kind of our secret sauce, but it's a series of indicators. You know, we don't want to take, you know, part of what we're trying to talk about here is we want to take data and be able to try to drive our investment decisions, and CPM is a series of indicators that really takes the assessment of the market and comes up with a binary decision. Is it risk on, is it risk off?
So that's what these arrows are for. You can see this is November of 2023. We went to risk on, which means you know, you're in the market. For our managed accounts, we bought SPY. So we were, for that particular money, let's say they gave us $500,000. For this particular model, we bought $500,000 worth of SPY on November 2nd. On April 15th of 24, it went to risk off. That means out of SPY and into BIL. So now we're getting a short-term interest rate. And then we're back in on May 3rd and so on and so forth. So the most recent signal, the two most recent signals, is we went to risk off on April 2nd. Then we went back to risk on April the 24th, and we are still risk on today.
What we have here is, you know, kind of highlighting why this model is important, and that is reducing your drawdowns. This model has consistently over the years had less drawdowns than the S&P 500. That, you know, what we're going to kind of highlight in the next slide actually is why drawdowns are important. But, you know, big kind of things to notice, 2020 was COVID, the market drew down 33%. You know, our CPM model was able to avoid a good chunk of that by only drawing down 9%. Drawdowns are increasingly important for those that are older in their investment career, as you know, you don't want to take big hits, especially when you're starting to come into your minimum, you know, distributions for some of your IRAs and things of that nature. So being able to avoid drawdowns kind of gives you a leg up on you know, not only needing to find the next alpha stock, but also knowing when you can avoid the kind of the downturns in the market.
Here's this year. So we've had an 18.9% max drawdown. There's that word again from the glossary in the S&P 500. So our max drawdown for CPM was 930. That's because for a little bit more than half of the way down, we shifted out of SPY and we were in BIL.
Why drawdowns are important. So, you know, kind of what this chart is highlighting is in green, you're going to see what kind of a drawdown you take. And then the red is the required amount of return that you're going to need to just get back to even. So as you can see here, a 10% drawdown requires an 11% return. And the larger the drawdowns you start to take, the more return you need. A 50% drawdown means you need an appreciation of your portfolio by 100% just to get back to even. And again, the reason we put so much emphasis on drawdowns, especially for our older investors, is you don't, you know, my dad always uses a football analogy, you know, older investors are in the fourth quarter. You really can't be taking those risks that you could take in your first or second quarter of your investment because you just don't have the time anymore. So, you know, trying to throw a Hail Mary in the fourth quarter isn't necessarily going to work. You want to be able to just take the ball, try to, you know, you already have the lead. You want to take it evenly. You know, a 70% drawdown is going to require 233%. So understanding the risk that you're taking and understanding how much you need to get back is key to our investment structure. CPM, what is it? You know, we kind of take the bias that market in general goes up, you know, looking at a long-term chart of the S&P 500, and obviously you can see that the stock or the price is always eventually going up. Now there are those drawdowns in between, but knowing that is we wanted to try to keep something that was in the market as much as possible to take that price appreciation. So we have about 5 round turns a year, round turns of buy and to sell. We don't do any shorts or derivative trading. And the goal is to give you the S&P 500 with less risk. And that's what the CPM has been able to do, better risk-adjusted returns, stronger Sharpe ratios, and it becomes an alpha-generating model when we use a little bit of leverage. We're comfortable using leverage when getting into the alpha-generating models because we do such a good job of reducing our drawdowns and keeping our risk low that we even using a levered product like SSO, we can still we can have some outsized returns without having risk that is even that of the S&P 500.
So the premise of this was, the origin of this was typically if you have an advisor, if you use Fidelity or Schwab or wherever you might go to for an advisor, in most cases, they're going to start you with some kind of an allocation, a stock bond allocation. Typically 60-40, right? Everyone hears about the 60-40 portfolio. So the premise of this was, instead of meeting with you in my office, if I'm your advisor, and setting you up, I ask you 12 questions and you determine by your answer that you're a 60-40 stock and bond person, and then you let that run. I'll see you next year on your birthday, I'll take you out for a steak. That seemed kind of ridiculous to me. To me it was, shouldn't the market be telling you whether you should be in stocks or bonds than some guy in a suit that talked to you 3 years ago? So the premise of this was, why not let the market tell us whether we should be in stocks or bonds, and not our advisor tell us on the initial meeting we had with them. So that's kind of the origin of this, the genesis of the idea.
So how we've done, like I said, the goal here is to try to stick with the S&P 500, and in certain times beat it, sometimes not. You can see it's like glue. The CPM model via SPY has stick with the S&P 500 quite a bit. And again, our returns are in general right that of the S&P 500. But the key here is the defensive statistics. This year to date, standard deviation significantly less, about roughly 7%. And historically, going back to, these are all hypothetical back tests that we've done on our model, about 4.5% less. So you're going to have a lot less of that waviness in your portfolio using a CPM type model. Having those lower standard deviations, we're allowed to drive a little bit higher of a Sharpe. So we have, historically, my understanding, any kind of a Sharpe nearing 1 is a pretty good model. On the year, we're at 0.92, which is relatively close to 1, and historically at 0.83. And then again, driving into our drawdown numbers, historically, max drawdown for the CPM model of 20.2 versus 33.9 in the market. And this year, we got 18.9 for the S&P 500 and 9.3 for the market. So you get S&P-like performance with much lower risk. Like I said, turning this thing into an alpha generator, in general, we build some of these models, and I'm trying to think of how my generation or people around my age can use these to increase their portfolio over time with still keeping that risk profile. So we have CPM Ultra. What CPM Ultra is it's a blend of, it's trading the CPM signals, but in this case using some SSO and some SPY, and it allows us to really outperform over time. Again, hypothetically back-tested models, but we've done pretty good. Historically, annualized return about 5% above the market. 3 years, roughly, again, 5% above the market. Again, why is this important though? If you look at our risk numbers are relatively close to the S&P 500. So, drawdown of 31% versus 33 for the S&P 500. So if you're comfortable with S&P 500 risk, which if you've ever been a buy and hold investor, or you're willing to buy some kind of index or basket of S&P 500 stocks, theoretically you are then comfortable taking the additional risk using the levered product, but also in this case, being able to outperform the S&P 500 while doing so.
And look at the difference in performance. Our start date is Q4 of 2017. That's what we see down here. And this is through about a week ago. So this is Q4 of 2017. Over time, with all of the compounding, and again, keeping the drawdowns low, these are the same signals for the CPM, for the regular CPM, which is a defensive strategy. Over the course of this period, we got 163.5 for the S&P versus 253.2, let's call it. So that's the difference when we add a little bit of leverage to this, because we're still following the model, but when we're in a risk-on situation, we're trading with leverage. So we're making more on the upside, but we're saving the same amount on the downside.
The other key thing, just to kind of wrap up the correction protection model, is, the reason that we built models in general is, you can turn on financial news at any particular time, and their goal is to get you excited, get you outraged, or kind of get you off sides a little bit, and you can kind of get mixed up. The next Fed meeting or the next big tech boom can get you off sides or excited. We like this idea of trading with these models because they're systematic, they're data driven, and it takes a lot of the emotion out of trading. We've had a number of our clients contact us, and they didn't take a signal because they were watching financial news that day, and they didn't buy in when we told them to on April 24th because everything still seemed like doom and gloom. It allows us to sleep better at night, knowing that we have a data-driven, systematic way to kind of cut through this noise and trade with confidence. So whether you're going to use a CPM or build your own with a set of indicators or a set of data points that you trust, the key is to use those to kind of get out of your own way.
So I'm going to talk about the Asbury 6 here in just a second, but just to kind of, we're here to hopefully teach you, help maybe take some of our experience and be able to give it to you. So the takeaway here is not to go right into looking at Sharpe ratios or standard deviations and studying that, but rather have a kind of a high level understanding of it's not just how much money you make, it's how much you risk. I was just talking to Jack when I was on the floor back in the 80s. Traders on the floor, they used to have a saying, and it was like, you'd see somebody walking around with his head down, and he'd say, "What's the matter? I'm losing money." Guy would say, "God, I had a horrible month," and they'd ask him why, and he said, "I'm eating like a bird and crapping like an elephant." And he didn't use crap, but and what that meant is he was taking little profits, having a bunch of winners, and then all of a sudden he puffed up and he thought he was really smart. It happened to me, God, more times than I want to even talk about. And then you start thinking that you're smarter than everyone else on the trading floor, and you take a big loss. So understanding the relationship between how much you're willing to risk for your trade. You should never go into a trade unless you know how much you're going to risk. And if you can't see on that chart or the piece of data that you could possibly make at least 3 times for me, if I can't see that if I'm going to risk $5 on a stock, I better see a way to get to 15 or I'm not taking that trade. So that's really what this is about. We've kind of streamlined it so it's all numbers and there's not a lot of chin scratching for us, but that's one of your takeaways here is come up with a methodology that you're comfortable with, know what your timeframes are, know what your strategic time frame is. That means if this trade is profitable, how long do I think I'm going to be in it? Our strategic is 3 months or better, 1 quarter or farther or bigger. Our tactical is 1 month. So we're using tactical tools to try to get into a strategic idea. And our tactical is always 21 days. Our strategic is always 63 days. No matter if we're looking at gold or crypto or whatever it might be, you can't vary. You got to have some constants. And that's why we've gone to such a mathematically driven place. You don't have to go all the way there like we have, but these simple mathematical boundaries will keep you from eating like a bird and crapping like an elephant, right? You don't want to, you want to know small losses, big wins over and over and over. So this is the Asbury 6. The Asbury 6 was designed to be an indicator rather than a model. And the reason that I built it is after doing this for a long time, over the past 10 years or maybe a little bit inside of that, the market started trading differently. A lot more volatility, a lot more days where the S&P was up 50 today, and then it was down 70 tomorrow and down another 70 the next day. And I was getting shaken out of some really good ideas on the market because the shock of waking up in the morning and sitting on your desk and the S&P's in your face 70 points was forcing me to make trades based on emotion and not based on logic. So what I did is I made a list. I'm actually looking at it. I have a list of about 20 different indicators that have been my most reliable indicators for how I approach the markets during my 40 years of doing this. Handed them over to Jack and said, let's start to blend these together. Let's start to backtest them in groups of 3, groups of 4, groups of 5. Let's find 6 disparate indicators that together are stronger than they are individually, because every indicator, it goes off for a while where it doesn't work. The market changes, something happens. There is no favorite indicator for me. Every indicator has an Achilles heel. So we found 6. We've got the monthly rate of change in the S&P 500, the relative performance of stocks and high yield bonds, investor asset flows, volatility, trading volume, and market breadth. Then I actually started trading this in my account, and I'll show you how we did that. This is updated every day after the close, about 2 hours after the close. So the A6 has been a slight relative outperformer versus the S&P 500. Actually, over the past 8 years, it's outperformed the S&P 500. It's 85% of the time over the past 8 years. But the max drawdown, as we know, because we've already mentioned it to you, is down 33.9 for the S&P. Max drawdown for the A6 has only been 13.6%. So for my own account, I trade this with a little leverage because I know even if we got a double of the max drawdown, I'm still underneath my drawdown for the S&P. So as you can see, the signals are much more rapid. You know, this is built to be kind of an EKG for the stock market. So how it works is 4 or more of the 6 that are positive or green, that means we're in the market. That means we're buying SPY or we're buying whatever we want to buy. 4 or more red, and we're out of the market or we're in cash. So you can see right now we are in the market. We've been in the market since August the 12th. If it goes to 3 and 3, that's not a signal to turn. It needs to turn all the way. So like if we went to 3 green and 3 red, that would tell me the market's at a balance point. I should be looking for where that support level is to correspond with this in the S&P 500. And it would have to flip to 4 red. So here's where we are now. So you can see what I'm looking at. This is the monthly rate of change in the S&P 500. It turned back to positive, went back up above its 21-day moving average on September the 15th. So there is September 15th. There's the rate of change. That's how you equate what you're seeing on the chart to what you're seeing in the model. This is, excuse me, the relative performance of stocks versus the S&P 500. We use SPY versus junk. There's that 21-day moving average again. Why? That's our tactical time period. Know your time period. You might be a day trader, so your tactical time period might be 1 hour and your strategic time period might be 3 or 4 hours. Doesn't matter what the time frame is. Stay consistent with your time frames so you're not conflating one with the other, because now you don't have anything. You got a bowl of spaghetti. You need to be very exacting about what you're trying to achieve with this trade, whether it's a day trader or it's a long-term trade, and know what your strategic and your tactical time periods are. This up since August the 6th. Stocks outperforming high yield bonds is characteristic of a rise in the S&P 500. This is ETF asset flows. This is the assets under management in SPY. Positive since August the 9th. So this is positive as well. Volatility, this is the VIX. Volatility has been up above its 21-day moving average, or VIX has for 3 days. It's negative, but we say it's at a tactical decision point. Why? Because it's right on top of that 21-day moving average. This thing can turn in a day, so I want to know that. Volume, near-term positive. This is cumulative volume, which is different than raw volume. You can see, with the exception of just a couple of weeks, the latter part of July, the very early part of August, it's been above its 21-day moving average while the market has gone higher. Number 6 is market breadth. We use the AD line for the NYSE composite. Again, chopping around a lot. It's negative right now, but I'm guessing looking at the market is up 21 today, this afternoon, as we're about an hour and a half from the close today on Friday. Tactical decision point, because it could turn either way. So this is how we don't get faked out if the S&P is down 70 today and up 80 tomorrow, is we're looking under the hood of the S&P and seeing what these 6 disparate indicators that play better as a team than they do individually is telling us about the health of the market, keeps us from making mistakes. I'll turn this over to Jack for the sort report.
So this is a sort report. It's kind of a high-level version of a couple of ways that we approach investments. We actually wrote a paper for the Secrets of Success, the three-legged stool of investing for MetaStock. If you haven't read that, check that out. But this is our sort report. So we want to know how disparate ETFs are kind of tracking across the investment landscape. So we have small cap, gold, emerging markets, US tech, a little bit of crypto. In general, we don't prescribe trading crypto, but we very much like to use it as a risk gauge. So I like to say, you know, if I have crypto trending across all 3, relative performance, trend, money flows, that's telling me that investors are willing to accept the riskiest of assets. So they are very much risk on. They're bullish into the market, using that as kind of a gauge instead of an investment itself. Commodities, interest rates, the dollar. What we're really trying to do is just, again, we believe that, you know, you want to see trend in price. So want to see that the price is appreciating in value. Trying to trade something that is either sideways or down really isn't doing us any good. And I think trying to pick bottoms or pick tops is a difficult thing. So trend is your friend. Relative performance, you know, this is kind of just trying to get out ahead of where your money is, getting the best value for where you are. So something could be appreciating in price, but your opportunity cost is lost if something is appreciating in price better. So we generally do relative performance versus the market or the S&P 500. So because if it's underperforming the S&P 500, I would rather just buy SPY. And then money flows. We kind of treat this as conviction, investors voting with their dollars. As we see money flowing into a particular ETF, we want to see that accumulation and that trending in the right direction. Price can be going up, relative performance can be going up, but without that conviction, that overnight conviction of keeping your dollars invested in that particular ETF, you know, the other 2, trend and performance are not long for this world. So that's our this model is actually available, or this table is actually available via our Substack. CEF, that is another one of the models that we built. This is kind of our you know, we have our risk on, risk off model with our CPM. We have our indicator with our A6, health indicator with our A6. CEF is our portion of our portfolios that we want to be in the market all the time. And we do that by tracking the velocity of money through 3 different time periods. We have a trading week, tactical month, and a strategic quarter. We rank those kind of like a golf score. So you want the lower, the better. And overall, we have our overall ranking by adding up the 3 time periods. What we're really looking for is momentum of assets going into the 11 sector spiders. We rank this, the way we trade this is the top 3. So any in this case, technology, consumer discretionary, and healthcare would be evenly weighted. If you take a hypothetical $100,000 account, it would be 33,000 and change in each of those particular sectors. We also treat this as, for some of our more active traders, treat this table as a place for them to know where the money is going and where the money is not going, or actually in some cases where the money is leaving. Traders can go, I really like technology. Instead of buying XLK, they might go find their favorite technology stock, knowing that there is assets at their back. We also have our rainbow charts. This is trying to kind of highlight what each individual sector looks like in terms of its ranking. So up top we have our daily ranking, our daily CEF ranking, and on bottom is our relative performance versus SPY. What we like to highlight here is when we get, actually the last time we were on with with you guys, we said that technology was moving into favored status. It was April 24th. We stayed in this upper favored ranking for quite a while, leaving it on August 19th for 12% of relative outperformance.
Versus the S&P
Versus
500,
the S&P
that's what the
500.
lower chart is, versus it's XLK versus SPY.
And as you can see here is when money is leaving a particular sector, when they start to get lower rankings and according to the CEF model, we tend to see relative underperformance versus SPY. When we can stay in this favor, which means money is consistently moving into these particular sectors, we see this relative outperformance. So this model has really done a relatively good job of staying in. Now, you know, this little period from August 19th to September 9th, we've had a little bit of apprehension in the market. We've seen money moving rapidly in and out of a lot of the sectors, really sped up. And I believe, you know, try not to inject my beliefs too much into this. We're very much a data-driven company, but as investors were nervous about rate hikes, nervous about tariffs, nervous about, you know, geopolitical, you could see that investors were moving their money out, taking little shots in order to try to grab what they saw in April through August. You know, they want to get that money in, and if it sticks, it'll stick in for a while. If that idea is not working, that money flows right back out. This is just how we've done. This is going back from June 26th of 2018. The CEF model has strongly outperformed the S&P 500.
Doubled it.
And you know, kind of had a question off at the pass. A lot of times we'll ask, well, hey, you know, can we trade the CEF model and the CPM model at the same time? You know, when CPM goes risk off, do we not want to trade the CEF model anymore? And the answer is invariably no. We back tested it 6 ways to Sunday, and the CEF model actually does well being invested in the markets at all times. And the theory behind that case is a lot of investors cannot go to cash. They have to put their money somewhere. And in times that even bearish markets, when the S&P 500 is declining, that money has to go somewhere. And in often cases, it goes into defensive stocks. XLE has been really big trades for us when the market was down, and and we were able to outperform. How we do risk-wise, similar risk to the S&P 500 here, you know, in terms of its standard deviation, which makes sense. We're invested in equities that are a part of the S&P 500 as a whole, but on a risk-adjusted basis, we do quite a bit better. Sharp ratio of 1, like I said, my understanding is anything with a Sharp of 1 is pretty good for a portfolio, you know, and we're doing pretty good this year. In terms of its drawdown, similar or slightly better than the S&P 500. Again, we treat the CEF model as our portion of our money that's always in the market, and we want to follow the money, namesake of our podcast.
So this next one, this is more of an indicator than a model, but what I use it for is to tell me where there's opportunity globally in equities. Really good example of this is earlier this year, when our market was weak, from February to April, I started seeing a lot of green on this chart. This is US versus the world. I should back up one step and say we have 25 different global equity indexes that are arranged on the model, on the you know, the little graphic here according to country. South America, continental US, Western Europe, Asia Pacific here, we've got Middle East here, and then we have what they call Oceania here, which includes New Zealand and Australia. When our markets started weakening, we saw a lot of strength coming from Western Europe. Spain, I remember, was in there. France was in there. I think Italy was in there as well, and also from South America. So this is part of a research service, but the point of it is when the market goes down, oftentimes there's opportunity somewhere else. This tells us where it is. So we have clients that manage money for their clients. And when the CPM went to risk off in the middle to latter part of February, the Asbury 6 was 4 or more red. people were looking here and they were taking some of the exposure that they had in the US, not all of it, but a piece, maybe 20%, even if it was 10%, and they were moving it to South America and they were moving it to Western Europe. And what happened is when the S&P was down, it was down 19.9 or something like that, well, they were up 7 or 8 or 9% the other way. So the swing between losing 10%, during the move down in the S&P and picking up 5 or 10% if you were in South America, if you were in Western Europe, it's a big deal. It's like for these guys, that's their year. If they can catch that lightning in a bottle. So that's what this is for. We have 3 overweights right now. We've got Hong Kong that we went overweight because it showed up on our model on 221. 26.7% outrights, outperformed the S&P by 15.4. These are a little bit more recent. We bought Brazil on 827 and we bought Mexico on 92. So here's Brazil. You can see on August 28th is when we actually put this out as a trade. Since then, Brazil outright has risen by 6%. And it's outperforming the S&P by 3%. That's what we're looking to do. Is not only the most important part of this chart is the bottom panel, right? Because if it's not outperforming the S&P, I don't want to be in it. So if we're getting this relative outperformance, that's the name of the game here, and that's what the US versus the world model is for. Now we've got ETF trading ideas. So we've got 4 open ideas right now. We're on copper miners, gold miners, a couple of gold miners, and metals and mining, right? All in the same space. They're all in the miners, but you can see we've got some nice leads here. Ring, we're actually up 24 to 25% as of today. Outperformed the S&P again by 17%. How we do this is important. What we do, well, here's Ring. Let's just take a look at Ring. We bought Ring on August the 6th. It was breaking out and making new all-time highs. So price, we talk about the 3 legs of the stool. This is the price leg, right? It's breaking out. We've got the 50-day moving average in blue. That's right underneath price right here. And then we have AUM, the asset flows. Is there money going into this particular ETF? Yes, it's above its 21-day moving average right here. This is a middle panel, trying to get the mouse to cooperate right there. Expanding, good. That's the second leg of the stool. The third leg is how's it doing versus the S&P? If it's not beating the S&P, I don't want it because I can buy SPY and I can pray the market keeps going up and I don't need to do all this work. Yeah, it's been outperforming the S&P 500 really since August. So checked all 3 boxes and it's moving higher. This is, if you're a person that likes to trade individual stocks or ETFs, this is what we do. In order to build a successful system, something that is repeatable, that you can do all the time, you don't have to do a lot of thinking or clenching of your fists. It's just you're following a strategy. You need more winners than losers, right? So this is going back from March 17th to last week. So pretty good chunk of time here, about 2.5 years, 109 trades, which is about 4 trades a month. It might not be active enough for some people, but these are the numbers that we look at to make sure that our system is good. And you could do this too. This is not hard. We know our average profit per trade is 1.5%. It doesn't seem like a lot, so you trade bigger numbers if it's not big enough for you, and you make your money that way. Sharp ratio 1.5, extremely high Sharp ratio. That means our risk-adjusted returns are extraordinary in this particular strategy that we're following. 54% of the trade. 2 things: you got to have more winners than losers, and your winners need to be bigger than your losers. 54% of these were they were profitable for us. Average winning trade 4.9%. Average losing trade 2.4%. So our winners are twice as big as our losers, and we're winning more than we're losing. I know that my average winning trade length is 18 days. I know that my average losing trade days, business days, is 8 days. So I've got all this information. I know how I'm doing. This is something that you should think about doing, is come up with a strategy that is repeatable, that doesn't require you to see what the guy on TV is saying or what the Wall Street article is about, the Wall Street Journal, but just based on numbers. This is how you build a successful trading system. Does it have to be just like ours? No, it could be 80% winners, and your winners are only 0.2% bigger than your losers. There's different ways to make these numbers work, but if these numbers aren't right, you're not going to make money in the market.
And then just, high level, our approach, we took our models and we built them into model portfolios for blending them for different of our customers. So we have our ultra conservative, that's going to be those, actually came from a client that called in and said that, they're on a fixed distribution schedule and they can't take a loss of more than 10%. Historically, over the last 7 years, back tested, ultra conservative has not had a drawdown of greater than, it's actually 9.3%. Asbury conservative, again, leaning a little bit more toward the capital preservation and balanced. And then we also have aggressive. Aggressive has a little bit of leverage. Aggressive is a little bit of a misnomer, as in it is still significantly less risky than the S&P 500. But we tend to skew a little bit on the older investors. As we kind of generate, drawdowns around that 21, 22, 23%, start to get a little bit more aggressive for those that are a little bit in the older cohort.
So Asbury aggressive, I'm just kind of looking at our sheets here. Through the end of last week, Asbury research, the Asbury aggressive is up 20.4% year to date versus 12.2 for the S&P 500. Its drawdown is still 3% less. Its drawdown for this year is 3% smaller than the S&P. So that's what we're looking for. If you could skin the cat on both sides, if you can outperform the S&P and have lower drawdowns, better risk-adjusted numbers, that's the white whale for us in building models. It's very difficult to do.
Yeah, so what we have here is we have our Asbury aggressive model in green, our Asbury balanced model in purple, and then we have the S&P 500 in blue, and then AOR, which is going to, it's an ETF that represents a 60-40 bond portfolio split. And really what we're trying to highlight here is that our models have allowed us to significantly outperform not only the market, but your general 60-40 split while keeping your risk numbers below the S&P 500, and in some cases actually below your 60-40 traditional buy and hold split. So, we think we built a better mousetrap.
What we do, okay, we sell research. Premium Research has all of our models. It comes with some one-on-one time with Jack and I to teach you how to use our models in a way that's going to overlay with what you're doing now, help you to do it better.
Our ETF trade ideas are a part of this play.
Thank you. And we also have a Substack subscription. The one is free, asburyresearch.substack.com, or it's a stripped down version of the premium, but that is $25 a month. And then we manage money for, again, portfolio managers, as well as individuals. We got a $250,000 minimum investment. Our annual management fee is 1% up to $1 million. The fee goes down as we go higher than 1 million in terms of assets, and we use Charles Schwab. So again, if you'd like a copy of this, we'd be happy to send it to you. Go to asburyresearch.com. Go to the contact tab there. Just say I was at the the MetaStock event today. Can you please send me a PDF of today's presentation? We can do that. This is feeding the lawyers, and that's all we have for today. It looks like atypically we're early, so we could take a couple of questions if anybody has one.
Yeah. Let's see. I got the link in here. I've got the phone number. Actually, I didn't get the phone number yet, but let me go ahead and type that out. We did have a question earlier. Michael wanted to know if you've tested the A6 with the downside equities to enhance returns from both sides of the market.
We have. We also back tested the CPM model that way too, which is our other risk on and risk off model. And those models perform better being either in stocks or totally in cash or in some kind of an interest rate bearing ETF. And the reason for that, anecdotally, but I'm pretty sure it's true, the speed that the market, and I just know this from trading on the floor for 17 years, everybody on the trading floor wants to be short. I never understood that, but everybody wants to be short and the market goes up most of the time. But they all want to, they like the short because it's fast money. And that's where I'm going. The market goes up in one speed. Like if you're old like me and you remember records, you know, the market goes up like an LP, like a 33 and a third record going up. It comes down like a 45, faster. It's the same song, but it's faster. So when you're building a model and everything is based on numbers, there's no way to shift speeds. There's no way, you know, to shift it into third gear when you're going down and then to go back to first gear when you're going up. So that is why this, we found through ridiculous amount of back testing that trying to build one model that is going to work equally in bull and bear markets is extremely difficult. And the reason is because the speed of the trend changes.
Yeah, the other kind of component to that is, you know, where correction protection model is, or the A6 is going to get you out of the way of the, you know, impending downturn in the market, but we don't know how big it's going to be. So trying to time that understanding of, you know, is the market going to drop by 20% like it did this year, or is it going to drop 3%? And on those 20% ones, those short ideas work really well. On those 3% ones, you get chopped up a little bit. So taking an understanding as this isn't a predictive model in the sense that I know that the market's going to drop by a certain percentage. I just know that the market's unhealthy and I want to get out of the way.
All right, here's a good question from Richard. Richard wants to know, what are you guys offering? Do you do money management, newsletters, that kind of stuff? So if we're new to Asbury Research, what would be kind of the recommendation for, like, what's kind of, is there a best newsletter that you would recommend? Give us kind of an overview of what you do.
We'd like to start people off at our YouTube, actually. It has a lot of really good information regarding what we do, how we do it, why we do it, and it's free. You know, some of the best advice you can get from people is free, I guess. So we start off there, and then, you know, we kind of run a pipeline. You know, if you want a little bit more from us, we have a Substack that you can pay for that gives you the sort report several times a week, 2 times a week, as well as our chart focus package. And if you like that as well, then we kind of push you up the ladder, and that's our premium research. And then, you know, we also do some money management. I know this group's a little bit more active in trading, but if you have a portion of your portfolio that is going to be more buy and hold, or, you know, you find that you're going to go take a 6-month hiatus and need someone to manage your money, or you just don't have time for it anymore, we can do that for you as well.
And sometimes I mean, you know, we run across people all the time that they may have $1 million that they want to invest in the market. They may give us $500,000 or $750,000 of it to invest in the model portfolios that, you know, we talked about. And if you're interested in those model portfolios, AsburyResearch.com, go to the contact tab and say you're interested in learning more about the model portfolios. We'll do a Zoom with you. We're not really going to show those. It's kind of a know your customer, right? So once, and we're fiduciaries. So if you're interested in the money management, let us know through AsburyResearch.com, and we'll send you a link, which is the availability that we have to do a Zoom with you, looking out 3 weeks. We'll show you all 4 of the model portfolios, how they performed over time, what the drawdowns have been, and should you decide to work with us, we'll help you to find the one that is the most suited for you, both in your, your temperament and your finances. And we'll get you started there. The premium research product is expensive. People tell us it's expensive. To me, if you spend $50 a month on a service and you lose $300, that's not a good way to spend your money. Our 3-month for the premium is $499. Again, it comes with some one-on-one time with Jack and I, teach you how to use it. It includes all of our models, all of our signals. If you go for 12 months, it's $1,800. It's a little less if you go by the year, but that's basically it. We've got a free Substack, and we've got a free YouTube. Thank you. Video. If you want entry level, just to get a little bit better feel for what our premium looks like, that's the Substack for $25 a month. If you're ready to get into the models, that would be the premium. If you like us to manage money for you, again, that's $250K minimum, 1% management fee, up to $1 million.
Investment for all ranges and ages.
There you go. That's a good overview. All right, John, Jack, thank you very much. Good to see you. As always, appreciate it.
Thank you.
All right. Thank you very much. Okay, we've got all the links posted down there. And I'm going to go ahead and kind of just make me the presenter. And thank you very much again, John and Jack. Let me go ahead and, I can turn on this as well. We've talked a little bit about the Traders Forum, well, probably a lot over the week. I hope you enjoyed the sessions. We're kind of getting towards our very last speaker, so that's exciting. I do want to actually let you know that the first time we did on the Traders Forum, one of the things we do is we bring in guests and we talk about the markets. We talk about like how people got into the markets, what they think is important, that kind of stuff. Our next guest actually did the very first session of those. She was our very first expert, and she named the actual session that we do. We call it the Ticker Talk, and that's actually her name. So, but before we get to her, I want to say, if you haven't joined yet, go to thetradersforum.com. You can just sign up. There's no cost to join. You can chat. You can come to the sessions that we do. We do probably 2 or 3 sessions a week on most weeks. And we talk about everything from technical analysis and indicators to, whatever comes up. So thetradersforum.com. There's about 1,200 members that have joined now. It's been growing pretty fast, and we'd love to see you there. We'd love to, you can go up there, you can chat with other traders, you can get ideas, lots and lots and lots of really good resources there. So Greg, let me just say,
yes.
I promised like a flurry of prizes. And so I was thinking of the logistics of a flurry of prizes. I was like, well, it actually takes a little bit of time because I have to say, hey, Greg, give me a number. And then I go and look up the number. And then I say, hey, Greg, give me another number. So I actually did that already, except for I just looked up, I got the random generator right here. And so I just announced prizes right now.
It doesn't take AI to make my job obsolete. It just takes Jeff and extra minutes. Okay, I get you.
Yeah. So, but I do want your help in a second because we're going to give away the mega prize. But I am going to give away very quickly about 4 prizes. I've already kind of ascertained what prizes they are and who's getting them and all that kind of stuff. So let me go ahead and just go over to my tab right here. I did pull a brand list.
While you're doing that, I'll mention that. In fact, Anne-Marie Baiynd, it's Baiynd, right? Not Baiynd, Baiynd. She corrected me about a year ago, and I can't remember. Sorry.
It's Baiynd.
Apologies, Anne-Marie.
It's Baiynd.
It's
I always
Baiynd.
pronounce it as Baiynd.
Yeah, anyway, she's coming up next, and she is. Apologies, Anne-Marie. She's coming up next, and she's in fact our last speaker. You said kind of sort of coming to the end. We're not kind of sort of coming to the end. We are at the end, and she is our last speaker of the event.
All right. Okay, so just to go through these really quickly, Neil D with Yahoo in Canada, I'm going to give you access to the Methodology Essentials course from TechnoTrader. Martha has said quite a few times that that's her favorite course. She's going to give you access to that. Stephen D in Australia might actually be watching. I don't think he's probably watching real time live right now. Stephen D, though, in Australia, we're going to give you the 6-month subscription to the Mad Hedge. Sorry, it's a 3-month subscription to the Diary of a Mad Hedge Global Trader Dispatch. That's a newsletter and all the services that he offers. It's the normal value of $9.97. Cal P did not put in a country when you registered, but Cal, you're going to get 6 months of access to the Trading Winds Pro membership. That's the membership that is put together by Vince Vora and Rahul Arora. They do 3 weekly sessions. They do stock picks every trading day. I was going to say every day, but every trading day. Very, very good service, normally $97 a month. We're going to give you 3 months of access to that. And then last, certainly not least, we're going to do Lillian S. Lillian, you're going to get John Seville's Smart Search System. That Smart Search System is the pattern that John talked about a couple of days ago. I think it was Tuesday. It might have been. They're all blended together for me at this point. But with that one, it's basically the indicator that he's got for the SSS scanner and the pattern that predicts the
well, I would say that definitely qualifies as a flurry of prizes. And I should say that tells people they're in addition to listening to the very delightful Anne-Marie Band, they should wait around to the end of the conference for a lot of special stuff.
Oh, Quack had a question. What's that? I'm sorry, I didn't hear you.
I said like a flurry of prizes.
Yeah, a flurry of prizes, yes. Quack said that he really liked Asbury's approach. He hasn't really heard that approach in trading. And that's cool. I'm glad you said that because I always hope you learn something new. You know, this is a long conference. There's a lot of really different ideas about the market. There's definitely more than one way to make money in the markets. And if you learn something, it makes it worthwhile. And the whole concept behind this is helping you learn more about what you're doing and kind of be more proficient in the market. Greg, we're going to give away the MetaStock Mega Weekly End Prize. Oh. You ready?
Best prize. I'm ready.
Okay. This one we've been doing based on your questions during the day. So if you ask questions, and you might very well be picked. We're going to give away MetaStock. We've talked about MetaStock all week. MetaStock's been rated the best software in its price category for, you see right here, 32 years in a row. It can scan, it can test, it can chop. Chopping's not recommended.
All right.
For full disclosure, it can't chop. It can test trading ideas. It can forecast the market. And again, it's been rated #1. We're going to give you 3 months of access to the Zenith News Service. The Zenith News Service is one of the best news services out there, built as a little competitor to the Bloomberg product. I'm starting to not be able to talk anymore, Greg. So we're going to give you that.
You're almost to the finish line, Jeff. Hang in there.
I got this. In addition to that, we're going to give you 3 months of the Learn MetaStock service. Kevin does a really good job of kind of doing a lot of training videos for Learn MetaStock. We're going to give you that. We're going to give you 3 months of Magic Trader, which Peter Dalal talked about yesterday. We're going to give you 3 months of the of his mentoring service as well. And then in addition to that, I'm going to throw in 3 months of the RMO ATM. So it's a huge package. It's a massive.
I don't think we've ever given that much away in one blow.
Do you know how long it's going to take me to put that order in?
I don't know. We should have calculated the cost because that's a very significant. That's huge.
Yeah, it's at least it's probably I don't know, $1,500 would be my guess. I'm
guessing more than that.
But really, the return is more important too.
That's true.
All right, now, Greg, I've said how to turn this around and how we do this, but I'll reiterate. I was going to make you reiterate, but I'm already having enough trouble talking, so I might as well kind of just muscle through this. I'm going to start at kind of the bottom, actually, of the list today of the chats. I'm going to start scrolling. I'm going to tell Greg when I start scrolling up, and then at some point he's going to tell me to stop. And when he tells me to stop, whoever I actually be hovering over is going to win the prize. So you ready, Greg?
It's very scientific.
All right, let's go.
I'm ready.
Going now. Yeah, I'm going.
Stop.
Let's see. Earlier today, Michael B said, Jeff, just an observation. Some of our presenters need to update their charts. And that is going to be the one that
will
wins.
get you a long way.
Oh, I think that's hilarious, actually. Let me go ahead and just make a note of that real quick.
Congratulations to the prize winner. And I'll tell you what, I'll go ahead and I'm off to the dentist. I would love, Anne-Marie, to stay around and listen to you. I guarantee you I'd love to do anything almost more than going to the dentist, but off I must go. Thanks, Jeff, for everything this week. You've done a fantastic job. And
it's funny that Michael, the guy that won, has been very chatty today. Goodbye.
Oh, break a leg, everybody.
I'm jealous of the final prize right before he won it. So there you go. And how are you doing? I can't hear you. Let's see.
There we go.
Yep, that works.
How are you?
I'm good. How are you?
Shuffling in the background, listening to you guys. You should take that comedy skit on the road. That's very funny.
You should be here if there's technical issues. We just tell jokes, and in fair disclosure, they're not good jokes. But yeah, I do have some right here. Do you know that the difference?
Read me one. Read me one.
I've got one for you. This one, I was going to say it anyway. Do you know the difference between a bad joke and a dad joke?
The letter D?
First letter.
Oh my goodness.
All right. I'm going to run charts for you today, right? Let me officially introduce you. Emery is a huge friend of mine. We've known each other for longer than we care to admit.
Yes.
And
we both had a lot less gray hair.
What are you going to talk about? What are you saying? Let's see.
I shaved my beard before coming on.
Let's see. The thing I like about Emery today, she's going to talk about some seasonal patterns. I'm going to run charts for her. So Emery is just, like I said, she did our very first ticker talk. She named the ticker talk. But what is really interesting to me is a lot of times people will say, hey, what about this stock? And it'll be some ticker I've never heard of. And Anne-Marie will be, yeah, okay, earnings was here. And this is kind of like what the company does. And she's not looking at any references. It's just all up in here. And I have that area. It's just full of dad jokes. So
I think they probably are more fun than what I have stuck in my head. So
yeah, but I'm sure yours are actually probably better. All right, so you want me to look at charts. I'm going to basically, let's see where the SPY is. We're going to have a little bit of a doji today. Let me go ahead and apply the target rich trades. And I'm just going to kind of do what you tell me to do.
Sounds wonderful.
So we can look at any charts that you want. We are looking at basically the add-on that we developed for you. So
yeah.
And if you do have questions still, let us know. We'll be watching the comments and the questions and that kind of stuff as well. Let's go ahead and I'll let you get started.
Yeah, well, thanks those of you that are with me on a Friday afternoon. I think that's really awesome. Shows a lot of dedication to the markets. And so that's what we need, the market dedication. We need to work through that. So if we take a look at SPY, we just had the FOMC meeting, and that was really a very noisy price pattern. That was Wednesday's red candlestick formation, and the price action turned completely around, holding trend. And so the most important thing I like to look at is really trend. It's master and commander. It's just like, I love seeing father-son teams or mother-daughter teams or, family teams that go into this business together. And so I love that father-son team. And I heard the dad say, hey, listen, a lot of guys on the floor, they like to go short because it's fast. And you can see that very deep dip that immediately reversed with that wick that we have at the bottom of 2 days ago. And so one of the things that tells us is that overall, we've got a pervasive bid in the market. You can look up at the very top. That's the stochastic momentum index. It's one of the key indicators there that I talk about when I look at the combination of trend and momentum. And everything is telling us to buy the dip. Now, that being said, next week is, from a seasonality perspective, the weakest week of the trading year, statistically speaking. And so we have a tendency to see small drawdowns there, but as we can tell from the past, these drawdowns are simply buying zones. So the big thing to remember is you're coming into a week that could potentially give you a number of excellent buying opportunities. And so I'm going to talk to you about a couple of those. And if you are a quick strike trader and you're looking for relative weakness across certain charts, I've got a few things that look like they might be pretty interesting into a quick snap fade, depending on your time cycle and what you're looking at. A lot of us, we like those rhythm cycles of maybe 2 to 3 weeks. Maybe some of us are in shorter spaces, but that really does give us a view of what's going on. So we have the green bar at the bottom that says bullish. We have trend moving up that says bullish. We have momentum that's positive. It says bullish. So because we have been seeing dips like that, like the one that happened on Wednesday, we realize that those dips need to be buying opportunities. As a trader, I think Jeff and I have probably known each other probably close to 15 years, to be honest, something like that.
I think it's close to that.
Yeah.
I've moved back to Utah, and it's been almost 14 years ago. So
Yeah.
I think that's right.
Yeah. So we've known each other for a hot minute. And one of the big things that we talk about in this trading space is really just working on your entry so that as it moves up or moves down, whichever way you're trading, you're sitting in a really good spot. A lot of us as traders, we really struggle with patience, and so what we want to do is make sure that we understand to manage our risk the best. We are looking for pullbacks that give us buying opportunities. And so we're looking at a buying opportunity today, and price action continues to lift. We can see that candlestick turning more green. I can look on some other spots and see that we are rising up into the close of the day. A side note, I do believe it is because so many people said it was a buy the rumor, sell the news event, and a lot of people positioned on the short side, and they really are unwinding their short positions as we move into new highs. So as we take a look at some really hot stocks, I would love to look at Bloom Energy. That's BLOOM Energy, and I think the ticker is BE. That's Bravo Echo. And as we take a look at this one, it's been running really hot. So let's talk a little, see that? Boom. So this stock is in a very sweet spot in the sense that it's using AI to build more productive energy controls. And it's been running really very strongly over several days. And so we had, what day is that? Let me put on my handy dandy glasses here. And it looks like the highest volume area was a breakout zone. Wow, that was huge. Let's look to the one to the right, about the 10th of September. The 10th of September. Yeah, that is a breakout formation. Notice it holds the edge at the end of that day and it comes back, but none of the wicks fall into the body of that candlestick. You'll also notice that's where the indicator on this custom setup sits. You can see the dashed line at the bottom and it shows that, not dashed, dotted line right there. So it shows that support zone. It tells us what's going on, and it's been running for the hills ever since. So what we want to look for is a fade next week that pulls us into and around that $72 marker. What does that do? It allows the chart to give up just a little bit of that heat because it's been running kind of hot, and you can see those dojis printing up there. That's a sign of indecision. And indeed, the traders are slowing their roll on how fast they're buying these dips and how long they are holding them into the new rise. So anytime you see a doji, especially a couple of them in a row, say to yourself, you know what? The traders are not super excited about really moving up very quickly or moving down very quickly. But if we have a seasonal week like we normally would have, that seasonality gives us this move into 70s and we can pick it up. This is a great long-term, in my opinion, of course, this is a great long-term position event because they really are transforming themselves to move into regions that have a lot of energy in focus. That's a really good energy name. And when energy names dip, this is a great one to look at to say, you know what, I think I'll nibble in here. If you're the type of person that says, you know, I just want to put an introductory position, what if it goes up to 100 next month and it just leaves you in the dust? You know, you can, but I would say let your entry position be a fifth of your normal size so that when it does come in, because it does, it has a lot of experience, this chart does, has a lot of experience coming into its hull, dipping below it and then rising above it. And that hull, of course, is the moving average that's sitting there. If you prefer, you can use an exponential, you can use a simple, whatever it is, it's just telling you what trend is focusing on right now. So the next one I want to talk to you about is Caterpillar. So let's go to Caterpillar, C-A-T. And as we take a look at Caterpillar, it's been really running pretty well since it had its last forward leg to the upside. Now, my suspicion is this. We had the FOMC come back and say, hey, listen, we got a 25-point basis cut. We have likely 2 more cuts before the end of the year, and that's making the dollar weak. And so when the dollar gets a little bit weak, our ability to export as a profit also begins to rise. But that cross current of, well, will we be able to keep the staff that we have? Will energy be under control? What might go on here? It's got Caterpillar sitting in a place where it's had a very nice move to the upside, and now it's positioning where it's starting to pull back. Again, the goal here is, what I'd like for you to do is just take some notes. And if you're in the trader forum, you can hop in there and go, hey, this was the price action we saw. Does it still hold? And Jeff can send me a note or talk about it himself. But here's a great thing. This is old resistance. We can see the red dots across the top of that zone, just a little bit higher up. Yeah, we can see, yep, that's resistance, and it's broken resistance. And what it needs to do is come back and test support. So this is fantastic. If you're looking at it on a long timeline, you can go way out into the future and buy yourself a leap call spread. You might look at, you know, the 450 to 480 long call spread way out in the future. It's 2027 would be a good one to do it for, or late 2026, because interestingly enough, from a seasonality perspective, next September to December, a year from now, is the most bullish time frame that we have looking over 100 years of stock market data. So that's pretty impressive. Next year, it'll be really, really interesting catching ourselves some price action in that direction. But if you're staring that down, 440 looks like a really nice floor of support. And so you'd want to give yourself about 2 to 3% wiggle room underneath there in terms of pulling back. But what we do see is 2 days of some pretty big volume yesterday and the day before. Look at those volume histogram lines. They're very, very big. My thought is we easily could come into that 450 area before we start to run again. And that's a little bit further than where we are right now, for sure. So there we have Caterpillar, and our formations obviously tell us we've got upside trend, we've got upside momentum from our stochastic, and we've got a big green bar sitting underneath that tells us what the relative trend is in general. And so that's a really nice way to look at those spaces. If you like this chart to tell you exactly what to do, notice that 1, 2, 3, 4, 5 days ago, it gave you a buy zone. And it was also an area to re-enter. And so from that zone, you can look up to the top. I think this is an all-time high for Caterpillar, I believe. And so you can't really tell what's going on unless you draw yourself a Fibonacci. And that's also possible too. Fibonacci's are wonderful things to draw. You can draw it from the high of the 20, where's the last silver? Okay, this red diamond over in July, August, yeah, right there. If we could draw a Fibonacci from the red diamond to the green diamond below at around August let's take a look at that. Notice where the 1618, see, markets are amazing. I have to tell you this, traders, people who actively trade to eat, we're simpletons. And so we'll use drawing tools like this to tell us where we're close to the top of our formations. So this looks like a great place for a buy profit event. When you see a brand new high like that, you would want to take a little profit and say, all right, I'm going to trim back on my position when it comes back to between 440 and 450, which also matches that red diamond to the past. It gives us a really nice buy zone. So I really like that setup there. It's a strong company. They've got lots of pricing power. And if the dollar keeps coming in, which I suspect the administration might want that to happen, we can see them rise to the next level for at least the next quarter, which should be fairly bullish. Okay, so
real quick, one wanted to know what periods you use in the whole moving average.
Pardon me?
Juan wanted to know how many periods do you use in your whole moving average?
Let's, I have this. Could we highlight on the hull? I think it's 20, right?
Yeah. It's 20.
Yeah, that's what I normally say. Yeah. 20.
So
you can also, how about overlaying a 21 exponential so that folks can see how different it looks comparatively. Some people don't love the hull because of the way that it looks. And so that's a personal preference. right? It's a personal preference. I like the whole, it's got more rhythm. It will move more cyclically. Notice how this exponential is almost flat. So it has a hard, you have a hard time going, I wonder what that is. But if you study a hull, if you study your exponential, I mean, when a moving average goes flat, it means there's a fair bit of pricing underneath and above that average, and they will come right back to form an equilibrium. So whenever you see a flat moving average, it literally means you are in a trading range. And when you're in a trading range, look for those diamond patterns and old areas that are support and resistance, and they're going to help you manage your risk very well when you use the target rich trades setup. So it truly is a preference. You do what makes the most sense to you. I try not to force people into a box about what they should be thinking. I just, for this particular system that we built, you know, between Jeff and William, this thing has just, it's done beautifully in many, many, many areas. And so keep a note on your, what's that?
I said it was mostly William.
Yeah. Yeah, for sure. William's a card carrying genius for sure. All right, so let's take a look at another one. Let's take a look at Micron, MU. Okay, so this chart has been on an absolute torch. Look at that thing. Here's what you notice. Squeeze in that time frame again so we could see it across a long cycle. What you'll notice is that when this chart has these great big cycles up, they do one of two things. They will chop sideways and then break north, or they'll chop sideways and then break south. You go, thanks, Captain Obvious. That's every chart. Yes, but this one is very specific. They've got earnings coming in. The 23rd, I believe, they're coming in. And so if we expand here, notice what is sitting at the very top of this formation. It is a red diamond. And so what it tells you is that resistance has been formed up there. So naturally, when resistance forms up there, it usually means that price action is going to come in and flatten out. They have earnings coming out with the new Intel, NVIDIA alliance, and I'm going to say alliance with a little tongue in cheek because I think this is a strategic move by NVIDIA to ingratiate itself to the powers that be at the time. And so it's very smart for them to say, hey, let's help Intel out, but let's also align ourselves with a company the government has said they're going to take a 10% stake in it. So it keeps them under that umbrella of safety. What it's going to do with things, in my mind, like with Micron, with Applied Materials, with advanced micro devices, all of those guys, it's going to put a little pressure on them, my thought. Micron is one of these that I think will be under some pressure in the long term. I would expect a mean reversion, right? And that mean reversion may come right on the heels of the earnings event on the horizon. So a couple of ways to look at that. A lot of us don't like to trade into earnings. If we don't hold the stock, we don't want to expose ourselves to risk that's unnecessary, but some of us like to play that risk game just a bit. And so my thought is this is a clear space. The system has said, listen, you want to take some profit. The top end of the range is about 170. It's showing resistance there. So you could do something like you could buy a long put spread at maybe the 150 to 160 area and take the trade from that space. Or you might say, you know what, I want to trade something else. I want to take a short call, and that's where you would use that resistance 170 to 180 and use that resistance line to frame out your positions. These markers on this add-on really give you a tremendous amount of power to take a look at how can I trade this? Do I want to go straight long the stock? Do I want to trade an option? And how might I position those option strikes? And you can position those option strikes actually using the dots that appear in the space and also the zones that say this is a buy, right? You see something, it says, hey, this is a buy. You can literally look at the strike at that price and then build yourself one rather than going straight long the stock. For me, I'm going to look at this one. I do want to short this one. I think this one is very long in the tooth and it just needs to come back and take a break. However, I don't know what the funny business of the market is going to bring us. So what I want to do is wait until Monday. I want to see if I can get right back up to that 170 and then fall below my hull. And when I fall below my hull on the daily, that's when I'm going to take the short. My first target will be 150. My second target will be 130. And my third target, my second target will be 140. And my third target will be 130, moving that down. And then, you know, it may move sideways and turn around to the upside and start looking really great. Okay. Dexcom is the next one I want to look at. DXCM. It just had, there we go. So Dexcom is I'm trying to give us opportunities for longs and shorts. Do you think we could go to a weekly chart for this one? So for those of us that don't know, Dexcom is, it's a subscription-based model to help manage diabetes. And so, or diabetes, however you say that word. I really don't know how, honestly, I don't know. So what's happened here is Medtronic, which makes medical devices, has spun off the division they have that is going to compete against Dexcom. And I think it actually is going to give Dexcom a little bit of trouble. And so, full disclosure, we did talk, I talked about the short a few days ago, someplace else, and it's moving very well. But on the weekly chart, what we notice, if we look to the left, we've got all kinds of weekly buy zones that were sitting right when the hull started turning up. And so that would be around April, where the whole market began to turn up. So this is a zone that traders are going to say to themselves, you know what? If I hold that level and I can close above 70, I'm going to be able to take that chart right back into 80 before it has itself another run to the downside. So this is a short that's in play, but is now at a target zone. And so if you're looking at this target rich trades and you're saying, wait, how can I use this? When you look to the left, and you see buy zones, or places that tell you to stop, where you run into a stop, those things are lines of interest that the broad market comes back and checks all the time. So it's very likely that on Monday, you'll see a little bit of a bounce zone coming into the chart here. And then what I would be looking for is a short near the top of that range to re-enter a short, or if you don't like to short, you can take a buy and use it here. Look at how much volume went this week though. One, it's negative. See the big red bar below? It's negative. It's underneath a downward sloping hull. That's negative. And the stochastic momentum is negative. So any bounce that you see in a formation like this is going to rotate over. It could rotate right back into the support zones and then bounce again, but this is not a place where you would buy the dip and hang on. It's just got too much weakness and it needs to prove itself out. So if you bought the dip at 80 and then it rotated right back down into 70, you know, that's over a 10% exposure event, and we don't really want that. We really want to focus on, can I get the entry point right? Can I focus on getting that entry right? It makes managing the trade easier, it makes risk lower, and it gives you a sense of peace about, all right, I think I know what's going on here. Dexcom, very interesting company. I really like the company a lot. They're just going to be under a lot of pressure because new competitors are drifting into their space. Okay, let's take a look at coin. Where would we be if we didn't talk about something crypto related at least once a day? I like this. I have like someone in the back just pulling all the, yeah.
I'm gonna start saying as you wish.
Man, was that the best movie ever?
Oh, it has to be.
Absolutely. For those of you that don't know, that is The Princess Bride. If you haven't watched it, I suggest you do that right after we get off this call. So, all right. So as we look at coin, we can look all the way to the left on the weekly, and we can see a red diamond sitting round at about December of 2024, right? So that's old resistance that is now being tested as new resistance. So the question is this chart going to break to the north, or is it going to head back to the south? Now, here's the thing. If we have an event, we have a couple of things coming up. Because the fourth quarter earnings event is going to start, what we really have is a space where the stock buyback window is going to get closed. And so as the stock buyback window closes, what we end up having is a reduction in liquidity for a short period of time. That's why the seasonality has a tendency to appear, because they're not allowed to buy anything on the dips. And so that's why every year we see these seasonal drifts, and it has a lot to do with why these stock, when these stock windows for corporations, when they do their stock buybacks, when they open and close. So right now, we're looking at a space where coin might be a pretty good buy over the long haul, but wait. It's at resistance to the left. That's about 350. It's got negative momentum on the hull, negative trend on the hull, moving averages down. It has negative momentum, and like Jeff just showed us, it's got a negative bar up here. So what it's telling us is the chart is going to try and reject this zone. Right? So here's another way to look at that. If you could draw, Jeff, a Fibonacci on the short setup that began on the 1st of August and draw Fibonacci from the actual candlestick low to candlestick high or high to low, either way. Yeah, that one right there. Just the candle, not the wave. Yeah, just the candle. Okay, so notice this. Do you see where the top of the wick is sitting on this range? It's at the 50% level of that very high volume candlestick formation. And so the rule of thumb, which I don't know if you guys know where that came from, but it's a terrible rule. But the rule of thumb, in the good way, says that when a volume candlestick occurs, the traders will try to recapture 50% of it. And if they can break over, the probabilities increase that they can go to the top of the candle. But if they lose that 50% marker of the range without breaching it, they're very likely to head back to the bottom of the candle. On top of that, Jeff just drew this moving average for us. What is the slope of that average in the near term? It's flat. And so that flat action is telling us, ruh-roh, if I want to buy coin, I better wait for the dips down around that 300 area to see if it can hold, right? So let's go back to the daily and have a look at this on a daily rotation. All right. So here we are sitting at the daily space. We can see if we zoom in to that same Fibonacci that we drew that managed that week of motion, you can see the traders tried to build a base from, what is that, the very beginning of August all through September. And then yesterday they broke out, came just about to that 50% area. And then today, nothing. It's just very, very sideways. My thought is this chart is in a very shallow pattern. So the dips will be buys, but the dips could be deeper. And so you'd look at the red dots just underneath it where the last blue buy setup arrow is. That is on the 10th of September. Yeah, right there. Just right there at that blue buy. That's going to give you the space that tells you, you know what, if I can get in there, I am going to have the best opportunity for upside pressure with the least risk. So here's where I want to just stop for a second and talk about how we have to manage the psychological part of us that says, hey, I think this is going up, or I think this is going down. I'm going to get in front of this before X, Y, or Z. And so if we stare at that and we say, well, wait a second, you know, that looks bullish to me, I'm going in. The number one thing that retail traders fail to focus on is what happens if I'm wrong. And interestingly, the market will do some very common things. It will estimate in general, okay, the average trader has a 2-3% loss. Here it is right here. I'm going to pull back 2-3% and I'm going to get a better buy. And so you might go, who's thinking those things? Anybody that carries a large portfolio and is responsible for the performance of that portfolio will be looking for very deep areas to turn around and buy, because the market generally trends up. And so when people are in a period of forced selling, like they were in June of 2025 into the end, or July 2025 into the very beginning of August, that's forced selling into the space. Big money managers are always going to say, okay, I'm going to look to the left. I'm going to see what support is sitting there. And I'm going to start to reload as soon as price action gets near this area. And they will continue to add up into the position. And so they were staring down 300 to buy, and now it's sitting up at 350. So rotation should be expected. So wait for price action. I don't quite believe we are sitting in a space where we will have no opportunities to enter the market. Does anybody have any broad-based questions, or Jeff, is there a stock you want to look at, or has anybody got any stocks they want to look at?
Let me turn down my mic. I'm coming in a little hot. Michael said the coin is coming into a seasonal surge, and he expects a potential gain of 33% over the next 8 weeks.
Oh, that's great, right? And so here's another thing. It's got a very big gap, right?
Right here.
And, yeah, and it's in the gap right now. So the pullbacks, remember, when charts break out, they break out and then they pull back and then they break out again, unless there's something dramatic going on. Now, because I believe we are in a seasonally weak pocket because liquidity is going to dry up over the next week, I am suspecting that we won't have to buy this at 350 to get involved, taking it back to fill the gap way up here at 380 or whatever that happens to be. From my perspective, it's just always better to get things on the cheap. And so what I will do many times is I will go to my support zone that I look across. I try to match as many red arrows that are setting up, or as many stops that are setting up, and I'll say, all right, what is that number? Here, it looks like it's about 325 to 330. I'm going to sell a put there, so that if it comes in, it hits me, I get to position from that perspective, and then, I'm going to be in good shape because I got it for credit and I got it on the cheap. So I'm not afraid of letting an opportunity go by, because I know there's always another opportunity on the horizon. That fear of missing out is the reason a lot of people buy way too high and end up seeing themselves in drawdowns.
Clark wanted to know, why do you use Fibonacci ratio without counting Elliott waves? I didn't know they were connected, but do you do any?
Yes, they are connected, but here's the thing, and I'll be very transparent. I'm not smart enough to count Elliott waves and trade in the market at the same time. I find it to be very complex. So as a trader, I trade in the futures market. As a trader that is very active during the course of the day, I can see price patterns occurring hundreds and hundreds of times in a week. And the Fibonacci's, they get measured by those volume rotations, right? They just do. It's pretty amazing, actually. It is pretty amazing.
If you guys have stocks you want to look at, let me know. I'm watching both chats. Since you asked for symbols, I haven't seen this one yet today, but I'm curious to see what your thoughts are on Roblox now. It's had a really good move.
Yeah, I mean, it's been a really, I have a significant problem understanding the revenue generation until I start thinking about how much money Fortnite made. And that brings it all to the fore. We're all about, Roblox is a game, right?
Yeah, and it's the game that if you have teenage daughters, they always want rogue bucks, which are the
Oh,
yeah. But yeah, it's a
interesting.
huge game.
Yeah, and so in the game space, not disparaging. Well, it is disparaging. Our society is built around games and having fun. And so this chart has got a lot of upside potential as long as they know how to scale up, right? The one fly in the ointment is this gigantic red bar on huge volume
This
that
one, right?
occurred. Yes.
It sticks
Now,
out, right?
it sure does stick out. And the volume is certainly not as big as the volume was on February 10th, but this is savage volume. And the base of that candlestick is resistance right now. And so again, draw Fibonacci on it from low to high, so it expands to the south.
Okay, give me a sec.
For me.
As you wish.
Low to high, other direction.
Yeah.
Yes, that's all right. No
This time for sure.
Yeah.
Okay, here we go.
Yeah, that's it.
Okay, got it.
Yeah.
First
okay,
strategy.
so notice, see the close of that candlestick? They are jamming up against that, and there is a wall of sellers sitting right there. If we expand that just a little bit, if we expand that, we can see that they are coming right into that candle wall, that close of that bearish candle, and they are not climbing over. The flip side of that is that they are being defended from underneath, because there is a series of, I think those are those red? This should be green. The dots that are right under that $130 line.
Right.
Yeah,
That's
right
right.
there.
Yeah,
Yeah. And yeah, so they've got to stay above that zone, or this is really going to break down. But all of it says, hey, if it breaks down, it's going to come into that 120, maybe even the 100 area, and then turn around and move right back up. But there is a big line of sellers right up there at the top of that zone at 137. If they break that zone for a day, and the following day it's a follow through, they've cleared out all the sellers and they're back to buying volume, and 150 is the next line in the sand. But right now there are a lot of sellers sitting right there.
Buck wants to look at SMCI.
Oh yeah. So this one, I think they're going to have a little bit of trouble. Listen, semis, even my cup has got a semiconductor in it. It's just, everything's got chips, right? And so we need them. And SMCI has been moving, but it has, if you compare it to AMD or Micron or any of those guys, it is really underperforming. So the thought might be, what do I want to see this chart do? And so we can see a lot of buys and sells because it's reverting to the mean, it's coming up. This is where this exponential average does really, really well. And now they're trying to build a framework right here in the last 6 days or so. They're trying to build a shelf. So this could be a very, big sideways formation. Let's take a look at the weekly and see if we see something just a little bit more.
As you wish.
Oh man. Okay, so what we are seeing is that 40 is a pretty good spot. We've got a red series of dots, like at about 41 or so. Yeah, is that what that number is? The
43.
43, right?
8.
And
Yep.
so the question is, can we get up over 43 and then retest? Now, the problem is that we've got sell orders sitting right here. Notice anytime you see that red diamond show up, you know there's trouble. And it begins to form about below the low of that first candle that it gets put on. And so then we've got 2 sell zones that rotate over. So this is very, very sideways. I don't like this chart for a buy unless it comes down into the green dots near 30, where I have all of these buying opportunities to the left, or a move up above 60 that pulls back and then recaptures 60. So that's what I would say there.
All right, let's say one more.
Okay.
Well, I mean, unless you want to do more than that.
Of course.
GLD's been running.
Oh my goodness, has
been
it
carrying a lot of the miners with it and that kind of stuff.
Yes, absolutely. And you know, the thing is, a lot of people were expecting, okay, gold is going to roll over, gold is going to roll over. And this is what happens in the market. People move to one side of the boat and all of it tips over into the next side of the boat. And so what happened was people started positioning shorts and they held on their shorts for days and days and days. It looks like between May 16, where we've got this top range at around 320, that whole zone between 300 and 320, the traders were arguing about, no, it's a long, no, it's a short, no, it's a long, no, it's a short, until finally the long said, hey, I'm going to give it a shot. And the most aggressive buying when a chart like this breaks out actually comes from shorts covering their positions. And so this is what I believe is happening with gold. Now, upside, it certainly should have a fair bit. It should have a fair bit of upside sitting on it. If it doesn't, it'll test that 320 and then move to 340 and then rotate right back down. But until the market has a liquidity freeze where people just stop buying and selling, every dip is going to continue to get bought in gold. Again, this is the kind of place where I would say, you know, I'm interested in catching this on the near term to the upside, so I'm going to sell the $320 put. I'll collect a premium, and when price comes in, I'm going to get the stock at, not only am I going to get it at my support level event, I'm going to get it at a premium, which is going to give me even more cushion as I hold the position forward.
One last question from Quack. He wants to know if you can talk a little bit about the red and green ribbon at the bottom of the chart. This one.
Sure. So the red and green ribbon, they tell you areas of trend, areas when it's red, it's trending down. When it's green, it's trending up. And when it's black, it's neutral. So often, because we have a lot of V-shaped formations in charts these days, we don't normally have these pockets where we see areas of black, but areas of black always mean sideways pressure events, right? For me, I will look down and I will see, okay, it's green. That's my first thing. The next thing I'll say is, how close am I to my moving average? If I'm close to my moving average and that moving average is up, that's great. It's telling me I've got a nearby zone. On top of that, if my momentum is up, I've got the triple whammy of motion. But here's the thing about these markets, folks. If you hold through some of these whipsaw actions, it's going to give you a bellyache. It might be better if you are proficient at chart reading to say, you know, I'm going to look at this forward motion and I'm going to take it from support to resistance, or I'm going to take it up for Fibonacci extension, and then I'm going to trim way back and wait for price action to settle, and then I'll take it out on the next run. Because if you're patient, price action will settle, it will come in, and you will get yourself into a spot where things look good for you.
Maverick says gold stocks have been good to me. They've been good to me too, but mostly because Maverick keeps bringing them up in the traders forum.
Yeah, I tell you, Agnico Mines or Anico Mines, that's how, I think that's how they say it. The G is silent. That has been a beast. AEM, Alpha Echo Mike. I mean, wow. I mean, a lot of them are, but this one, AEM. Yeah, it's got the most.
I'm not seeing an
It's got this AEM. Okay, say AGNICO.
I'm sorry, what?
AGNICO. Anico Mines. Yeah, I saw it. There we go. AM. Yeah. Yeah, it is just it's been a beast. Oh, gee. Huh?
I don't think it wants to look at Agnico. And that's interesting because I did. It was a valid symbol.
It's hiding itself.
Oh, I know what it was. Okay. It's user error.
You know, that's always me. I always blame it on user error.
AEM.
What? Symbol. You got it under name.
Oh, okay. We might need some help getting this taken all the way home. Okay, there we go.
Yeah. So this one has got the best numbers underneath the covers, and it is doing tremendously well. These guys and a lot of other miners have followed suit, but guess what? They want gold so much abroad that they're saying, listen, you guys just pull it out of the ground. You don't even have to refine it. We'll just buy it from you. And they're selling it at a premium and not having to do all the refining work. So they are absolutely tearing it up. Absolutely tearing it up. This one is a beast.
Very cool.
Yeah.
I think that's all of the questions we've got. I want to talk a little bit more about this add-on and kind of show the expert and stuff like that. Thank you so much, Anne-Marie. Always
it's
a
my pleasure. Yeah, it's always fun. I love talking charts.
All right. This does have, as you can see, it's kind of drawing all of the buys and the sells and the setups and that kind of stuff. It does have a commentary. I'm going to open that up real quick, just to kind of give you an idea. This was done by the drawing was done by an actual Disney artist, right?
Yes.
So right now, if we're just looking at it, I'm going to go back to this day right here. It's going to give us an idea of exactly what was going on. Right now, it's bullish and bullish. You're in a buy zone, a trend. Tells you the profit target is hit, and it gives you Anne-Marie's checklist. So it does a really good job of kind of spelling everything out for you. Also, of course, it's got scanning. So if we want to be able to write a scan or run a scan, I'm gonna finish here. But if we wanted to be able to run a scan, you can come in here. You can scan for the setups, the profit target areas, the buy setups, all of that kind of stuff. And it does a really good job of that as well. Where are my slides? So it's called Target Rich Trades. And I talked about the expert advisor, the commentary, the scanning, all that kind of stuff. We did do a class. This was August 16th of 1 year. It's available as a download, so you can just download it and run with it. Normally, it's only $500. It's $399 here at the conference. If you need a trial to MetaStock, MetaStock's been rated the best software in its price category for 32 years now. We'll help you install everything. We'll give you unlimited support. Get in touch with us. You can watch a little video on this and buy it at metastock.com/AnneMarie. And of course, you can call us. I'm going to actually kind of type in this address real quick. Anne-Marie, thank you so much.
It's my pleasure. I enjoy spending time with you, Jeff. You guys are so great over there at MetaStock, and it's great getting to meet traders. And hopefully I'll see some of you guys soon in the near future.
Yeah, we need to have you back in for a chart checkup because you always do such a good job with that part of it.
Thank you.
And everything else, but particularly you did a great job.
Thanks a lot.
All right,
Appreciate it.
thank you.
All right, take care. Bye-bye.
Bye. All right, metastock.com/AnneMarie. Metastock.com/sales chat if you have any questions. 800-882-3040. Richard said, I learned a lot over the weekend, or over the week, enjoyed the experience. I'm glad you did, Richard. All right. I do want to say thank you to Stocks and Commodities Magazine. I've been talking about how great they are all week. They did a really good job, and I appreciate their support. If you haven't yet, join the tradersforum.com, thetradersforum.com. Just join our community. We do a lot of really cool stuff up there. It's been a lot of fun for me, and I think you'll enjoy it too. We are going to wrap up. So if you want to take advantage of any of the offers that we had over the course of this week, if you want to get an extended trial to MetaStock, any of that good stuff, go to metastock.com/conf-promo. If you have questions, if you want to get more information, give us a call, 800-882-3040 or metastock.com/sales chat. I want to say thank you to all of the great presenters this week. I think we had like 35 of them. I really appreciate all of the stuff that they've done for us over the years and the presentations that they give and everything. Also want to thank you. Thanks for being here. I hope you learned something. I hope you enjoyed it. I hope it was worth your time. Thanks for being here, everybody. We'll see you at the next one.